Zoom it is coming na. Hello, 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 hello. Yeah, here on YouTube also it is coming. Where is it? Here, okay, fine. Here it does not come. Okay, it will come. Okay, front is there. Slight delay time. That will be there na. Just 1 minute. Disable the recording here. Go to more. Okay, they are not recorded. Okay, fine. Yeah, audio is clear na. Is there a need for a mic? Speak here. Okay. Okay. I guess we are live. Students who are watching it on YouTube as well as Zoom, just give me a confirmation if the audio is clear. In the end, audio is okay. If you want, you guys can come front. There's a lot of space here, so that I can also save a bit of energy for myself. Don't worry, I'll not be asking you guys question. You can come and sit aram se. Zoom students, give me a confirmation if the audio is clear. Okay, clear, great. Okay, perfect. So we've got a confirmation from every end that the audio video is clear. So shall we begin? Yes, everyone. So hello, hi, namaskaram, and good morning, my dear students. I hope you guys are doing really well. So we have joined here for a 5-day AFM marathon revision series. So we will be focusing primarily on 4 chapters. Okay, in the order in which I'm going to take. First will be portfolio management, next will be advanced capital budgeting, next is going to be mutual funds, next is going to be forex. These 4 chapters are roughly from your examination perspective is going to give you around 45 to 55 marks weightage. Okay, so what all we'll be doing, concepts we will be explaining. Okay, some of you may have understood it, some of you may not have be having an understanding. So obviously not from scratch, but on an assumption that you would have heard things at least once, we are going to start with our discussion. With that, maximum questions also we will be solving. So questions, firstly from study material, each and every question we will do. With that, from past paper, from May 18 till now, that is till May 24, whatever questions have come, obviously eliminating the repetitive questions, we will keep on solving quickly. So obviously the speed is going to be much more faster. I hope that is clear. So just about me, 1 or 2 minutes for those of you who don't know about me. My name is Tabish Hassan. I'm a chartered accountant, all India rank. So I've taught more than 7,000 plus students for CA Inter as well as for CA Final in the last 2.5-3 years. Okay, so with that, let us begin with our discussion, everyone. Yes, on a small positive note, timings is going to be daily 9:30 to 6:30. On the assumption that there will not be any technical issues. Okay, these things were beyond my control. So hoping that they may not repeat. Yes, everyone. So just on a simple positive note, let us start with our session. What if it does work out exactly how you imagined it? You know, we have all those dreams that we see for ourselves. You know, even when things are not going that way. What if each and every dream that we have seen will be a reality? How amazing will it be? You know, we always think that what if our dream doesn't come true? What if I do not clear? What if that does not happen? Every time you get that question, ask to yourself, what if it does happen? How amazing will that be? What if every freaking dream of yours will be a reality? Think of that. Visualize that. Work towards that. If we work towards our dream, each and every dream that we have seen will be a reality. So with that, let us begin with the first chapter, that is going to be portfolio management. Okay, so from an examination perspective, portfolio chapter is going to cover roughly around 12 to 15 marks. Every attempt you will see 8, 16, 8, 16, sometimes 24, sometimes 30 also. Okay, so let us try understanding. So firstly, let us start with the basics. Now the way I teach concepts, yes, I explain the entire chapter with the help of simple stories. I do not believe in teaching you guys even a single formula. So obviously, the first thing, the main thing I want you guys is to give me first 2 hours of time to adopt to this method. Trust me, even a chapter like portfolio, which students tell is having a lot of formula, 50 plus formula, it is my assurance by end of it, you will be in a position to do it without touching a single formula. Absolutely zero formulas, pure simple logic. So are we ready to start, everyone? Students who are watching it YouTube live, everyone? Okay. So let us begin our journey with the help of some simple stories. I guess, yeah, it is coming, right? Yeah. So assume me, all of you guys, okay, I have cleared, assume all of you guys have cleared your CA. Okay. So sir, what to do? We all together started an investment advisory firm. We call it Maja Investments. Have you heard the term Maja? Yes. What is Maja mean? Enjoyment, Maja. Okay. So we start an investment advisory firm. So I am there. As you, I am the CEO. I have appointed you guys as personal CFOs. So whatever wealthy individuals come, you're going to manage their finance for them, advise, do all those things. Okay, boss. Great. So first story, an investor has come. You guys are there. Okay. So investor is coming. He's telling, I want to invest in the stock market. We tell, great boss. How much money you are having? He's telling, I'm having 100 rupees with me. Tell me, with 100 rupees, can you invest in stock market? Mutual funds you can. Stock market, which stock you'll get? So we tell, you're having 100 rupees, go get a chocolate for yourself. Give it to your girlfriend. Yes or no? Okay. He's telling, no, I was just checking you. I have 1 lakh rupees with me. So we are asking, okay, what is your plan, boss? He's telling, I have 4 shares in my mind. Infosys is there, Adani is there, Reliance is there, Tata is there. Which one is good? Tell me. So we tell, okay, boss, let us do an evaluation. So we made an evaluation in each of these shares. So we told that the theoretical market price or the fair price, security valuation chapter, ideally at what price that share should be in. So we told ideally Infosys should be at 1500. Similarly for all shares. Then we went into the market. We saw actually at what price it is trading. Now coming to Infosys, ideally at what price it should be there? 1500. But actually in the market at what price it is trading? 2000 rupees it is trading, boss. Ideally that product I should be getting at 1500. It is available at 2000 rupees. Will you buy it? Will you not buy it? I will not buy it. It is overvalued, boss. Okay. Coming to Adani, assume, yes, ideally it should be available at 1300, but it is available at 1000 rupees, boss. Good or bad? Good, sir. That means it is undervalued. So if I want, I should ideally buy it if I have the funds and interest. Similarly, Reliance, similarly, Tata. So we told that, boss, in the 4 stocks that you have told, Infosys assume is overvalued, balance 3 stocks are undervalued. Whichever you like, you invest. You told, boss, from the last 2-3 years, I have heard great things about Adani. I will do one thing. I will invest my money in Adani. So you are asking how much money you are having? 1 lakh. He is telling full 1 lakh I will put in Adani. I can see that 30% up it can go. So 1 lakh if I invest 30,000. Maja will come in life. Yes or no, everyone? Okay, great. So he is telling 1 lakh rupees fully I will invest. He told your money, do whatever you want. You've come for advice. We have given you advice. As simple as that. Okay, great. Now comes the question. Yes, when we are investing our money, is it good to invest our entire money only in one stock, or should we be creating a portfolio? We should be creating a portfolio. The question is, why should we be creating a portfolio? Say for example, yes, there are 2 aspects. One is the return, one is the risk aspect. Till now, everything that we have done is from the return aspect. Yes, selection of stock, which stock should I select, is from a return aspect. But creation of portfolio is from a risk aspect. I want to reduce my risk. Say for example, the investor invested in Adani, and say in a week, yes, these things we have told. Yes, in a week, Hindenburg report came. For those who have heard about that, yes, I am not getting to any of those stories. Assume after that report, Adani shares fell by 50%. 1 lakh fully you have invested. You thought it will become 1,30,000. 50% downfall came. What happened? It's now at 50,000. 50,000 rupees loss. Yes or no? Or say for example, some fire broke out in the plant. Some fraud was discovered. Assume, yes, government changed. Nothing more I am telling. Okay, assume. Yes, any of these things happened. Yes, say Adani shares fell by 50%. Now what is going to be the revised value? 1 lakh it was, now it has just become 50,000. That can happen with any share. Say for example, you invested in Reliance. Unfortunately, say for example, yes, after a week, some bad news comes about Mukesh Ambani, or some fraud was discovered, whatever it happened. What happens to the share? The entire value will fall down. Similarly with Tata, similarly with any share is having an inherent risk. But sir, if we create a portfolio, what will happen? Yes, on the other hand, yes, if that entire 1 lakh we distribute in 4 stocks equally, let us see what would have happened. So I am taking, yes, 1 lakh rupees investment, I would have invested in 4 stocks equally. That will become 25,000, 25,000, 25,000, 25,000. Okay. I am assuming every other share is like that only, nothing has happened. Yes, Adani fell by 50%. So 25,000 I had invested, it is now just 12,500. Every other share, some could be positive, some could be slightly negative, some could be highly positive. I am ignoring all of that. I am assuming every other share is like that only. That means it was 25, 25, 25. That means the revised portfolio value is going to be 87,500. The simple point being, why am I creating a portfolio? I want to reduce my risk. The objective is clear. Yes, why am I creating a portfolio? Simple point, I want to reduce my risk. That is why I am creating a portfolio. Otherwise, invest 100% money in a single stock, sufficient, na? Okay, great. So now we understood that, okay, yes, why we are investing in a portfolio, we want to reduce risk. So when we are creating a portfolio of assets, a portfolio of securities, which kind of securities should we be investing our money in? That is going to be the second story. Yes, moral of the story is, yes, whatever stock I am going to select is from a return perspective, but why am I creating a portfolio? It is from my risk perspective. Great. Now, which kind of shares should I be investing in a portfolio? Again, after that, okay, he understood the lesson. He came back to me. He's telling, yes, boss, I want to invest in a portfolio. Okay. So ideally, we should be investing in securities which are moving in the opposite direction so that my risk gets reduced. Okay, slowly we will pick speed, but initially to get the foundation right is going to be important. Okay, yes. So what does it mean, sir? So he's telling, I want to invest. I'm asking how much money you are having. He's telling 100 rupees I'm having. I'm telling, go get a chocolate, da. Why are you coming here? Saying, no, da. I was just checking. I have 1 lakh rupees with me. Told, great. Okay, he's telling, yes, what is your plan? What is it that you want? He's telling, sir, I made a full market study. Told, tell your market study. Yes, he's telling 2 things are there. Now, just imaginary situation. He's telling, sir, there are 2 different seasons. Rainy season is there, summer season is there. Assume 50% of time it will be rainy season, 50% of time it will be summer season. Okay, great, continue. He's telling, sir, I have identified 3 different business. Sir, in rainy season means nicely it will be raining. So if we come up with a, yes, chai samosa business, cutting chai samosa, nice money it will make during rainy season. With that, if we keep also, where a level? Sir, no, that is not there. Okay, only chai samosa. Okay, great. Rainy season, assume he is telling 30% return it will give, sir. Okay, great. If it is summer season, yes, that will not be making money. Sir, summer season, what will happen, sir? During summer season, we made an analysis that, okay, ice cream business we can start. It will give 30%. Or a juice shop we can start. Random numbers, just a story. Okay, 30% return it will give. We told, okay, great. So what is it that you want to do? Okay. Now he is telling, sir, I don't want to put my full money in one business. I want to create a portfolio. Okay, great. So now understand, yes, option 1 is, yes, I can put 1 lakh rupees I'm having. Yes, 50,000 I will put in ice cream business, 50,000 I will put in milkshake juice business. Okay. Or option number 2 is 50,000 I will put in ice cream business, 50,000 I will put in chai samosa business. Okay, great, boss. Now understand what can happen. Okay. 2 portfolios I have created. Portfolio number 1, 50,000 in ice cream, 50,000 in milkshake. Portfolio 2, 50,000 in ice cream, 50,000 in chai samosa. Okay. Yes. On a given day, if the situations turns out to be positive, each business will give 30%. Otherwise, it will not give. Okay, great. Now, suppose ice cream business, milkshake business. Assume it is summer. Okay, in summer, people will have ice cream, people will drink juice. Tell me how much money it will make. Sir, ice cream 50,000 I have invested, 30% return it will give. That means how much it will give? 15,000 rupees. Milkshake also summer season. People are drinking milkshake also, 30% return it has given. That means how much it is? 15,000. That means overall how much return it is giving me? 30,000 return it is giving me. Great, Maja is coming. Yes, sir, 30% return we have got. But, if in case it is a rainy season, tell me, yes, whether we will be having business. Some people will tell, sir, rainy season, summer season, winter season, sir, ice cream will have any time. Story. Okay, yes. Assume it is rainy season. Yes, what we are telling, in a rainy season, people will have chai samosa only. Assume, I'm just creating a hypothetical example. That means whether milkshake will give me any business profit? No, boss. Milkshake is also giving me no profit, boss. That means what is going to be my profit? 0. Risk is there? Risk irka? Yes, sir, risk is there. Either it can be 30,000 or it can be 0 also. Yes, but assume if I create a portfolio wherein 50,000 I put in, say, ice cream, 50,000 I put in chai samosa. Okay, assume it is a summer season. What will people have? They'll have ice cream. Ice cream is giving me 30% return on 50,000. 30% means 15,000. But tell me whether my chai samosa business is giving me any return? No, sir. Who will have in that? So how much profit I'm getting? 15,000. Assume it is winter. Yes, what is happening? Winter or rainy season? Yes, rainy season. Whether people are having ice cream? No, boss. Ice cream business is giving me 0. But in that time, what is happening? People are having chai samosa. On that 50,000, I am getting 30% return, 15,000. So tell me, yes, whether it is rainy season, whether it is a summer season, whatever the season, yes, whether the investor is having a tension. He gets up from sleep, he sees, oh my God, raining, okay, people will have chai samosa. Oh my God, hot, okay, people will have ice cream. No tension, yes or no? Okay, so we have understood 2 points till now. Firstly, yes, why am I creating a portfolio? I want to reduce my risk. Second, okay, boss, I want to create a portfolio. Which kind of share should I be investing in? Ideally, I should be investing in shares which are moving in the opposite direction, which are having a negative correlation. One is increasing, other is decreasing. One is decreasing, other is increasing. This is the overall background of why am I doing this. Okay, boss. So let us have a look at the basics. Yes, what is a portfolio? It is a bundle of securities. Till now, every analysis we have done from return perspective, but in this chapter, we are talking about a risk. Everything we are going to talk about is risk. Okay, if we invest in more than one security, what will happen? Risk will be reduced. Why? Because my investment is diversified. Okay, to what extent my risk will be reduced? It depends on the basis of correlation. How stocks are moving in relation to each other. Stocks are moving in same direction. Risk will be reduced or no, boss? If it is increasing, if it is decreasing, dumb or gone. If it are moving in different directions, yes, to a reasonable extent, my risk will be reduced. Is this clear, everyone? Okay, boss, this was my basics. Yes. Now comes concept number 1, which is going to be modern portfolio theory by Harry Markowitz. Yes, one of the most important things. Yes, so many things we are going to discuss in this. Okay, first thing is going to be expected return and risk of a single security. Most of you guys will be knowing the formulas. Quickly, let us try summarizing. Yes, expected return formula. Yes, return of a security, summation x by n. Yes or no? Risk in terms of variance, it is summation x minus x bar the whole square divided by n. Standard deviation is going to be square root of variance. You would have heard this. Yes, 10-15 minutes will give. We'll understand the base, because once this base is ready, all things which are coming subsequently are just an extension, tweak of here. Okay, so we'll spend some time understanding here. Okay, expected return and risk of a security. Okay, boss. So comes the question. Okay, boss, how do we calculate return and risk of a security? Simple example I am giving. 3 students are there. They gave mock examination. Okay, student 1 was there. First mock he scored 60, second also 60, third also 60, fourth also 60, fifth also 60. Every mock he scored 60 marks only. I am asking, yes, he is giving his final examination. What is the expected marks that he will be scoring? 60, he scored 60 only every time, so he will be getting 60 only. Okay. Yes, student 2 is there. Sometimes 60, 50, 70, 80, 40. If I take a total altogether in 5 examination, comes to 300. On an average, yes, 5 exams, different things he has taken. So on an average, how much he will be scoring in the final exam? Telling, okay, boss, all these times he has done. We will be taking the average, yes or no? Okay, 300 divided by 5. Again, I will tell 60 only. Third student is there. One exam he scored 60, next exam 20, next exam 100, next exam 30, next exam 90. Again, if you add, you are getting 300 only. What is expectation? Again 300 divided by 5, 60 only. Simple point. I want to expect the return in my future. How do I expect my future? By looking at the past. What has happened in the past, same things will be happening in the future. Okay? Yes. So student number 1 I am expecting he will score 60. Student number 2 also I am expecting he will score 60. Student number 3 also. Simple. We will always be predicting the future. How? By looking at the past. What has happened in the past, same things will be happening in the future. And now, when I am predicting the future by looking at the past, yes, which data from past I will take? Will I be taking extremes or will I be taking the average? I will be taking the average. Yes or no? So look at this. For this student, he may score 20 also. He may score 100 also. But what I want the average. Yes, most of the times what is going to happen? Okay. So I will be taking the average. So whenever I am telling expected return of a security, how much my security will give in the future? Anybody has seen future? No. But how do I say? By looking at the past. I will pick my past data. And which data from past I will pick? I will pick the average from that, and that I will tell is going to be the expectation for the future. Okay, simple. Okay. Now, for every student we told expected marks in exam is 60. But tell me whether a risk is there or not. Tell me. Student number 1, 5 times he gave mock, all 5 mocks, easy, difficult, whatever it is, he got 60 only. So what am I expecting in future? He will get 60 only. Risk is there. Risk will be there, but a very minute risk, because every exam he scored 60 only. Generally he is there 60 only. Okay, second student, sometimes he scored 60, 50, 70, 80, 40. Yes, on an average it is coming 60 only, but every time is it 60? No, boss. Gap is there, deviation is there. Risk is there, risk is there, boss. Comes my third student. Sometimes it is 60, sometimes it is 20, sometimes it is 100, sometimes it is 30, 90. Overall average is how much? 60. But whether risk is there? No, boss, risk is there. Now understand what is my risk. Risk is nothing but deviation from the expectation or a deviation from the average. I expected 60, but in reality if I get 20, that is my risk. Is this clear, everyone? Okay, boss. So is there a risk? Okay, boss. So we have told, yes, what is a risk? Point number 1 we understood. Yes, how do I expect future? By looking at the past. Past average only I will be expecting. Okay, risk. What is a risk? It is a deviation from expectation. What I expect, that does not happen. That is a risk. Or it is the scatteredness from average. I have calculated average. Yes, my actual is a scattering. That is my risk. Okay. If there is no deviation, means no risk. First student, some deviation, some risk, more deviation. Yes or no? Okay. So let's go into another example. Assume cricket. Okay, 3 cricketers I am taking. Assume first cricketer Virat Kohli. Yes, assume 5 matches he played. Every 5 match he scored 60, 60, 60, 60, 60. Assume. What is expectation? Next match how much he will score? 60 only. Risk is there? Very less. Okay, assume second player I am taking. Okay, assume I am taking Warner. Okay, he also plays well. Yes, first match he scored 60, second 80, 40, 90, 30. 5 match total is 300 only. Average is 60 only. But risk is there? Risk is there. Every time he has not scored 60. That side, this side it is happy. Some risk is there. Yes, then comes our third player. Assume Rishabh Pant. Yes or no? He plays, he plays. He goes, he goes. God only knows. God, sometimes God also doesn't know what is happening. Yes, first match he scored 120. Second match 0. Third match 110. Fourth match 10. Fifth match 60. Take 5 matches total is 600. Sorry, 300. Average is how much? Next match how much he'll score average? 60 he'll score. Risk is there. Risk is there, boss. Yes or no? So simple, expected return. How do I expect my return? By looking at the past, I will take the average from past. What is risk? It is a scatteredness from my average, scatteredness from my expectation. Okay, now let us come to shares. Okay, 3 different companies are there. Assume Tata. Last 5 years I saw 15%, 15%, 15%, 15%, 15%. What is my expectation? Next year how much it will? 15% only. Risk is there? Very less, negligible. Suppose Reliance. 15 it has given 12.5, 17.5, 14, 16. Average is still coming to 15 only, but whether deviations are there, risk is there. Yes, risk is there. Third assume is Adani. Sometimes it is giving 15, sometimes it is giving 0, sometimes it is giving 30, sometimes it is giving minus 10, sometimes it is giving 40. Again you add everything, expectation is how much? 15 only, but whether risk is there, deviation is there, scatteredness is there. Okay, online students give me a confirmation, audio video is clear. Okay, so till now whatever we have discussed, simple lessons. Firstly, how do I predict my future? By looking at the past. Which data from past I will be taking? Extrema? No boss, average I will be taking. Okay, it is nothing but the average of return I earned in the past is going to be my expected return. Yes, what is risk? It is the deviation from my average. I calculated my expectation. If my actual is deviating from that, that is my risk. Deviation could be positive, negative. Everything is a risk only for me. Okay, boss. X is not equal to X bar. The degree of risk is going to be my deviation. Okay. So with the help of one example, let us try calculating, building all the calculation. Tata Motors, last 5 years data is there. Returns are given 10%, 18%, 12%, 20%, 15%. Let us calculate expected return and risk. Okay, boss. 5 years returns are given. I want to calculate my expected return. First tell me total 5 years how much they've earned. 10 plus 18 plus 12 plus 20 plus 15. Online students also. 75 they have given, yes or no? 75% they have given in the last 5 years total. That means on an average every year how much they are giving me? 15% return. So I can tell, yes, what is the average? A simple formula for average we've been learning from 3rd standard. Total divided by number of units. Simple. Last 5 years, total 5 years, 75% we got was, that is for 5 years. That means every year on an average how much we were getting? 15%. That means in future also how much I will be getting? 15%. Okay. But whether risk is there? Risk is there, boss, because every year I did not get 15%. So what is the extent of a risk? Simple. I am expecting next year 15% I will be getting. If I am getting 15%, I am happy, very happy in life, no tension only. But if I am not getting 15%, yes, am I happy? No, boss. Yes. So understand, assume first year I got 10%. How much I was thinking? 15. How much only I got? 10. That means how much less I got? 5% less I got. So I will tell 5% less I got, minus 5. X minus X bar. I was expecting 15, I got 10 only, 5 less. Yes, second year, 18 I got. So how much more I got? 3% more I got. Sir, 3% more means you should be happy now, we should be dancing now. Why are you worrying? Yes. Risk is a risk, be it favorable or adverse. Everything is a risk for me. Okay, this is my expectation. Anything apart from expectation is risk. Suppose I tell that I will start the class at 10 o'clock sharp. I start at 10:30. That is also risk. You will come to me, you will wait. I start at 9 o'clock only. Nobody is there. Okay, more or less, both are going to be considered as risk. Okay, fine. Third year, 12 only I got. How much less I got? 3% less I got. Fourth year, how much? 20 I got. How much more I got? 5% more I got. Fifth year, 15 only. Risk is there. So now understand what is risk. Okay, investor comes to me, he tells last 5 years Tata's returns is this. What is going to be the expected return? I tell 15%. Sir, what is the risk? Okay, I will tell, yes, if Tata next year it gives 10%, na, yes, 5% negative risk is there. If Tata gives me 18%, na, 3% extra risk is there. Yes, if Tata gives me 12% only, minus 3% risk is there. If Tata gives me 20%, yes, 5% risk is there. If Tata gives 15% only, no risk is there. Investors, for this we are calling. Tell me one figure, na. Yes. So these are the individual risks. I want to know on an average what is my risk. Okay, boss, let me do the average. We know average. What is it? Total divided by number. So let me add, yes, minus 5 plus 3 minus 3, 5, 0. Add how much it is? 0. That means I want the risk, average risk I want. Yes, so I will tell, yes, 0 divided by 5, 0%. Risk is there? No, risk is not there. But tell me, is this giving me a correct picture? Whether risk is there in the security? Risk is there, boss. Then why it is not giving me risk? It is because I am calculating the difference from the average, the middle value. So obviously some will be positive, some will be negative. When you add everything, it will get nullified. 1 year it was 12, 1 year it was 18, minus 3 plus 3, you add it becomes 0. Yes, that means, yes, this thing has to be eliminated. I don't want this negative positive. Because of that, I am not getting my average risk, boss. So that was a problem. So what should we do for that? What should we do for that? What should we do for that? Yes, my risk is X minus X bar only. But when I do a summation of that, because it is in the center, everything gets nullified. Yes, it gets cancelled out. I am getting 0. So to eliminate this, what we have done, we have squared our deviations. I got my deviations, minus 3 was there, plus 3 was there. Both are risk, but it was becoming 0. So what, yes, Markovitch told is you square the deviation. Then if you want, you can do square root. Okay, boss. So 3 square has become 9. 3 has become 9. So your positive negative has been eliminated. Okay. So step 1, I calculated my deviation X minus X bar. I was ready to take an average of that, but it came to 0. So to eliminate this negative, what I did, X minus X bar the whole square. I did a square of my deviation, X minus X bar the whole square. Okay, perfect. So now Markovitch is telling this only is my risk. So if you ask me what is my risk, X minus X bar whole square, that is my risk. Okay. Now understand, when I do a square, it becomes percentage square. Simple. I am expecting 15% return. In reality, I got 10% only return. That means how much less I got? 5% less risk I got. Okay, that is X minus X bar is minus 5%. Yes. Now I am squaring it. So into minus 5%. 5 into 5 becomes 25. Minus minus gets eliminated. percentage into percentage becomes percentage square. Simple. 3x into 4y. 4 3s are 12, x into y becomes xy. 4x into 3y. 4 3s are 12, x into x becomes x square. Yes or no? Yes. 4 feet into 3 feet, it becomes square feet, feet square. Similarly, 3% into 3%, percent into percent becomes percent square. Okay, boss. So what all I did? Firstly, I calculated my expectation. I calculated deviation x minus x bar. Yes, I was ready to take average of that, but it came to 0. So to eliminate that problem, what we did? We did a square, x minus x bar whole square. Now my risk is ready. Yes, so I will just square this here. Okay, 5 square is going to be 25% square. It is going to be x minus x bar the whole square. 3 square is 9% square. 3 square is 9% square. 5 square is 25% square. 0 square is anyway 0. Okay, now I will just add all of them. Can you just add it to me? 25, 25, 50, 59, 68% square. Okay, yes, that is the summation. So investor is still waiting. Told boss, last 5 year data is there. Tell me risk na. How much is risk? I'll tell, wait. See, expectation is 15%. If you get 10% only, it is 5% less. That means 25% square is your risk. If you get 18%, 9% square is your risk. If you get 12%, 9% square is your risk. If you get 20%, 25% square is your risk. If you get 15%, 0% square is your risk. Telling, what are you trying to tell? Give me one single figure. These are all the different risk. What I want? I want the average risk. So I will average this out. So it is going to be 68% square for 5 years. That means for every year divided by 5. How much you are getting? How much? 13.6% square. That is my variance. What is my risk? My risk is variance. What is the formula of variance? For variance is denoted as sigma square. It is always in terms of percent square. Yes, firstly, I took x minus x bar. I took the gap. But when I did a summation of that, it became 0. I wanted to eliminate that. I did a square. I added all of that. But I want average divided by n. That gives me my variance. Okay. Okay. So, investor is still waiting there. I told your expected return is 15%. You told that, you told half an hour back only. Tell me risk. I told your risk is 13.6% square. What are you telling? Return you told in terms of percent. Risk also you tell in terms of percent, na boss? What is this percent square that is going around? Yes. My risk is a variance only. What is my risk? Throughout, if someone asks you what is risk? Variance. Summation x minus x bar the whole square divided by n. But variance, normal person cannot interpret because it is in terms of percent square. I want to eliminate the square so that it can be easy for me to interpret. So what I will be doing? I will be taking the square root. That is my standard deviation. For interpretation purpose, I am bringing it to standardized terms. So I'll tell, okay boss, 13.6 square it is. I will take a square root of that. Yes, square root cancels. 13.6 square root is 3.68 whatever percentage. This is my risk. Okay, standard deviation is going to be 3.68. So understand, yes, the ultimate story is, yes, when investor comes and asks me how much return next year I am expecting, 15% I am expecting, boss. But will it happen that 15% only I'll get? No, boss, risk is there. On an average, how much risk is there? 3.68% plus or minus it can become. Is this clear? I'll ask for water. Okay, I have water. Till here things are fine. Okay, this is my risk only, but it becomes difficult for me to interpret. So in order to eliminate that, yes, I am doing a square root of that. Okay, so conclusion is, yes, next year what is expected return? 15%, risk plus or minus 3.69%, up or down it can become. That means 15 minus, if it is on the lower end, minus 3.69, somewhere around 11.3%. If it goes higher, plus 3.69, somewhere around 18.7%. Yes, normal distribution, all those things are not needed for the time being. Okay, so we have discussed these three formulas. Yes, expected return next year, how much I will be getting, based on which data I will pick? Based on my past data. Yes, I am expecting the average to happen. That means summation x divided by n. Risk is there, risk is there. How do I denote my risk? What is my risk? My risk is variance. My risk is variance only. Yes, I will calculate the deviation x minus x bar. I will do a summation of that. But boss, summation will become 0. To eliminate that, I will square it. That becomes the total of my deviations. I want average divided by n. Yes, and what is going to be my standard deviation sigma? It is going to be square root of variance. Till here, is this clear? Any doubts? No, boss, absolutely clear. Okay, expected return is summation x by n, variance formula, standard deviation is square root of variance, or you can also write it as square root of variance formula you can be putting. Okay. Till now it is over. Now one small final point is there. Yes, we told that last 5 years, Tata is earning 15%, 18%, 20%. That data was there. From where on earth am I getting that data? How am I getting my annual returns? Sometimes it will be given in the question. If it is given in the question, jingalala, no tension, boss. But if it is not given in the question, how do I calculate? Simple, boss. Yes. Suppose today I buy Tata company shares at 100 rupees. It is not available at 100. Assume it today I purchase it at 100. Okay, boss. How much money is going from my pocket? 100 rupees. Yes, by end of first year, they give me a 10 rupee dividend. Happy as sad? Yes, year end, my closing market price is 125. Happy as sad? Tell me total by end of the year, how much extra, how much return I've got. Sir, 10 rupee dividend I got, and 100 rupees what I'd invested, now it has become 125. That means 10 I got plus 25 I got. 35 rupees return I got. On total, how much investment? On 100 rupees investment, that means how much percent it is? 35% return it is, yes or no? So can I tell my return is nothing but the dividend I am getting from a share plus the capital appreciation on my initial investment into 100. If you want to write it down, yes, in a simpler way, dividend I will write it as a D, capital appreciation it is a P1 minus P0. At how much I purchase today, how much it is, that gives me my capital appreciation divided by P0 into 100. Okay, this is going to be the annual return. Okay, so till now 4 formulas we have pulled. Okay, yes, let us quickly try summarizing. Yes, what all we have done. Firstly, expected return. What is going to be expected return? Previously, what all I have earned, average of that, summation x by n. Yes, risk. How will I show my risk? Variance. Yes, I will take my deviation. I will do a summation of that. But when I take the total, it will become 0. To eliminate that, I will square it. I want the average. Summation x minus x bar the whole square divided by n. Standard deviation is square root of variance. Sir, x is not given to me. X. How do I get? How much dividend I have earned plus how much capital appreciation has happened on my initial investment into 100. Okay, great. Till now it is fine. Okay, boss. Great. Now let us try solving 1 or 2 simple questions on that. Okay. Simple example, I will show it here itself, quickly we'll finish it off. Okay, yes, returns of X limited for the past 5 years is given, calculate expected return and risk. Okay, 15, 20 minus 5, 30 as well as 5. Okay, 5 years we've earned. So 10, 20 minus 5, 35. Yes, can I calculate the total of the returns in 5 years? Total, how much we have got? 60%. I want the average, it is for 5 years. So I'll tell expected return X bar is summation X by n. 5 years total I got 60%. I want every year, sir. Divide by 5, 12%. Okay, but whether risk is there? Risk is there. So risk is x minus x bar. Now how do we calculate? Yes, do it on our calculator quickly. Yes, x bar will be constant. So it is 10 minus 12. How much it is? Minus 2. Yes, directly you will press 20 on your calculator, equal to. So there is no need to every time write it minus 12, whatever it is. Yes, 20 minus 12, how much more I can get? 8. Yes, if it is minus 5. Now here you will have to be careful. Yes, from minus 5, I was expecting 12. How much I am getting? 0 also I am getting. No, boss, I am getting minus 5. So from here, 0 it is coming. Again, it is going minus 5. That means how much negative? Minus 17%. 30 means how much extra I am getting? 18%. 5 means how much less I am getting? 7%. If we add everything, it will become 0. So I want to eliminate that. I will square it. So tell me 2 square is 4. 8 square is 64. 17 is going to be 280. 9, 324, yes, 49. Okay, great. Add all of this together. 730 percentage square. Okay boss, yes, I want the risk is always the variance, which is sigma square summation x minus x bar the whole square. I want average, how much it is. 730 boss is for 5 years together, that means every year roughly how much it is going to be. 146 exact. Yes or no? Yes or no? Yes or no? No, it is 146% square. Okay, yes, can I interpret 146% square? 12% is giving, risk is 146% square. Yes, so I want in terms of interpretable terms, square root of 146, it is going to be how much? 12.08%. That means I am expecting 12% plus or minus 12.08, it may happen. Okay, great, perfect. Yes, 12% plus or minus 12.08 may happen. Okay, yes, alternative presentation. Okay, now in a different way let us try to do this. Yes, using that expectation of future also I will build. Okay, now I am telling last 5 years 10%, 20%, minus 5, 35 has happened. That means next year, in future also, what is my expectation? Any of these may happen. It can be 10% also, it can be 20% also, it can be minus 5 also, it can be 30 also, it can be 5 also. Now, what is the probability of occurrence? Nothing is given specifically, so I will assume equally enough the things can happen. So that means 5 years are there. Yes, so it is 1 by 5.2. 20% chance is there of each of the things to happen. Yes or no? Yes, I toss a coin, head or tail, probability 1 by 2. Yes, out of 5, anything can happen, 1 by 5, 0.2, 0.2, 0.2, 0.2, 0.2. So now what is my expected return for the future? Yes, my return can be 10%. What is the probability that it may happen? 20% chance is there. That means my expectation is 10 into 0.2, 2%. Yes, it can be 20% also. What is the probability it may happen? 20%, that means it is going to be 4. Yes, it can be minus 5 also. What is expectation of that? 0.2, that means it is going to be minus how much? Minus 1. Yes, 30 into 0.2 is going to be 6. 5 into 0.2 is 1. Again, you add all of this. What is going to be your expected return? 12% only. Clear? So, if I am having historic data, yes, summation x I do divided by n, or else I can also do it like this, summation x, yes, 1 by n gives me my probability. So, it is nothing but summation p into x. Okay, boss, great. But whether risk is there? Risk is there. Now, I have to calculate my x minus x bar. Here we will have to be careful. Most people commit a mistake here. Yes, I should do x minus x bar. What is my x bar? 12%. I am expecting 12%. But boss, I got 10 only. Risk is there? Risk is there. How much less it can be? Minus 2. If it is 20 means 8. If it is minus 5 means minus 17. If it is 18 means 18. If it is 5 means minus 7. Okay. Yes. Now, I will do a square of that x minus x bar. Yes. Negative. Yes, positive. I want to eliminate 2 square becomes 4. 8 8s are 64. 289. 324. 49. Now, my risk is always in terms of percentage square. Okay. Yes, there is a risk that, okay, yes, my risk could be 4% square. Yes, what is the chance of that happening? 20% chance is there. So, 4 into 0.2 is going to be how much? 4 into 0.2, quickly. 0.8. Okay, quickly on your calculator, you guys do. 64 into 0.2, 289 into 0.2, 324 into 0.2, 49 into 0.2. Yes, add and give me the total, grand total or m plus. Okay, 4 into 0.2, 64 into 0.2, 289 into 0.2, 324 into 0.2, 49 into 0.2. 146 percentage square, the same thing only we got. Yes, but it is in terms of percentage square. Yes, I will take a square root of that. Yes, it becomes 12.08%. Okay, simple way, understand. Yes, till now past data everywhere I was doing divided by n, which is nothing but 1 by n, which gives me the probability. So, past data whenever I had divided by n, yes, for a future data or when probability is given, I will multiply it by probability. Simple. Expected return. What was my formula? Summation x divided by n. For future data, yes, every year what will happen? What is the probability of that? Summation p into x. Yes, risk is always variance. Yes, it is x minus x bar the whole square, summation x minus x bar the whole square divided by n. But when it comes to future, Yes, I will take x minus x bar the whole square. And what is the probability of each of these things happen? Summation p into x minus x bar the whole square. Standard deviation is anyways square root of variance only. Is this clear? And how do I calculate a return of a security? It is how much dividend I am getting plus how much price will increase divided by p naught into 100. Okay. Yes. Now one thing I told that whenever I do a total, whenever I calculate average risk based on x minus x bar the whole, yes, x minus x bar, it will become 0. But here check, yes, just do the addition, minus 2 plus 8 minus 17 plus 18 minus 7. Add how much you are getting. Are you getting 0? You are getting 0 here. Directly you are getting 0. Okay, don't worry. Next question I will see where you are not getting 0. Could be that, okay, numbers are equally placed and probability is also same one. Okay, fine, no issues. Next question we'll see. Okay, next example, let us try see. Yes, here returns are not directly given. Returns have to calculate. Question is telling, boss, yes, every year 6 years data is there. Yes, every year end what is the market price is given, and for that year how much dividend I have got is given. First year end market price was 100. That year 10 rupee dividend I got. Next year end this is, yes, all these things are there. Yes, let me just write it down in the form of a, yes, line so that I understand. Yes, year 1 I invest. How much at what price I invested, God only knows. They have not told. They have told year 1 ending na the value is 100 rupees. Okay, boss, great. And in year 1 10 rupees dividend they have given. That is what they are telling. Tell me, for first year can I calculate my return percentage? Not possible. How much I have invested is not given. This is the price at the end of the year. So I cannot calculate for first year. Next year onwards, if I want, I can calculate. Simple. Yes, second year I will see. Look at this. First year end 100 rupees it was. Yes, by the time it reached second year end, it became 120. That means how much capital appreciation I got? 20. With that, how much dividend I got? 10. That means total 30 I got on how much? 100 rupees. That means I have got 30% return. Simple. Look at this data. Year end 100 was there. It became 120. That means 20 this I got. And in the second year 10 rupees this also I got. So total 30 I got on 100 into 100. Here, yes, people will not commit a mistake in understanding, but while picking numbers, 80% of you guys will be, yes, doing a mistake. So you have to be very careful here. Once you do this, then it becomes fast. But here you have to be very careful. If you want to draw a line, understand every year what is happening. Based on that you do. But calculation of X is going to be difficult here. People will commit a mistake in a hurry. Okay, boss. Second year, yes, second year end it was 120. Third year end it became 130. That means how much capital appreciation I am having? 10 rupees I am having. With that 14 rupees dividend I got. Total 24 I got on 120. How much it is? 20% again. Okay, 20%. Okay, third year 130 was there. It became 140. 10 rupees I got plus 10. 20 I got on 130. How much it is? 15.38%. Yes, fourth year 142. It became 120. Good or bad? Bad. 20 rupees fell. But 5 rupees I recovered from dividend. That means total how much fell? 15 fell on 140. How much? 10.71%. Okay, great. Fifth year. Yes, 120 was there. It became 136. 16 I got plus 10 rupee dividend also I got. That means total 26 I got on 120. 21.67%. Okay, so I've calculated every year's annual return. Okay, you guys can do it in the form of a statement or be careful. The only point is be careful. Okay, yes, simple point. Whenever market price is given, yes, if I am having 6 years means for how many years returns I will get? Yes, -1, 5 years only I will be getting, because for first year opening price will not be given for. Okay, yes, once I have got my data, then it is simple only. Yes, I will do the average. Yes, every year return I have written. Okay, numbers could be, yes, more or less based on whatever you guys are telling. I am writing. Recorded students, if number is wrong, okay, yes, you guys take care of that. Okay, yes, PDF I will share it with you guys during the break in our Telegram group, don't worry. So summation is given 66.33. Yes, based on that, what is my expected return? 5 years data I got. Yes, 66.33 divided by 5. How much it is? 13.26%. I will take up to 2 decimals sufficient. Yes, I will do my x minus x bar, 20 minus 13.26. Similarly, I will keep on doing. Yes, I will square my deviations. Yes, I will do the total of the square. I will be getting 740.47%. That means my variance is summation x minus x bar the whole square divided by n. Yes, 740.47 is for 5 years. So for every year I will be getting how much it is? 148.6. 0 percentage square. Yes, I want in standardized form, square root of that 12.17 percentage is going to be my risk. Okay, so till here it is okay. Okay, fine. Okay, now if future data is given, how do we do that? Okay, yes, example number 3 is there. With this example, okay, let us try seeing. Okay, now understand, if past data is there, okay, based on that I will do. New company is formed, past data is only not there. How will I estimate? Some random estimates will be there on how much I might be earning. Based on that we will be doing. Say for example, yes, you are telling, yes, CA final AFM exam, how much you will score? If you are given mock examination, average of that you will take. Or else you will tell, sir, if paper is very easy, na, we will score 80. So if paper is very difficult, na, we will score 40. If paper is okay, we will score 60. What is the probability of that happening? Take the average of that, you will be getting. Okay, boss. So we are telling for next year what may happen. Yes, it is also called as ex ante analysis. Yes, analyzing my past based on past data is ex post analysis, post mortem analysis. Once this is done, I am looking back, based on that I am analyzing. Yes, future data is also called as ex ante analysis. I am anticipating what will happen in the future. If in case you get the yes terms, you should be knowing, that's all. Ex post, over, post mortem, back you are looking. Yes, ex ante, front you are seeing, anticipating future data. Okay, boss, great. Now all these things are there. Based on this, let us try calculating. Okay, I am telling, yes, I can earn 2%. What is the probability of earning 2%? 20% probability is there. So how much it will be? 2 into 0.2, 0.4. I can earn 8% also. What is the chance of that? 40% chance is there. How much it is? 3.2. Yes, I can earn 10% also. 30% chance is there. See, I can earn 20% also. 10% chance is there. 2. Yes, do the total of this. How much you are getting? 8.6%. Yes, one more mistake people do here is, yes, again they will do divided by 4. Yes, do not do that. Yes, when you are multiplying by probability, already you are doing, yes, expectation is how much? I can earn 2%, but its chance is only 20%. Only 20% I will be calculating. So on and so forth. Okay, a simple point. Past data is there, everywhere you will do divided by n. Future data is there, everywhere you will do into p. There is no more dividing by n. Okay, boss. But whether risk is there, risk is there, boss. So let me try calculating the risk. Okay, now my expectation is 8.6, but if I get 2% only, how much less it will be? Minus 6.6. Yes, if I get 8, how much less it is? Minus 0.6. If I get 10, 1.4. If I get 20, 11.4. Yes, this is my deviation. Yes, I will be squaring my deviation. Okay, 6.6. Yes, into square. Yes, into yes, 6.6 into 6.6. How much it is? How much? 43.56% square could be my risk. What is the chance of that happening? 20% chance is there that it may happen. Yes or no? So into 0.2. How much it is? 8.712. Okay. Now here onwards, directly on your calculator, you guys do it. Okay. Yes, 6.6 into 6.6 into 0.2 m plus 0.6 into 0.6 into 0.4 m plus 1.4 into 1.4 into 0.3 m plus 11.4 into 11.4 into 0.1 m plus. So what is the total value that you are getting? Zoom live students. Yeah, how much you are getting, da? Okay, 22.44. Whatever, does not make much of a difference. Okay, yes. So this is my risk. Okay, in terms of percentage square, but I cannot interpret that. So for that purpose, what I'll be doing, I'll be taking a square root of that. So I'll tell expected return, formula. Yes, every year's return is given, with that the probability is given. So I will get the expected return. Risk, how will I be getting my risk? Always in terms of variance. Yes, I will take the deviation. Yes, I will square my deviation. Yes, I want to know the average of that into probability. Yes, I will add all of that. I will give it my expected risk. Yes, this will be in terms of percentage square. Yes, I want to calculate in terms of percent. So I will be doing, yes, square root of a variance. Okay. Yes. Now one very simple point. Yes, sometimes, yes, you might be getting this question. Sir, the reason why I did a square was because when I added, I was getting 0. But here you add and check x minus x bar. Yes, minus 6.6. Yes, minus 0.6 plus 1.4 plus 11.4. You add. Are you getting the total as 0? You're not getting the total as 0. So, sir, here what is happening? Understand, here also the total is 0 only. It is just that, yes, here, yes, my risk could be minus 6.6. It can happen that I will earn 6.6% less. But what is the probability, chance of that happening? Only 20% is there. So, minus 6.6 into 0.2. Yes, I can earn 0.6% less. Minus 0.6 into 40% chance is there, 0.4. I can earn 1.4% extra, its chance is into 0.3. I will be earning 11.4% extra, its chance is 0.1. Yes, this if you do p into x minus x bar, that time it will become 0. If you want, you can check that. Okay. Yes, great. Okay. Fourth, one more example is there wherein market price is given. Okay, current market price of a share is 500 rupees. Today I invested in a share. How much money I paid? 500 rupees I paid. Yes, today I invested. Future what will happen? God only knows. But we anticipated. We are anticipating what all may happen. If economy is bad, there is a 20% chance that economy can be bad. If economy is bad, now price will be 480 only. Yes, but they'll give a 10 rupee dividend. Economy is okay, it will become 520. Yes, I'll get a 20 rupees dividend. Economy is good, economy is best, great. Okay, different chances are there. Yes, here returns are not directly given. So my first step is to calculate the returns. Okay, boss. So today I invested 500 rupees. Yes, if economy is very bad, 20% chances there, it may come down to 480 rupees, but I'll get a dividend of 10 rupees. So let me try calculating my returns. Okay, 10 rupee dividend I got. But boss, 500 I invested, it became 480. That means how much capital appreciation am I having? No, boss, 20 rupees it fell. That means net how much rupees is a fall? 10 rupees minus on how much rupees investment? 500 rupees investment. That means how much percent it is? Minus 2%. Okay. Yes, if it becomes 520 rupees, my investment, yes, initial investment is 500 only. There, past data, every year it kept changing. Here it is 500 only. Okay. 20 rupees I got. Yes, capital appreciation. 20 rupees dividend also I got. So I got overall 40 on 500. That means how much it is? 8%. Yes, if market is doing good, 500 becomes 550. 50 rupees plus 30. 80 rupees I will be earning on 500. That means 16% I will be getting. Yes, if market is super amazing, 500 will become 600 rupees. 100 rupees plus 20 rupees. 120 I will be getting on 500, which is going to be 24%. Okay. So now I got my returns. Okay. So returns I've got. Yes, probability is given. Yes, p into x. Yes, there is a 20% chance that I will be earning negative 2%. There is a 40% chance that I will be getting 8%. So on and so forth. Yes, I will get my expected return. But whether risk is there, x minus x bar. Yes, but we will always be squaring it, x minus x bar the whole square into probability. Okay, so when I'm doing, I'll always be doing directly x minus x bar. Directly I'll put x minus x bar the whole square into p. I'll be doing instead of writing so many times. Okay, yes, this gives me my variance. You take a square root, you will be getting standard deviation. Okay, boss. Yes, till now whatever we have told, let us quickly summarize. Yes, firstly, why am I creating a portfolio? Because I want to reduce my risk. How my risk will be reduced? Based on the correlation between stocks. Negative correlation means risk will be reduced to a greater extent. Okay, boss, I want to calculate the expected returns and risk of a security. Yes, firstly, yes, two different ways data will be given. Yes, either past data will be given or future data will be given. Past data means divided by n, future data means into p I will be doing. Okay, expected return, also known as x bar. It is the average return. So every year how much I earned total divided by number of years. Yes, risk, how will I be showing my risk? In terms of variance. Yes, x minus x bar, risk, whole square, do a summation. I want the average divided by n. Yes, standard deviation sigma is square root of variance. Okay, yes, when future data is given, that is a probability, weights are assigned. How do I do that? Yes, what is the return into how much percent chance is there, probability. Add all of that, you will be getting your expected return. Okay, risk, x minus x bar, risk, do a whole square. Yes, I want average of that, that is nothing but the probable into probability. Summation P into x minus x bar the whole square. Standard deviation is anyways square root of variance. But if x, that is my returns, is not given to me, how do I see? Yes, how much dividend I got plus how much capital appreciation, P1 minus P0, yes, on how much investment into 100. Till here things are okay, fine, absolutely fine, no issues. Okay, great. Okay, in this entire chapter, all calculations of return will always be done in percentage terms only. Question will give me 10%, 12%, that way only the entire chapter will keep doing. Okay, variance and standard deviation of a risk-free security is always 0. Simple basics for MCQs. Risk-free securities, there is no risk only. Yes, you put in government bond, 6%, 6%, 6%, 6%, 6%, 6%, 6%. 20 years is there, every year you get same only. Deviation is there? No, deviation is not there, means risk is there. Risk is not there. So variance is 0, take a square root, standard deviation is also going to be 0. Okay, yes, standard deviation will determine the total risk. It can further be bifurcated into systematic and unsystematic. Subsequently, we will be discussing. Okay, yes, when I tell a risk of a security, what is the risk? Whether my risk is variance or risk is standard deviation. Yes, as per Markowitz, risk is always the variance. Variance is my risk. I cannot interpret variance. That is why I am bringing standard deviation. The only reason of bringing standard deviation is for interpretation purpose. Till here, is this fine, everyone? Okay, great. Now, yes, if you want, yes, to bring everything down in the form of a format, now you can do it like this. See, types of question. Either future data is given to you, probability. Past data is given to you. Yes, future data is given means probability is already there. For those who want to by heart, if you do logically, there is no need to do anything. Yes, sir, past data is given to me. That means I want probability. Yes, 5 years data is given. I want probability of every year. 1 divided by number of years, 1 divided by 5, 20% chance is there. Equal weight I will give. Yes, once I have given equal weight, yes, how do I calculate? Yes, expected returns. Yes, every year how much return I am getting, what is the probability? Summation P into X. That will be in the form of percent. Risk, I want a variance. Yes, I will take a deviation, x minus x bar. I will do a square to eliminate the signs. Yes, what is the probability of that happening? Summation x minus x bar the whole square into P. That is my variance. It will always be in the form of percentage square. Yes, you want a standard deviation, take a square root of that, you will be getting standard deviation. Okay, great. Yes, annual return is not given, how much dividend you are getting plus how much capital appreciation, divide by initial investment into 100. Now, if you want in the form of a format also, yes, x will be there, every year x you will put, probability P into x, you add, you will be getting your expected return, you will take a deviation x minus x bar, P into x minus x bar the whole square, this is going to be variance, take a square root, you will be getting standard deviation. Okay, so part 1 is over, giving you guys a 2-minute break to let the things settle in. Now till afternoon we'll ensure to do maximum concepts. After that, somewhere in the evening, okay, yes, we will quickly discuss adjustments of the questions. Okay, whatever adjustments are there, I'll quickly keep on telling you guys. Okay, yes, you guys can go back and practice it quickly. Okay, we'll take till great clarification. Okay, thank you dear. 2 minutes. YouTube live, Zoom live students, I hope concepts are clear, speed is fine, we will pick pace, no issues. Once your basics are clear, yes, advanced things will not be taking much time. Okay. We'll continue. Okay. What the, for 1 minute break you're seeing mobile and all. Huh? Portfolio off. What is happening? Red or green? Green? Okay. I don't see. It should not impact my class. Okay. Now we have calculated, we have seen expected return and risk of individual security. Only one security I am putting. But sir, we understood that we should not be investing in a single security alone. What we should be doing? Portfolio you should be building. So if you build a portfolio, what is the expected return of a portfolio? What is the risk of a portfolio? Okay, boss. Let me try understanding expected return of a portfolio. Then we'll understand the risk of a portfolio. Okay, expected return, it is nothing but the weighted average of returns. Okay, boss. Yes, investor is there. You are only there. What is your name? Da portfolio? What? Sibila. Not portfolio. Da your name? Da. Huh? Sibia. Sebi. Very bad joke, da. Okay. SEBI is there. Whatever I'll remember, I'll tell da. SEBI, CB, CBIL, whatever it is. Okay, now. Yes. SEBI is there. He's telling he's having 10 lakh rupees to invest. He has picked 3 shares. 40% of his amount he put in Tata. That means how much amount he put in Tata? 4 lakh he put. 30% he put in HUL, Hindustan. Okay, that means how much it is? 3 lakh rupees. 30% he put in TWT. What is TWT on earth, sir? Not listed on stock exchange. Assume I created my own company. Think with Tabish randomly. Okay, 30% he put on that. 3 lakh he put on that. Okay, sir, what is expected return, sir? He is telling Tata will give 15% return. Okay, HUL will give 18% return. Think with Tabish will give 30% return. Okay, great. Yes, standard deviation also individually has calculated. How to calculate individual returns risk? We know individually calculated, kept everything is ready. Now he is asking, sir, portfolio I have built. What is expected return of portfolio? What is the risk of a portfolio? Now simple. Let me see his portfolio as a whole, how much it will give him. Tell me how much he has put in Tata? 4 lakh. How much expected return he is expecting? 15%. So 4 lakh into 15%. How much it is? 60,000 he is expecting from Tata. How much he is put in HUL? 3 lakh. How much he is expecting? 18%. That means how much he is expecting? 54,000. Yes. How much he is put in TWT? 3 lakh. How much he is expecting? 30%. That means how much he is expecting? 90,000 return. That means total how much he is expecting? 60 plus 54 plus 90. 2 lakh 4,000 return he is expecting. Total he is expecting 2 lakh 4,000. Total how much amount he has put? 10 lakh. Yes, that means how much percent return he is expecting? 20.4%. Yes or no? Okay. Can I also do it like this? Can I also tell? Yes, in Tata how much he is expecting? 15% he is expecting. But how much percent money only he has put? 40% money only he has put into 0.4. Yes. In HUL, how much he is expecting? 18% he is expecting, but how much percent money only he has put, boss? He has put 30% only. Yes. In TWT, how much he is expecting? 30% he is expecting, boss. He has put how much money only? 30% only. So tell me 15 into 0.4 plus 18 into 0.3 plus 30 into 0.3. How much? 20.4%, whatever it is. Okay. This is the expected return of a portfolio. Simple. Yes. How much return I am getting? What is the amount we put? What is the weight? Yes or no? So weight of A, expected return of A. Weight of B, expected return of B. So on, which is nothing but summation of weight into expected returns. Is this clear? Okay, great. Yes, look at the formula. Expected return in a portfolio. Yes, every security, how much weight, how much percentage of my fund I have put, and in that how much return it is giving, which is nothing but summation of weight into the expected returns, where W will represent the weight, E is the expected return. Sir, how do we calculate expected return? Part 1 we have discussed that only now. Past data, future data, all those things. Okay, how do I calculate the weight? Tell me on what basis I have calculated the weight? Based on the amount we have invested. My returns I am calculating as a percentage of amount invested. So weight I will always be calculating based on the amount that I have invested. If weight is directly given in the question, okay, take it as it is, simple. Yes, weight is not given in the question. What is my weight? Weight is the amount invested. Or you can also take it is the opening market value in the year start. What is the total value? On that you are getting the return. Based on that you will be taking your weight. Okay, boss. If calculations are to be done for 2 or more years, weight will change every year based on the opening market value. Suppose simple 2 years are there. First year, yes, 2 securities were there. Assume security 1, security 2. Its value was, say for example 60, its value was 40, so 100 rupees. So here the weight is 0.6 and 0.4. By second year, yes, your value increased. Assume the total value now became 200. It became 150 as well as 50. Again you will be calculating your weight. You will tell it is okay, boss, 75%, it is 25%. Okay, yes. Now expected return. Okay, yes. 2 things I want: weight given in the question, great. Yes, not given in the question. It is my amount invested or opening market value. Expected return given in the question, great. Not given in the question, I know. Past data means average, total divided by number of years. Future data means, yes, every year into probability over, yes, expected return. Yes, I will be doing my weighted average. Okay, great. Yes, 2 examples are there. Quickly we will see. Okay. Yes, there is Mr. Sebi. Yes, Mr. Sebi has invested in 3 securities, A, B, C. Yes, expected return. He is expecting how much returns he is getting. Yes, how much shares he has invested. Yes, share A, 1000 share he purchased. Every share at what price he purchased? 100 rupees. Share B, 2000 share he purchased at what price? 200. Share C. I want the total return of the portfolio. Okay, great. So it is nothing but my weighted average. So step 1, I want to calculate the weights. Step 2, expected return. It is given to me. Weight into expected return gives me my weighted average. Okay, great. So look at this. So ABC, number of shares is given, market price is given. If I multiply 1000 shares I purchased at 100 rupees, total how much amount I have invested? 1 lakh. 2000 shares I purchased at 200 rupees, how much I invested? 4 lakh. 2000 shares I purchased at 250, how much I purchased? 5 lakh. That means total how much he has invested, boss? 10 lakh he has invested. Okay, great. So in that, share A is only 1 lakh. That means how much is the weight of that? 0.1, 10%. Okay, share B is 4 lakh. How much percentage is the weight? 0.4. Yes. C is 5 lakh. How much it is? 0.5. Weight I will always be showing in the form of decimals. Okay, great. Now, security A, how much returns I am expecting? 15, 20, 25. Yes, expected return. Yes, A 15% I am expecting, but I have put only 10% of my money in that, na? 1.5. B 20% I am expecting, I have put only 40% in that, na? 8. 25% I am expecting, how much I have put? 50% I have put, how much it is? 12.5. That means what is going to be the expected return total? 12.5 plus 8, 20.5, 22%. Okay, alternatively like this also you can do. Yes, look at this. 1 lakh you put on 1 lakh, how much percent you are expecting? 15%, that means 15,000. On 4 lakh, 20% you are expecting, that means 80,000. On 5 lakh, 25% you are expecting, that means 1 lakh 25,000. Total how much you are expecting? 125, 205, 2 lakh 20,000 return you are expecting on a total of 10 lakh. Again you will be getting 22%. Instead of doing this entire calculation, simple, yes, calculate the weight. Okay, into expected returns, do a summation of that, you will be getting the, yes, expected return of a portfolio. Yes, now look at this question. 2 years data is given. Okay, like this one question is there, beautiful question in the study material. Okay, how many shares I purchased? Okay, yes, at the time I invested, what was the market price? First year end, what became my market price? Second year end, what became my market price? Calculate expected return for 2 years. Okay, great. So yes, I will calculate expected return for first year also, I will calculate expected return for second year also. Dividend is also payable. First year how much dividend is payable, second year also how much dividend is payable, they have given. Okay, great. Now 3 different shares are there. Okay, slowly aram se one step at a time will do. Okay, share A. Yes, at the time I am purchasing, how much was the return? Sorry, what was the price? 100. First year end it became 120, second year end it became 160. First year 10 rupee dividend, second year 30 rupees dividend. Okay, so let me try calculating the returns here. Look at this. For A, at 100 I purchased, first year and it became 120. How much capital appreciation? 20. How much dividend? 10. That means 30 I got on how much? 100. That means 30%. Second year it was 120, boss. From 120 it became 160. That means how much I got? 40. Yes, how much it is? Dividend 30. So total 70 I got on 120. How much it is? 58.33%. Okay, great. Similarly, I should be doing for B also, for C also. Okay, oh, expected return I have not written here. Of gone case. To sit and calculate then. Okay, great. Okay, now for B, let me just to do it here quickly. A, B, C, year 1, year 2. Okay, for A, I guess I calculated 30% as well as 58.33%. Okay, for B, at the time of purchase it was 200. First year and it became 220. How much capital appreciation? 20. How much dividend? 20. That means total 40 I got on 200. 40 upon 200. How much it is? 20%. Yes. First year and it was 220. From there, second year and it became 250. That means 30 rupees plus 20. 50 I got on 220. 50 upon 220. How much it is? 22.73 percentage. Based on whatever numbers you are telling, I am doing. Yes, people who are watching online live, I don't know the numbers. God only knows. I am believing them. Okay. Security C, 250 it was, it became 260. 10 rupee only I got first year, but 30 rupees dividend I got. 10 plus 30, 40 I got on 250. On 250, 40 I got. How much? 16%. Yes, first year and 260 was there. It became 300. That means 40 rupees capital appreciation with that 10 rupees. Total 50 I got on 260. 50 we got on 260. How much? 23%. Assuming these numbers are right. Okay. Based on this, let us try calculating expected return of the portfolio. Okay, boss. So, first year I will calculate expected return. Second year also I will calculate. Okay. First year, how many shares were there? 1000, 2000, 2000. Okay. At what price we purchased initially? 100, 200, 250. 100, 200, 250. So, can I calculate the amount invested? Tell me 100 into 100. 1 lakh, 4 lakh, 5 lakh, 10 lakh, 10%, 40%, 50%. Expected return, yes, of each security we have done here. How much it is? 30, 20, 16. Assuming they are right. Okay. Yes. So understand. I am telling. Okay, boss. First year total portfolio, how much it is given. I will see, boss. First year how much investment was there. So I calculated the weights. So first year starting, how much amount was invested, based on that I calculated weight. Yes, every security, how much returns it is giving, expectation is there. Based on that, I will calculate the return of the portfolio. Can you guys do that? Yes, 30 into 0.1 is 8. This is, how much it is? 8, na? 8, 16, 19%. Yes or no? Okay, that is for first year. Now comes for the second year. Okay, it is weight into expected returns only. Expected return I know 58.33, 22.73, 22.73, 19.23. But when it comes to second year, my weight will change, because the first year I invested, that amount was there. But when I am coming for second year, na, yes, my investment base has changed, its value has changed. So based on that, my weight will also be changing. That's the only adjustment why we are doing this. Understand? Okay, boss. Second year stat. Look at this. 0th year was there, first year was there. First year when I am calculating returns, now here I have invested. So based on market price, here I am calculating return. Second year when I am calculating returns for the year, how much percent? Where? From here I am calculating. That means here what was the price? From there I want to see. Okay. So first year end or second year start, what was the market price? 120, 220, 260. 120, 220, 260. Based on this, okay, boss, 1000 share was there first year and it became 120. That means the value was 1,20,000. 2000 share was there. Number of shares did not change, but my price changed. It became 220. That means it became how much? 4,40,000. Yes, 2000 shares were there, but it became 260. That means 5.2 lakh. That means total is how much? 10,80,000. Yes, you will calculate the revised weight. Yes, 1,20,000 out of 10,80,000. 1.2 divided by 10.8, whatever is the weight, into expected return. Yes, 4.4 lakh divided by 10.8, whatever is the weight, into expected return. 5.2 divided by 10.8, whatever is the weight, into expected return. Do a summation, you will get the expected return of portfolio for the second year. Okay, va? Till here things are fine. Okay, great. So part 2 is also over, which is expected return of a portfolio. I hope things still here are fine, clear, no problem. So till now whatever we have discussed, quickly let us summarize. Okay, simple. I want you guys to have at least a book open with the pen. Portfolio can be open, don't worry. To scribble, not to study material. Study material you keep it aside. That you bring for bodybuilding only. Okay, don't worry. Yes, now we will scribble whatever we have written. Yes, understood till now. Firstly, yes, why am I creating a portfolio? to reduce my risk. How my risk will be reduced? By creating a portfolio based on the correlation between the stocks. Okay, first for my individual securities, let me calculate returns as well as risk. I want you guys to scribble down quickly. Yes, online students as well, scribble as much as possible. Once you have understood logically, now the only thing that you'll have to do is scribble, keep scribbling. Your mind will automatically start giving you guys the formulas. That's the only way for us to do it. Okay, boss. Yes, for my individual securities, I want to calculate expected return. It is nothing but the average return. How do I get the formula? Yes, it is summation x divided by n. Risk, how do I calculate risk? In terms of variance. Yes, I will calculate my deviation x minus x bar. I will do the whole square. I will do the total of that. But boss, I want the average divided by n. Summation x minus x bar the whole square divided by n. Yes, this is not interpretable, boss. Standardized for square root of variance. Okay. Yes, this is for yes x post data, post mortem analysis, past data. For future data, probability is given, boss. How do you do? Yes, every year how much return you will get? Yes, what is the return you may get? What is the probability of that? Summation p into x. Risk x minus x bar the whole square. What is expectation? Into probability. Summation p into x minus x bar the whole square. Cannot interpret. Do a square root of that. Okay, and how do you calculate the individual returns of a security, expected returns of a security? If data is not directly given, how much dividend I am getting? D plus how much capital appreciation? P1 minus P0 divided by how much amount you invested? P0 into 100. Yes, this was part 1. Based on that, part 2 was expected return of a portfolio. What is the expected return of a portfolio? It is nothing but my weighted average return. That is weight of A, return of A plus weight of B, return of B plus so on. Summation of weight into expected returns. Now, how do you calculate weight? Given in the question, great, jingalala. Not given in the question. Weight is calculated based on the amount invested or opening market value. If 2-year data is given, means for first year opening market value, based on that you will be calculating. For second year opening market value, or first year closing market value, based on that you will be calculating. Expected return given in the question, great. Not given in the question, I know how to do. Past data summation x by n, future data summation p into x. Till here, okay, great. Yes, now we are going further. Okay, this is there. Okay, yes, day and revision time we will use this. Yes, now comes the most important thing, risk of a portfolio. Okay, we'll be spending a good amount of time here. We'll have to understand the covariance, correlation, how does it reduce the risk, how it gets reduced. Yes, based on that we'll understand. Yes, once we reduce a substantial portion, chunk is understanding this. Okay, once this is done, after that things will flow comparatively faster. Okay, risk of a portfolio. Now, yes, understand risk of a portfolio depends on 3 different factors. First is the weight risk of individual security. Yes, one security I have selected, very risky. Whether my overall portfolio risk will also be more? Yes, very risky security I have selected. Second is the weight of the individual security. How much percentage you have put? Yes, one very risky security you took, but you put only 5% money in that. Your overall impact will be less. Weight. With that, there is one more hero coming into picture, which is the correlation between the 2 securities. How they are moving together. Yes, is it cutting my risk? It is not cutting my risk. Let us try understanding this. Okay, simple. SEBI is there. Okay, yes, SEBI has 10 lakh rupees to invest. He is telling 2 shares. Tata, think with Tabish, 6 lakh rupees, 4 lakh rupees. That means the proportion weight is 60%, 40%. Okay, how much return he is expecting? 15%, 25%. Okay, great. Yes, individually he calculated risk. Individually for every security, can I calculate risk? Okay, boss, I know. Summation x minus x bar the whole square divided by n. Okay, great. For Tata, 10% risk, up or down may happen. Yes, for second security, 15% up or down may happen. Okay, great. Now, I want to calculate expected return of the portfolio. His portfolio is there. Overall portfolio, how much return it is giving? Simple, boss. Tata is giving 15%. How much chance is there? 60% chance is there. Yes. Second security is giving 25%. How much chance is there? Sorry, how much amount we have invested? 40% we have invested. That means what is going to be my expected return? Weight of A into return of A. plus weight of B into return of B. Tell me how much it is. 15 into 6.6, 9 plus 10, 19%. Yes or no? Da? Okay, great, 19%. On same premises, let me calculate the risk also. Tell me, in Tata, how much risk is there? 10% risk is there, but how much money only we put? 60% only I put. So 0.6 into 10, which is 6. Plus, on Think with Abish, how much risk is there? 15% is there, but how much only I have put? 40% only I have put. So 15 fours are 6. So that means my overall risk of the portfolio is 12%. Simple. Jujibi. Yes or no? Yes or no? Yes or no? If it was here, chapter is over today. Finish. Now only over. Nothing else is there. Weighted average. Because it is not this, the game starts from here. Okay? Yes. The risk is not this. If risk was this much only, no need for chapter only. Go home. Anyone can do. Okay. Now, return of a portfolio is impacted only by two factors. Yes, how much return every security is giving, what is the weight, how much amount you invested. But for risk, I told when I am creating a portfolio, my third factor will come into play. My correlation will help me to reduce my risk. So that is the total risk. But net, when I create a portfolio, net how much risk I am getting, correlation is going to impact. So three factors are impacting the risk of a portfolio. First is every security, how much risk it is having. A security is a high, very risky. Your overall portfolio risk will also increase. Yes, then how much weight you have invested in every security. Yes, one very risky security you took, but you put only 1%. Its impact will be very less only. Third is going to be the correlation. So before we understand risk of a portfolio, you have to understand what exactly on earth is correlation. Okay, how each one of these are impacting. Okay, let us now go to correlation between securities. Okay, simple. What does a correlation mean? Correlation means how two securities are going. Yes, simple, understand. One security is increasing, other security is also increasing. That means what kind of relationship it is? It is a positive relationship, positive correlation. One is increasing, other is decreasing. What kind of relationship it is? Negative, negative correlation. One is increasing, decreasing, whatever it is dancing, other is not moving only. Zero correlation, no relationship only. Yes or no? He is smiling, she is also smiling, positive. He is smiling, she is angry, negative. He is smiling, crying, dancing, emotionless. Zero correlation. Okay, now let us try understanding. Okay, same simple. Three businesses are there. Okay, investor has come to me, SEBI has come to us. Okay, one, he can start a ice cream parlor. Okay, yes, if it is summer, 30% return it will give. If it is rainy, nobody will come, 0%. Yes, or sugarcane business, again in summer it will run. These are all just stories. Okay, summer means it will give 30%, rainy means it will not give anything. Or umbrella, umbrella shop you can open. Okay, yes, if it is summer, nobody will use umbrella. Yes, except for couples, God knows why. Yes, but if it is rainy, people will use umbrella because it is rainy. Okay, great. Okay, now assume only two seasons are there. There is an equal likelihood that it can be summer also, rainy also. Now understand what all can happen. Yes, first possibility is I tell full money SEBI is putting only in one business. He is telling he likes ice cream business. He puts his full money in ice cream business only. Okay, great. Assume 100 rupees is there with him. He puts 100 rupees in ice cream business. Tell me, if it is summer, whether people will come to have ice cream? Yes, they will come. How much return it will give me? 30% return it will give, 30 rupees. But tell me, if it is rainy season, whether people will come? Nobody is coming. He is only sitting there. Yes or no? Couples are also not coming. There is no time pass also. Yes, there are two advantages in ice cream business. First is you can sell ice cream. Second is you can see how couples are behaving. Okay. Yes, rainy season, nobody is there. Return is 0. Whether risk is there? Yes, boss, risk is there. Yes or no? Yes. Why? Either it will give me return or it will not give me return. Okay. Second, we create a portfolio. Creating a portfolio will reduce my risk for me. Okay. Yes. Which all two businesses he chose? He chose 50 rupees. He'll put. Which all business? Yes. He tells ice cream business. He'll put 50 rupees. Sugarcane business. He'll put 50 rupees. Tell me, when will ice cream work? Summer. When will sugarcane also work? Summer. So tell me, if it is a summer, ice cream business he has put 50 rupees. It gives him 30% return. 15 rupees. Sugarcane also 50 rupees he has put, 30% return, it will give 15 rupees return. That means overall how much return he is getting? 30 rupees. But tell me, if it is rainy season, whether people will come to purchase ice cream? People are coming to drink sugarcane also. Return is there. Whether risk has reduced here? Same thing is there. Because both shares are moving same direction. Summer means both are giving profit. Rainy means both are not giving me profit. My risk has not reduced only. But, yes, if you invest in securities which are moving in the opposite directions, say ice cream and umbrella, 50-50. Yes. Tell me, if it is a summer, ice cream will work. Yes, it will give me 50 rupees, 30% return, 15 rupees. Whether people will buy umbrella? No, boss, nobody is coming. 15 rupees return is there. Assume it is raining. Everyone went purchased what? Umbrella. It gave me 30% return, 15 to 30%, 15. People are having ice cream. No, boss, rainy season. Tell me. Here, whatever be the situation, how much return I am getting? 15 rupees return I am getting. Yes or no? Whether risk is there? Risk has been reduced. Tell me individually whether ice cream business has a risk. It has a risk. If it is rainy season, people will not come. Individually, whether umbrella business has a risk, it has a risk. If it is summer, no one will use. But when I create a portfolio, whether the risk is reduced? Yes, the risk is reduced because both the securities are moving in the opposite direction. That relationship is called as correlation. What is correlation? Simple. It is a relationship between two securities, two people relationship. That is my correlation. Both are moving in the same direction, positive. Both are moving in the opposite direction, negative. Yes, one is moving, jumping, playing, one is not playing only. Zero. As simple as that. Okay. Yes, moral of the story. Relationship. Very important in life. SEBI. Yes, positive correlation. Stocks are moving in the same direction. X is increasing, Y is increasing. X is decreasing, Y is decreasing. Positive. Negative. Both are moving in the opposite direction. One is increasing, other is decreasing. One is decreasing, other is increasing. Yes. When will risk reduction happen? Yes, if both securities are moving in the same direction, whether risk will reduce? No, boss, risk will not be reducing. But securities are moving in the opposite direction. Yes, my risk will be reducing. Risk reduction will happen due to negative correlation between the stocks. Okay, till here things are fine. Okay, great. Look at this type of relationship, positive or correlation, a simple. Yes, ice cream and sugarcane business means, okay, if ice cream gives me 10%, sugarcane is giving me 15%. Ice cream gives me 12%, sugarcane is giving me 18%. Tell me, in ice cream I get 2% extra. Ice cream is increasing, sugarcane is also increasing. One is increasing, other is increasing. What kind of relationship? Positive relationship. Okay, ice cream reduced from 12 to 9. Sugarcane also reduced from 18 to 4. One is reducing, other is also reducing. Both are moving in the same direction. What kind of relationship? Positive correlation. Okay. Second, ice cream umbrella. Yes, if it is giving 10 means it is giving 20. It increased from 10 to 15. One is increasing. It reduced from 20 to 12. One is increasing, one is reducing. What kind of relationship? Negative. 15 to 8, it reduced. 12 to 22, it increased. Negative. One is increasing, other is decreasing. This is negative. Both are moving in the same direction means it is going to be positive. Okay. Practical examples in real life. Okay, for correlation. Suppose automobile industry and bank, they are normally having a positive correlation. Understand? Yes, Tata is there. More people are buying cars from Tata. Tata's return has increased. Now tell me how people will normally be buying vehicles? By taking a loan. More people will take loan. This return is also increasing. Both are moving in the same direction, positive correlation. People are not buying car only. Nobody wants car. People will chumma go and take car loan. Their returns will also reduce. Positive correlation, same direction. Yes, car manufacturer and its component manufacturer. Yes, Tata is there, MRF is there. More car is selling, more tire is selling. Both are moving in the same direction. Car is only not selling. What will do with tire? Yes or no? Yes. Same direction they are moving. Okay, positive correlation. Now, pharma and automobile, they are normally having a negative correlation. Assume economy is doing great. People are having no problem in life. Yes, loan is also available. No health problem. Nothing is there. People will go. They will buy car. Yes, car manufacturing is giving me good returns, but pharma is giving me okay. Suddenly, yes, global pandemic happened. COVID came. The day COVID comes. Yes, next day only SEBI went, he purchased Tata Motors. I want to purchase the latest car. Will you do? You will not do. Yes, economy is falling down. First, your auto industry will be impacted. Their returns will reduce. But pharma, your defensive sectors, their returns will go up. Negative correlation. Okay. So, next, motor vehicles as well as essential items. Say for example, Hindustan Unilever. Yes, he is buying Lux soap. Yes, SEBI's favorite soap, Lux. Yes, the reason for his beautiful soft skin. Okay, now tell me, economy is booming. People are having crazy amount of money. They will buy more car, people will start buying car. Yes, car is giving me more return. Yes, tell me, just because economy is giving me more return, whether he will go 10 times, yes, instead of buying one soap, he will purchase 10 soap, 10 times he will take bath in a day. It's going to be same only. Yes, economy is completely gone, boss. Full global pandemic. Yes, whether it will a pandemic, boss. I will not use soap only, just with water I will take a shower. Yes, essentially it does not matter. It will keep running. As simple as that. Okay, there is zero correlation, no correlation. Just a feel of that. Okay, great. Simple example, yes, one more example, boyfriend, girlfriend. Assume Sebi got into a relationship. Yes, the start of the relationship. Girlfriend is happy, Sebi is also happy. Why Sebi is happy? Because girlfriend is happy. Yes, she is happy, he is happy. She is sad. What kind of relationship? Positive correlation. Yes, after 3 years. Yes, she is happy, she is smiling. Yes, she is crying, she is angry. My boss scolded on me. Yes, at least somebody is there in the world who can get angry on me. Negative correlation. Yes or no? Yes. Okay. Now, from here, yes, we've understood what is correlation. Calculation part will come. Yes, what is a correlation? How two stocks are moving in relation to each other. Both are moving in the same direction means positive, opposite direction means negative. Yes, irrespective of whatever is change, one is not moving only. That means zero correlation. Okay, great. Now let us try understanding the concept of covariance. Correlation calculation will come back. Overall idea we've got. Covariance will come. Yes, all these. Why am I understanding correlation, covariance? I have a portfolio. I want to calculate the risk of a portfolio. For that purpose, we are doing. Okay, online students, I hope you guys are with me. Understanding things are clear. Okay, great. Understanding of covariance. Yes. When we create a portfolio, yes, when we create a portfolio, what will happen? My risk will reduce. Why? Because of diversification. Okay. Yes, covariance will explain me, yes, whether my risk has reduced or not, and to what extent my risk has reduced. Let us try understanding. Covariance. Covariance. Yes, variance is a deviation. Risk. Joint risk. Two things together because I am creating a portfolio. Okay. Sebi is there. He is telling two different businesses starting. One is ice cream, one is sugarcane. Okay. Yes, simple. Yes, extreme examples we are taking just so that we get the feel of that. Okay. Both will work only in summer. Okay. Look at this. Here you should, just by looking at this, you have to see and tell whether my risk will reduce or not. Okay. Yes. Ice cream business returns is given, sugarcane returns are given. Okay, great. Now individually, yes, I will calculate the expected return of each. Yes, ice cream business 10 also it can give, 15 also it can give, 20 also it can give, 5 also it can give, 3 also it can give. Total is 53. That means on an average expectation for every year is 53 divided by 5. How much it is? 10.6%. Okay, great. Sugarcane 15 also it can give, 22.5 also it can give, 30 also it can give, 7.5 also it can give, 4.5 also it can give. Total is 79.5. Average 15.9%. But whether risk is there? Risk is there, boss. Simple. Yes, I am expecting 10.6 in that. Yes, if I get 10 only, that means 0.6% less. If I get 15, I am expecting how much? 10.6. That means 4.4 extra. Here 9.4 extra. Here minus 5.6. Here minus 7.6. Okay. Yes, I will do a square. Okay. Summation of that is 197.2. Yes, I want to calculate my risk. Risk is always a variance. Yes, individually I have calculated. Take the average of that 197.5. Sorry, 197.2 divided by 5. How much it is? 39.44% square. I cannot interpret. I will, yes, take a square root of that, 6.28%. So if I invest in ice cream business, I am expecting 10.6% returns, but risk is there, 6.28%, up or down may happen. Okay, great, boss. Yes, if I invest in sugarcane business, yes, my expectation is how much? 15.9%. Tell me, 15 minus 15.9 is minus 0.9. 22.5 minus 15.9. How much it is? 6.630 minus 15.9. 14.1. 7.5 minus 15.9. 8.4. Yeah, 4.5 minus 15.9 is minus 11.4. Till here things are okay, clear, fine. Okay, I will take a square of that. I will be getting 443.7 percentage square. I want variance divided by 5, average of that. How much you are getting? 443.7 divided by 5. How much? 88 point percentage square. Take a square root of that. 9.42019 percentage. Okay, great. Now understand what is covariance. It is the joint deviation. Now understand total what is happening, whether my risk is reducing or not. First let me just get a feel, then we'll get into the calculation. Look at this. X was giving me 10%, now it gave me 15%. It gave me 5% extra. Great. Yes, X is increasing. Yes, Y also is increasing. Okay, okay. Now X is again increasing, Y is again increasing. X is decreasing. Tell me what is happening to Y? Y is also decreasing. Yes, X is again decreasing, Y is again. Tell me what kind of relationship is there? Positive relationship. One is increasing, other is also increasing. One is increasing, other is also increasing. One is decreasing, other is also decreasing. One is decreasing, other is also decreasing. So that means if I create a bundle, a portfolio, what will be the risk? Now understand. First year, let me see what is happening. Yes, first year I invest in both the companies, X and Y. Tell me, my expectation in X was I will get 10.6, but I got 10 only. That means how much less I got here? 0.6 less I got here. Yes. Second business, how much less I got? 0.9 less I got here. That means what is my joint deviation? I will tell, yes, it is a risk of X into risk of Y. Yes or no? Look at this simple point. Yes, covariance. Yes, two stocks are there. Yes, I want to know how stock X is varying. I want to know the deviation of X. It is X minus X bar. I want to know how Y is varying. Y minus Y bar. Now I want to know how both are varying together in a portfolio. It is X minus X bar into Y minus Y bar. Is this clear? So my covariance here I am calculating the joint deviation. How both are varying. How X is varying, with that how Y is varying. It's total I am saying. Okay, and I will be doing a multiplication. Yes, again, yes, how X is varying from average into how Y is varying from average gives me total how Y is total it is varying. Yes, again, why am I doing a multiplication? Again, just a very simple point. If I am telling, yes, it's the probability, basics of probability. Suppose I am telling, yes, I have a dice, I throw a dice, chance of getting a 6. Total 6 things can happen. Yes, it is 1 by 6. Yes, I throw a dice 2 times. I am telling, I want a 6 either in the first one or in the second one. That is also okay, this is also okay. So tell me, first time I throw a dice, what is the chance of getting 6? 1 by 6. First time I did not get. Second time I threw. What is the chance of getting a 6? 1 by 6. That means total what is the probability of getting a 6? 2 by 6. When I am having either or, I will do a plus. When I am having and, first time also I want 6. Second time also I want 6. Tell me whether the chance is more or chance is less. Yes. First time chance of getting 6, 1 by 6. Second time again I am getting 6 only. By 6, 1 by 36. Yes, when I am having and, I will do a multiplication. Okay, simple. When I am having a and, I am doing multiplication. How X is varying from its average and how Y is varying from its average. X minus X bar and into Y minus Y bar. Okay, great. Now let me come to this. Yes, let us just get a feel of this. Tell me. Yes, when X is giving me 0.6% less, Y is also giving me 0.9% less. That means total how much it is? 0.96 or 54. Yes, minus into minus becomes plus. Here this minus or plus is telling me whether my risk has reduced or not. Here tell me whether my risk has reduced. No boss, my yes symbol is plus, because this is also falling, this is also falling. My risk has not reduced, boss. Yes, here this is giving me 4.4 extra. This is giving me 6.6 extra. Tell me, one is increasing, other is also increasing. Whether my risk has reduced? No, boss, it has not reduced. Symbol is plus. How much is 4.4 into 6.6 is 29.04. Yes, 9.4 into 14. How much it is? 131.6 minus 5.6 minus 8.4. Both are reducing. Whether my risk has reduced? No, boss. Minus into minus becomes a plus. How much it is? 47.04. 4 minus 7.6 into minus 11.4. How much? 6, 4. Okay. So I've calculated the joint deviation. So in my first year, the joint risk is 0.54. Now understand one simple point. How is my covariance denoted? Yes, x minus x bar is in terms of percentage. 10% minus whatever, 10.6% minus 0.6%. This is also percent. So x minus x bar into y minus y bar. Percent into percent will become what? Percent square. Okay, so covariance is always x minus x bar into y minus y bar, both percent. It is always in terms of percentage square. Okay, I will add this. How much it is coming? Can you just add and tell me? How much? 290 point percent square. Yes, that is for every year I calculated. What I want? I want the average net deviation. That means I will be doing divided by n. Yes or no? So covariance xy, simple covariance, joint deviation of x as well as y. So first I will take the deviation of x minus x bar. I also want the deviation of y minus y bar. I want the joint into. For every year I did, yes, I will do a summation. I will get the total. But boss, I want the average divided by n. Will be giving me my covariance xy. Is this clear? Okay, great. Now covariance xy is telling me that, okay boss, yes, if I create a portfolio, yes, the net deviation of a portfolio is going to be 294.86% square. Okay, great. This is okay ba? Okay, so what is the formula of covariance xy? Covariance, joint deviation, x minus x bar into y minus y bar. Take a summation, you will get the total. I want average boss, divided by n. Okay, now tell me a very simple point. I will not, yes, use another example for this again. Yes, future data is given, probability is given. Yes, first I will take how x is moving from its average into how y is moving from its average. Yes, now into what is the probability of that happening? Summation p into x minus x bar into y minus y bar. Till here story is over. Okay, joint deviation, how they are moving. Okay, great. Okay, 0.54% square. Formula we have done, correlation we will come back to it. Y. Okay, yes, second story also we will try. Look at this. Yes, YouTube live students, I hope audio video is clear, speed is okay, understanding, manasilayo. Yes, in Tamil what do you say? Purinjidcha, what? Yes, whatever. Gottaita in Kannada. Okay. Sebi, Paka, portfolio, green. Yes. Now, Sebi is telling, yes, sir, other business will invest. Ice cream and umbrella will invest. Okay. Yes. Now understand, look at this. Yes, just get a feel of this. Now, if ice cream is giving 10 means umbrella is giving 30. One is not performing, one is performing. Yes, ice cream is performing, this is not performing. Yes, one is giving okay, this is giving more, this is giving more, this is giving me less. Okay, great. Okay. Now look at this. First I will calculate, yes, expected return of x. Tell me x bar 10, 30, 40, 55, 60, 80. That means is it 20%? Yes. For y also 80. Yes, that means 20%. Yes, let me take the risk deviation. Yes, ice cream business, I am expecting 20. I got 10 only. 10 less I got. 30 I got. 10 more. 15 I got. 5 less I got. Yes, 25 I got. 5 more I got. Yes or no? Yes, take the square of that. 100, 100, 25, 25. This is going to be 250% square. Yes, that means that is the total. I want to average. It is summation x minus x bar the whole square divided by n. 250 by 4 gives me 62.5% square. I cannot interpret. Take a square root of that. 7.9057%. Okay. Same story is coming here. Y also 20% I am expecting. I got 30 boss. 10 more I got. I got 10 only boss. 10 less I got 25 boss. 5 more I got. I got 15 only boss. 5 less I got. Yes, take a square of that. 100, 100, 25, 25, 250, 250 by 4, 62.5 percentage square. Yes, take a square root of that. 7.9057. Now let me try taking a covariance. When these both come together, what is happening? Just let us try getting a feel whether risk is reducing or not. Based on that, let me see. Now look at this. When X is increasing, Y is decreasing. That means when one is not performing, other is giving me more, it is getting compensated. Negative correlation, whether risk is reduced. When X is reducing, not performing, this is increasing overall. Okay, boss, my risk has reduced. This is increasing, this is doing good, this is falling. Negative relationship. That means whether my risk will get reduced. Yes, boss, it will get reduced. Look at this, risk of X. Whether ice cream business risk is there, boss, risk is there. If it is 10, it will give 10% less. But in that case, this will give 10% more. Yes, so overall my net risk, yes, minus 10 into 10, it is minus 100. 10 into 10, 100 gives me the net deviation. The sign plus minus tells me, yes, is it in a position to reduce my risk or not? If it is plus, means it has not reduced substantially. If it is minus, means it is reducing substantially. Okay, similarly, yes, 10 into minus 10 will be minus 100. Yes, minus 5 into 5 will be minus 25. 5 into minus 5 will be minus 25. It is going to be minus 250. That is individual years. I have done a summation. I want to average. Yes, covariance XY. Yes, risk of X, risk of Y, summation total. I want average divided by N. Great. So it is minus 250% square divided by N, which is minus 62.5% square. Okay, great. So understand. Yes, whether risk has reduced or not. Yes, if my covariance is positive only, means it has not reduced the risk substantially. If it is a negative, means a good risk reduction is there. Okay, great. Till here things are okay. Yes, fine. Yes, now let me just quickly scribble down. I want you guys also to scribble. Yes, whatever we have discussed till now. Look at this, everyone. Yes, let us keep compiling, keep bringing them together. Yes, past data is there, future data is there. Yes, past data is there, everything I will do divided by N. Future data is there, everywhere I will be doing into P. Okay, great. Firstly, expected return of a security. Past data is given. Yes, summation X total I will do divided by N. Risk is always variance. So it is X minus X bar deviation. The whole square, eliminate signs, do a summation. Every years I got, total I got, I want average divided by N. Yes, my standard deviation is going to be square root of variance, any case. Now, covariance XY, risk of X, X minus X bar, risk of Y, Y minus Y bar. I want the total risk of X minus X bar, Y minus summation. I want the average of that divided by N. Great. Okay. Now, future data is given, means into P I will be doing. Obviously, every year written is there into probability, summation P into X. Yes, variance X minus X bar the whole square into expectation of everything happening, probability. Okay, then covariance XY is also X minus X bar, Y minus Y bar. What is the chance this can happen into P? Take a summation of that. Okay, till here things are okay. Yes, now along with that, yes, if return value is not given to me, yes, what all I will be getting? Dividend I will be getting plus capital appreciation whole divided by initial investment into 100. Till here things we have discussed. Along with that, one more extra thing we had discussed till now was expected return of a portfolio. It is nothing but the weighted average return, summation of weight into expected return. Yes, weight is given, great. Weight is not given, yes, on what amount I am getting the return? It is my amount invested or opening market value. Multiple years is there, every year's opening market value will be taken. Expected return given is given, not given is I have known how to do it. Till here things are fine. Great. Yes, giving you guys just 1 to 2 minutes to let the things settle in. Next we will be going into calculation of correlation. Okay. YouTube live students, I hope speed is fine, explanation is okay. Obviously, if you have not heard at all, then obviously it will be a bit fast. Girlfriend, Ada? He didn't come. His portfolio is red, Speed can be a little less, I should reduce or I should increase? Shadow gaming. Okay, we will continue our discussion. Okay. Okay, yes. Now comes our hero. Yes, why did we start this discussion of correlation? Yes, I wanted to calculate a risk of a portfolio. Three factors are there. One is how much weight I am investing in every security, that we know. Then I want to know the individual risk of every security, that also I know. But now I want to know when they both come together, whether risk reduction is happening or not. If so, to what extent? Correlation. So for that I came into calculation of correlation. Before understanding correlation, I calculated the net joint deviation, the net risk, covariance I calculated. Now based on that, okay, calculation of correlation. Now simple, yes, story I'll tell. Yes, assume SEBI is there. SEBI gave AFM mock examination. He scored 25 marks. Good da, bad da? Bad. Good da, bad da? Bad, wrong. It depends on how much marks he has given his examination. Suppose he got 25 out of 100. Dumki. He got 25 out of 30. He got 25 out of 25. Error level. Yes or no? So, yes, I want to calculate it as a relative number, as a percentage. Suppose I am telling he scored 25 out of 30. That means how much percent marks he has scored, how much percent he has scored. 25 by 30, how much you are getting? 83.8333. If I have to create a formula out of this, this is my marks scored or net marks scored divided by total marks. Yes or no? Similarly, suppose yes, 5 different cases are there. Yes, a student scored 120 out of 200. How much it is? Net marks scored 120 out of 200. It is 0.6, 60%. Yes, 180 out of, randomly assume 600. So 180 out of 600, 0.3, 30%, so on and so forth. Okay, great. Yes, net marks score divided by total marks. Now I want to see the correlation. When I create a portfolio, whether risk will reduce, whether risk will reduce. What is the net risk on the total risk? That tells to what extent my risk has reduced and whether it has reduced or not. So the way I told, net marks scored divided by total marks. Similarly, net risk after diversification, net how much risk is there divided by, if diversification was not there, total what was my risk. That tells me to what extent my risk has reduced. Correlation. Let us just try getting a feel. Okay, look at this, look at this, look at this. Okay, first story. Let us come back to, yes, two stories. Yes, one is of positive correlation, one is of negative correlation. Okay, first business was he is investing in ice cream and sugarcane. Summer season means both are giving. Winter season means both are not giving me performance. Yes, whether risk will reduce, not great. Okay, now look at this, look at this, look at this. Tell me, yes, whether sugarcane business is having a risk. Yes, sir, it is having a risk. How much risk is there? 6.28% risk is there. Yes, whether ice cream business is also having a risk. Yes, sir, 9.42% risk is there. That means what is the total risk? What is the total risk? It is a risk of X into risk of Y. So tell me, this can be 6.28 plus or minus. This can also be 9.422019. That means how much you are getting? 58.59. What is this? The calculation, God. 6.28 into 9.42019. 59 point. Yes. Ideally, individually I am investing separately. Yes, X is having 6.28%, this is having 9.42%. That means total risk should have been 59.16%. Now tell me, when I create a portfolio and I calculate my covariance, how much covariance I got? I did not write somewhere I scribbled. Okay, tell me covariance. 294.86 divided by 1, 2, 3, 4, 5. Covariance xy. My net risk is also how much? 294.86 divided by 5. How much? How much da? 58.97. Okay, fine, great. Okay, so this also comes somewhere around the same range only. That means understand. Yes, my total risk was 59.16. When I invest in a portfolio, yes, the net risk that I am getting, that is also somewhere around 58.97 only. That means whether my risk has reduced, very less risk reduction has happened. Yes or no? Now based on this, let me try creating the formula. Correlation. Yes, correlation is just telling me after investing in a portfolio, my net risk is how much percent of total risk. That is my net risk divided by my total risk. Net risk after diversification, when I create a portfolio, my net risk will be reduced. My covariance will be showing me the net risk divided by total risk. If I had invested separately, sigma x into sigma. Is this clear? Getting a feel of what exactly my correlation is trying to tell? Yes or no? Okay, great. So I am telling, look at this. Yes, if I invest, yes, separately in x 6.28%, separately in y 9.42%, that means total risk, yes, would have been some 59%. If I create a portfolio also, my risk is how much only? 59% only my risk is there. That means whether my risk has reduced by creating portfolio? No, boss, because both are moving in the same direction. Yes, and now look at this. Yes, the second story when I am having. Okay, yes, when I create a business having ice cream as well as umbrella, tell me whether ice cream business risk is there? Sir, risk is there. 7.9% up or less can happen. Yes, whether umbrella business also risk is there? Sir. That means ideally my total risk should have been, yes, total risk should have been sigma x into sigma y. How much? 7.9057 into 7.9057. 62.5% square. But tell, when I create a portfolio, the net risk became minus 250 divided by 1, 2, 3, 4, 4 minus 62.5% square. That means, yes, their total risk was 62.5%, but from there it reduced by 62.5% square. Yes, that means my net risk is how much? Minus 62.5% square. That means my net risk as a percentage of total risk, yes, minus 62.5 divided by 62.5 is minus 1. Is this clear, everyone? So what is my correlation formula trying to tell me? Simple, there is absolutely no need to by heart and keep it simple, just the feel. Yes, correlation is telling me, yes, that my net risk is how much as a percentage of total risk. Yes, my total risk, individually my risk, yes, x is also having risk, y is also having risk, that is my total risk. But when I create a portfolio, what is the net risk? Covariance x. Therefore my correlation is nothing but covariance xy divided by sigma x into sigma y. Okay, till here things are fine. Great. Okay, fine. Okay, now till now what all formulas we have discussed? Quickly. Yes, we will keep on. Yes, the reason I am writing it again and again, it is not for me, it is for you guys. I want you guys, once you have understood logically, to scribble, keep scribbling till the time, even without thinking, your mind should tell, okay, this is a formula. There are two things, one is your mental memory, one is your muscle memory. The more you repeat, your muscle memory becomes faster. It will help you to do things in a much more faster way. Okay, online, people are watching it online as well. Every time I'm telling let us scribble, I want you guys to write it down. Okay, from a scratch, from a zero. Why am I creating a portfolio? To reduce risk. How my risk will be reduced? Based on the correlation between the securities. Okay, individually for every security, let me try calculating the returns. Okay, so firstly, based on past data, based on future data, I want you guys to scribble quickly. Yes, firstly, expected return x bar, it is the average, it is summation x divided by n. Risk, how will I be getting my risk? In the form of variance. First, I will calculate the deviation, x minus x bar. I will do a square of that to eliminate the signs. Then I will take a total of that, summation x minus x bar the whole square. You want average, boss, divided by. Yes, my standard deviation is always going to be square root of variance. Okay, boss. Past data is not given, future data is given. Okay. Yes, probability. Here I was doing divided by n, here I am doing into p everywhere. Yes, every year how much return I am getting, what is the probability of that? Summation p into x. Okay, risk in terms of variance. Yes, it is x minus x bar the whole square into p. Summation p into x minus x bar the whole square. Okay. Yes, the next thing that we had discussed was for past as well as future data was covariance, joint deviation, net deviation, because I created a portfolio. Yes, it is risk of x, x minus x bar into risk of y, y minus y bar. Yes, I will do a summation total. I want on an average how much it is divided by n. Probability is given means yes, p into x minus x bar into y minus y bar. Do a summation of that. Great. Okay. Yes, with that, the next thing, the final thing that we have told is correlation. Yes, correlation. How two stocks are moving in relation to each other. Both are, yes, moving in the same direction, positive. Both are moving in the different direction, means negative. Yes, one is not moving only, means it is going to be 0. Now, how do I calculate this? Yes, simple, just to get the feel of that. Yes, what is the net risk on the total risk? How much is the net marks on the total marks? That percentage, that is my correlation. Tell me, when I am telling net risk, because I created a portfolio, that is nothing but the covariance xy divided by total risk. It is sigma x into sigma y. Is this clear, everyone? Yes, my correlation is always given as a number. Okay, 1 minus 1 minus 0.5, and it will be ranging from -1 to +1. It cannot go beyond that. Okay, yes, my net risk can never go beyond my total risk. 100 marks exam, you got 120, possible or not possible? So the maximum it is that. Okay, great. So let us quickly have a look at the theory part, whatever things, yes, we have to read quickly. Portfolio variance. Okay, yes, understanding the correlation. Quickly, let's finish it off. Yes, correlation. What does correlation means? It is a relation, how they are moving in relation to each other. Positive means same direction, negative means opposite direction. It is a numerical value between -1 and +1. Because understand this simple point, students. Net risk divided by total risk. Yes or no? It is covariance xy divided by sigma x into sigma y. Tell me, my covariance is in terms of percentage square. Suppose randomly I am telling 10% square. Sigma, yes, standard deviation is in terms of percent. Suppose randomly assume 5% into 10%, randomly assume. Okay, percentage square gets nullified. What will be left is just a numerical value. It is just telling my net risk is how much percentage of total risk, just as a yes number it is telling. Okay, great, boss. Yes, ideal scenario, yes, I want securities having negative correlation so that my risk gets reduced. Yes, if my R is equal to +1, both are moving exactly in the same direction, whether my risk can be reduced? No, boss, it cannot be reduced. R is equal to -1. Yes, if you want, you can bring down your risk to 0. Yes, R is any other value in between, means risk will reduce, but to what extent it will reduce, that depends on my R. Okay, great. Now, types of correlation, just for us to understand, get the feel, look at this. Yes, perfect positive correlation. R is going to be between -1 and +1. +1 could be there, -1 could be there, 0 could be there, positive could be there, negative could be there. Now, what it exactly tells me, understand. Yes, perfect positive correlation, R is equal to +1. Yes, it means that, yes, R is equal to +1. Plus means both are moving in the same direction. Yes, 1, what does this number tell? It tells the percentage of times this is happening. That means 100% times securities are moving in the same direction. X is increasing. What will happen to Y? Y will also increase. How many times it will happen? 100 out of 100 times it will happen. Yes, this relationship is true for full 100 out of 100 situations. Now R is equal to 0.4. What does it tell? R is equal to plus 0.4. R is equal to plus 0.4. Tell me what kind of relationship is this? It is a positive relation. One is increasing, other is increasing. One is decreasing, other is decreasing. How many times this relationship will hold true? It will hold true for 40 times out of 100 times. 40 times, yes, X is increasing, Y is increasing. X is decreasing, Y is decreasing. Positive relation. That means balance 60 times. Balance 60 times, there is no relation. Okay? Yes. So it is telling, yes, for 40 cases out of 100, this relationship is true. That means balance 60 case, what was? No relationship. They are moving independently, whatever is happening. Okay? Yes. Rxy is equal to 0. It means tell me whatever happened to one security, whether other security is responding, not responding. There is absolutely no relationship at all. Yes. R is equal to minus 0.58. The sign is telling how they are moving, positive or negative. Ulta they are moving, negative they are moving. How many times it is happening? 58 times out of 100. If I take, yes, 100 days data or 100 months data or 100 years data, negative relationship can be seen. How many times? 58 times out of 100 times. That means balance times, no relationship is there. Okay, great. Yes, R is equal to minus 1 means what kind of relationship it is? Negative, opposite direction they are moving. How many times? Full 100 out of 100 times. Okay, so plus or minus tells what kind of relation. This tells is out of 100 how many times. This is the percentage of times it is happening is what it is trying to tell me. Okay, great. Covariance is going to be the joint deviation based on past data. Net both of them together, x minus x bar into y minus y bar. I take a summation of that divided by n. Probability is given means summation p into x minus x bar into y minus y bar. Till here things are fine, I guess. Okay, now some additional points which will help us in solving of questions. Okay, great. Yes, covariance of a security with itself is nothing but variance of a security. Sir, what nonsense, sir? Yes, look at this. Covariance xx is nothing but variance of x. Sir, what you are telling? Okay, tell me covariance xy formula. Can you tell me covariance xy? Yes, it is, yes, risk of x, risk of y together. It is x minus x bar into y minus y bar, summation x minus x bar into y minus y bar divided by n. I am telling I take a portfolio. In that x I am putting, x only again I am putting. Suppose I am telling, yes, I want to invest in HDFC. Yes, in upstocks also I put HDFC, in grow also I put in HDFC only. Tell me total whether my diversification, whether my risk will reduce. No, same only it will be. Variance only my risk is. Yes or no? So if I want to calculate covariance xx, yes, it is x minus x bar into x minus x bar divided by n. Tell me x minus x bar into x minus x bar. It is nothing but x minus x bar the whole square divided by n. Tell me what is the formula of this? It is nothing but my variance formula. Okay. So covariance xy, it is the net risk of x and y together in a portfolio. Covariance xx, it is the net risk of x in the portfolio, which is nothing but the variance. Risk of x is nothing but the variance of x. Okay. Okay, perfect. Covariance, how will I be showing my covariance? It is always shown as percentage square. Yes, correlation. Yes, my net risk is how much a percentage of total risk. My net risk, because I created a portfolio, it is the covariance xy divided by total is individually sigma x into sigma y. Till here things are okay. Great. Yes, correlation is a numerical value. It can be from -1 to +1. Yes, correlation of a security with itself is always going to be +1. Tell me, HDFC has increased by 10%. What will happen to HDFC? It will increase by 10%. HDFC has decreased by 5%. How much percent it will decrease? 5% only. Suppose randomly I am telling, yes, SEBI invested. SEBI wanted to reduce its risk. So he told portfolio should be created. What he did is he invested in HDFC. He had two different trading accounts. One account was there in upstocks, one was there in grow, randomly. Okay. In upstocks he purchased HDFC. In grow also he purchased HDFC. Tell me, yes, HDFC has increased 10% here. Here also what will happen? 10% only increase. Here it will reduce by 5%. Here also what will happen? 5% will reduce. Here it has not changed. There also it will not change. It will be same +1 only. Is this clear? Okay. Yes. Yes. Then one more important point. Yes, we can discuss it later also. Or if the correlation of two securities with the market is given. Now, till now what I was doing is individually securities I was comparing. I am telling boss, if I am having 1000 securities, how many times I have to keep seeing the relationship. What I will do, I will keep market as a base. For every security, I will get the relation with the market. So when I am calculating covariance, I will calculate covariance of X with the market, covariance of Y with the market. Now I am telling, now I want to calculate the covariance of XY. It is nothing but covariance of X with the market into covariance of Y with the market. So just look at the formula. Yes, we will try getting a feel of this. Look at this. Yes, covariance XY. When both things are related with market, both are linked with market, it is RXM into RYM. Yes, look at this, a simple feel. Look at this story. First, let me just get the number. RXY is equal to RXM into RYM. Question is telling, yes, RXM is 0.7, RYM is 0.4. That means RXY is going to be 0.28. Calculation is okay. Let us try getting a feel. Look at this. RXM is 0.7. Tell me, X and market, what kind of relationship is there? Positive relation. That means both are moving in the same direction. How many times this is happening? 70 times, 70% times they are moving together. Okay, great. Yes, RYM is 0.4. That means tell me, Y with the market, when market is increasing, what will happen to Y? Y will also increase only. But this happens how many percent times? 40% times only. Now I am telling, tell me, if market has increased, tell me what will happen to X? X will also increase. What will happen to Y? Y will also increase only. That means ultimately both are moving in the same direction. But how many percent times it happens? Look at this. Yes, when market is increasing, yes, X increases how much percent times? 70% times. Y increases how many percent times? 40%. That means both will together increase how many percent times? 0.7 into 0.4. 28% times. When market is increasing, X and Y together they will keep increasing. Is this clear? Yes, got a feel? Yes or no? Okay. Now look at this second situation. If RXM is equal to 0.7Y, RYM is minus 0.4. Tell me what is RXY? RXY is RXM into RYM. Now both are together relating. 0.7 into minus 0.4. It is minus 0.28. Okay, great. Now understand. Yes, if market increases, tell me what will happen to X? X will increase. But what will happen to Y? Y will decrease. That means tell me net, how they are moving? They are moving in opposite direction. Minus will come. Yes, when market is increasing, X will increase how many times? How many percent times? 70% times. Y will decrease how many percent times? 40% times. That means these two things will happen together in a relation to market only. How many times? Percent times? 28% times. Minus 0.2. Is this clear, everyone? Okay, great. Now, yes, single format to solve all the questions, including two securities. Till now, whatever we have done, yes, if you want to just bring it down in the form of a format. Yes, whenever I am bringing a format, I will always be bringing a format for future data, because that for past data also, if I do 1 divided by number of years, I will be getting. Okay. Now, weight is given in the question, probability given, jingalala, no tension. Yes, weight is not given, probability. Equal weight I will be giving 1 divided by number of years. Now, look at the format I will be using, yes, to do every calculation till now, covariance, correlation, everything. Firstly, I will put the probability. Then I will put the individual returns, X. Yes, probability into returns, P into X. I will get the expected return of X. Now, I want to calculate the risk. Yes, it is a deviation, X minus X bar. Yes, I will be doing X minus X bar the whole square into P. Yes, this will give me the variance of X. Great. Yes, now this thing I have done for X. Same story I should do for Y also. First, individual return of Y. Probability will be same only. Yes, so probability into returns gives me the expected return of Y. Now I want to calculate the risk. I will do Y minus Y bar. I want to do a square, so it is Y minus Y bar the whole square into P. This gives me the variance of Y. Now I want to know the joint deviation also, which is X minus X bar. What is the risk of X? Into what is the risk of Y? What is the probability that it will happen? So it is P into X minus X bar into Y minus Y bar. You add this, you will be getting covariance X. Great. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 10 columns will be having everything together. If you want to by heart it, that there is no need, so long as you do it logically. Okay, fine. Now tell me, yes, in this case, when I am bringing down everything to probabilities, what is going to be my formula? Expected return summation P into X. How will I be getting my returns? Percentage. Risk is always x minus x bar the whole square into p, summation p into x minus x bar the whole square. Risk will always be in terms of percentage square. Yes, covariance. Yes, risk of x, x minus x bar, risk of y, y minus y bar. Yes, what is the probability it can happen? Summation. Covariance xy is summation of p into x minus x bar into y minus y bar. Yes, how will it be? Percentage square. Yes, correlation doesn't happen, whatever happens. My correlation formula is simple, boss. What is my net risk on the total risk? Net risk, because I created a portfolio, covariance xy divided, if I had not created individually, if I had put, means sigma x into sigma y. Yes, my correlation is always going to be a numerical value. Yes, from -1 to plus. Okay, till here things are okay. Great. We are having, okay, variance, standard deviation, just correlation calculation. Okay, fine. Till here things are okay. Fine. Any doubt? Okay, just 1 minute. Yes, let things sink. Okay. Yeah. Yes. Now the final thing. Yes, why did we do all this Ramayana for? Why did we do this? Yes, why? Chumma, I did not have any work in yes life to do. I calculated correlation, covariance, positive, negative, zero. Why did I do? Boss, I created a portfolio. I want to calculate the risk of a portfolio. 3 factors are there. What all factors? Yes, what is the weight of every security? What is the risk of every security? With that, what is the correlation? How they are moving together? Will it reduce the risk or not? Okay, boss. Let us come back to the story. SEBI is there. Yes, 6 lakh, that is 60% in Tata, 40% in Think with Tabish. Yes, individually risk, that is sigma x is 10%. Sigma y is 15%. He wants to calculate the risk of a portfolio. Tell me, can I calculate risk of a portfolio like this? Can I tell 60% I put in Tata, its risk is 10%, plus 40% I put in Think with Tabish, risk is 15%. So total is how much? 6 plus 6, 12%. Yes or no? Yes or no? Yes or no? No. Because what impact I have not given? Correlation impact I have not given. Mistake number 1. Mistake number 2. Tell me whether my risk is standard deviation. What did I tell in the stat? My risk is what? Risk is always variance. My risk is always in square terms. Risk is always square. I cannot interpret square. That is why finally I will do a square root. Yes, standard deviation is always simple. It is just a square root of variance. Nothing is there. Standard deviation is just to interpret. Risk is always variance only. That means 2 things I have to do. Point number 1, 2 lessons. Yes, risk is always calculated in variance terms. That is, I have to square this. Secondly, when I am doing, I should also be giving the impact of my correlation between the securities. That means understand. Till now what I had done, till now how did I do till now? Yes, I had done, yes, Tata I have put 60% into Tata's risk is 10%. Think with Tabish I have put 40%, its risk is 15. That is, I have done weight of x into sigma x plus weight of y into sigma y. This only I will be doing, but I will be doing in square terms. Is this clear? Tweak number 1. Tweak number 2 afterwards we will do. Okay, aram se. Now tell me, yes, this to simplify, if I take it as a plus b the whole square, formula you guys know. Yes, 4th standard, what is formula of a plus b whole square? A square plus b square plus 2ab. Yes, or sorry, if how am I getting a plus b into a minus b, or yes, you can do a box approach like this also. Yes, a is there, b is there, a is there, b is there. Look at this, a into a will be a square, a into b will be ab, a into b will be ab, b square. So it is a square plus b square plus ab will be giving me 2ab. Till here okay ba? Okay, great. Now similarly, yes, what am I having? I am having weight x sigma x plus weight y sigma y. I have to do a square of this because my risk is always in variance terms. Okay, so what will I be getting? Yes, it is a square. I am having weight x sigma x. So instead of a I am having weight x sigma x, instead of b I am having weight y sigma y. So it is a square weight x sigma x the whole square plus b square weight y sigma y the whole square plus 2ab, 2 into yes weight of x sigma x, weight of y sigma y. Till here is over. Tweak number 1 I have done. I told my risk is always in terms of variance, boss. I have to square, so I did a square of this. Till here I got. But boss, this gives me the total risk. Because I create a portfolio, what is happening? Risk is getting reduced, na? Correlation impact I have to show. Everywhere correlation impact I have to show, yes or no? So tweak number 2, I have to show the impact of correlation, whether correlation will reduce it or not. That impact I should show. Yes, till now I have only considered weight of securities as well as the risk. Yes, but portfolio may reduce based on correlation. So its impact I have to show. So this was the formula I have written till now. Yes, look at this. Weight of x sigma, yes, a square plus b square plus 2ab. Great. So I can also, if I want, also write it as yes, weight of x square into sigma x square plus weight of y square into sigma y square plus 2 into yes, weight of x into yes, sigma x into weight of y into sigma y. Now till here I have written and kept. Now I have to give the impact of correlation everywhere. Okay. Now tell me, yes, weight of x sigma x. Tell me, here I am telling yes, risk of x with x. Yes or no? This is, tell me, if I invest in x only, whether my risk will reduce? No boss, it will not reduce, it will be same only. Yes, tell me what is the correlation of a stock with itself? 1 only. So I will tell it is weight of x square into sigma x square into correlation x with x plus weight of y. I invest in y only. Will it reduce my risk? No boss. Y is increasing 10%, y is increasing 10%. It is reducing, it is reducing. Tell me what is the correlation of a stock with itself? It is 1. Yes or no? So it is weight of y square, sigma y square into correlation of y with y. Here it is telling yes, y with y. Okay boss. But when I create yes, portfolio, when both are coming together, yes, x is coming, y is coming, that time whether risk can be reduced, whether risk cutting can happen? Yes boss, it can happen. So x and y together are there. Here my cutting can happen into r x y. X and y are coming together. Now this I will simplify. Yes, look at this. R x x, r y y. Yes, tell me. Yes, correlation of a security with itself is always 1. Whether I write it, I don't write it, will it make a difference? No, it will not make a difference. So it is nothing but, look at this, weight of x sigma x the whole square, which is a square, plus weight of y sigma y the whole square, which is b square, plus 2 into weight of x sigma x, weight of y sigma y into correlation of x and y, because when both are coming together, risk reduction may happen. Not necessarily it should happen, depends on the extent of correlation they are having, but it may happen. That is how I am having the derivation of the formula. Is this clear? So Yes, obviously everyone would have heard this formula. Simple. Yes, for us to remember, we will just keep the formula a plus b the whole square. Based on that, I'll keep on playing. Look at this. Yes, let us write it down. Scribble. Yes, tell me first. I will just write a plus b the whole square. It is a square plus b square plus 2ab. Two security x and y is there, which is weight of x sigma x plus weight of y sigma y the whole square. Simple. Firstly, a square weight of x sigma x the whole square plus b square weight of y sigma y the whole square plus 2ab 2 into weight of x sigma x weight of y sigma y into here alone what will come? Correlation between x and y. Yes, here two places whether correlation is not there. Correlation is there, boss, but a security with itself correlation is 1. You write it, you don't write it, does not make a difference. Is this clear, everyone? Yes or no? Yes or no? Yes or no? Okay, great. Now, yes, the same story. He is investing 60% in Tata, 40% in Think with Abish. Assume he calculated, yes, correlation, he got it as 0.4. That means whether both are moving in same direction, yes, boss, but how many times? 40% times only. We should get the feel. Based on that, formulas will keep playing. Feel is, yes, what is the most important? Okay, great. Based on that, I will calculate the variance of a portfolio. Risk is always variance. I will calculate variance only. Risk is variance only. Because I cannot interpret that, then I will do a square root of that. Standard deviation formula throughout is very simple. It is square root of variance over. What I should think is, how do I calculate variance? Okay, great. Tell me. So let us create this. Yes, we will write it down. Yes, data is there here. Tell me a plus b whole square. Yes, till the time we get the comfort, we will keep writing it like this only. A plus b whole square is a square plus b square plus 2ab. Yes, firstly I am having instead of a weight of x sigma x, instead of b I am having weight of y sigma y. So it is, yes, a square, this is weight of x sigma x the whole square plus weight of y sigma y the whole square plus 2 into weight of x sigma x weight of y sigma y into correlation xy, because when both are coming together risk will reduce. Sir, here correlation is not there. It is there, but a security with itself is 1. You write, you don't write, it does not make a difference. Okay, yes, now yes, let us do the number crunching. 0.6 into Tata is 10 square. Yes, think with Abish, 40% I have put into sigma y is 15 square plus 2 into 0.6 into 10 into 0.4 into 15 into 0.4 is the correlation. Yes, in your calculator m plus or grand total function, one of the things you use, yes, quickly calculate 0.6 into 10 into equals 0.4 into 15 into equals 2 into 0.6 into 10 into 0.4 into 15 into 0.4 equals, press GT, grand total. How much you are getting? 100.8% square. Yes or no? Yes, that is going to be the risk of a portfolio. So if he invests in a portfolio, yes, risk is there. How much is the risk? 100.8% square risk is there. Can I interpret percent square? No, boss. That means what I will do? Yes, square root I will do. Take a square root of that. 100.8 square root becomes 10.04%. Great. Till here things are fine. Okay, great. Yes. Now let us try understanding whether creation of a portfolio has reduced the risk or not. Tell me. Yes, just to get a feel. Yes. Tell me, if my R is equal to +1, whether risk will reduce? No, boss, it will not reduce. If R is any other value, risk will reduce, but to what extent it will reduce? That matters. Now tell me, my R is 0.4, that means whether risk will reduce? Boss, it will reduce. How much? Some risk only will reduce. Now look at this. Otherwise, yes, what would have been, if I was individually investing, what would have been my risk? Okay, yes, look at this without showing correlation impact directly. Yes, tell me. I will just do a weighted average for understanding purpose. Look at this. I am telling I invest in Tata 60%. What is the risk of Tata? 10%. Means 6% risk is there. Yes, I invest in Think with Abish 40%. What is the risk? 15%. 6% risk is there. Total would have been how much? 12% would have been the risk. But because in portfolio some risk cutting happens, my portfolio's risk is now 10.04% only. Why did my portfolio risk reduce? Because of the correlation. If correlation here was 1, you will get 12% only. Okay, yes. Now Let us try calculating the risk of a portfolio if R is equal to minus 0.4. Just let us scribble the formula. Scribbling thing we'll keep on doing. Everything else is same. R is minus 0.4. Let us see how much my risk gets reduced. Yes, A plus B the whole square. Yes, online people who are doing, yes, there is no, yes, point in chumma seeing and, yes, watching the class. You have to write, you have to scribble. Okay, yes, notes files I will share it with you guys, but running notes you have to do, you have to scribble. Okay, A plus B whole square is A square plus B square plus 2AB. Yes, which is weight of x sigma x the whole square, weight of y sigma y the whole square plus 2 into weight of x sigma x, weight of y sigma y into r x y. Okay, let us put the numbers. Tell me 0.6 into 10 square plus 0.4 into 15 square plus 2 into 0.6 into 10 into 0.4 into 15 into minus 0.4. That means overall risk it is reducing to a very great extent. Yes, do it on your calculator. 0.6 into 10 into equals 0.4 into 15 into equals 2 into 0.6 into 10 into 0.4 into 15 into minus 0.4. That minus symbol is there. Yes, that means what is going to be the risk of the portfolio? How much you are getting? How much? 43.2% square. Yes or no? Okay, great. If I take it as a standard deviation for interpretation purpose, 6.57%. Yes or no? Yes, understand, if I was investing individually, total risk would have been 12%. But because of negative correlation, ultimately when this portfolio comes done, yes, the risk is only 6.57%. Why? Because of negative correlation, risk has reduced, boss. But assume, yes, my correlation is 1. Randomly assume. That means everything else will be same, only here it will be 1. Just put your calculators, do the calculation. 0.6 into 10 into equals 0.4 into 15 into equals 2 into 0.6 into 10 into 0.4 into 15 into 1 equals, summation is going to be 144 percentage square. Take a square root, 12% you are getting. Yes, tell me, is there any point investing in this portfolio? No, boss. Individually you are putting, same risk only is there. Why risk has not reduced? Because correlation is 1. Both are moving exactly in the same direction. How your risk will reduce, boss? Is this clear, everyone? Till here things are okay. Now, portfolio risk, let us try creating an alternate formula also. Okay, just a small tweak. Okay, look at this, everyone. Yes, once we do this, yes, we will write down, we will do some further analysis things also. Pay attention, look at this, everyone. Yes, portfolio risk. Risk always, how I will calculate? Variance terms. Yes, in a portfolio, impact of correlation should be given. Simple. A plus B the whole square is A square plus B square plus 2AB. Like this only we will create. Aram se, no hurry only. A is weight of x sigma x, B is weight of y sigma y. So aram se I will create. Yes, portfolio risk sigma p square. It is weight of x sigma x the whole square, A square, weight of y sigma y the whole square, B square, 2 into weight of x sigma x, weight of y sigma y. When both are coming together, correlation may help us in reducing the risk. Okay. The same thing, can I also write it as weight of x sigma x the whole square, weight of y sigma y the whole square? Here, instead of writing it like this, can I rearrange it as weight of x into weight of y into sigma x into sigma y into rxy? What did I do? Look at this. 2 is there, 2 is there. Weight of x is there, weight of y here I wrote. Sigma x, sigma y, rxy. Sir, chumma why time pass you are doing, sir? What will get by doing this? Yes, we will get. Understand. If you see, you will get everything. Sebi, yes, understand. Yes, correlation formula. It is my net risk on the total risk. Net risk when I create a portfolio, it is covariance divided by sigma x, sigma y is rxy. If I take this to the other side, yes, it becomes rxy into sigma x into sigma y is equal to covariance xy. Yes or no? Just to get a feel of this also. Sigma x into sigma y, yes, gives the total risk into R, into how much percent is left, that gives me the net risk, covariance xy. Now Rxy into sigma y gives me my covariance xy. So instead of writing this, if I want, I can also replace it with covariance xy. That means what will be my formula? Yes, it is a square weight of x sigma x the whole square plus b square weight of y sigma y the whole square plus 2 into weight of x weight of y. Instead of sigma x into sigma y into Rxy, I can also write as covariance xy. This also can be my formula for portfolio variance. Standard deviation is simple, take a square root, story over. Yes or no? Throughout, anywhere, standard deviation, that is just interpretation, that is not my risk. Okay, till here things are okay. Great, absolutely no problem. Fine. Okay. So what we will be doing now? Yes, till now whatever we have discussed, quickly let us summarize. Based on that we will continue a bit further. Okay, this time I will not scribble, only you will scribble. Okay, quickly. Yes, online people. Okay. Concept 1, modern portfolio theory is what we are discussing. Yes. First thing, why am I creating a portfolio? To reduce my risk. How risk will be reduced? Based on the correlation type of relationship. Okay. First, individual securities return and risk. Let me try calculating. Okay. Based on past data, expected return x bar, it is nothing but summation x divided by n. Risk is always going to be the variance. Yes, it is summation x minus x bar the whole square divided by n. Future data, that means instead of divided by n, you will be putting into p. Okay, great. Covariance, net deviation, that is risk of x, x minus x bar, risk of y, y minus y bar. Yes, summation of that divided by n, covariance xy. Okay, future data I am not putting, instead of divided by n, you put into p. Okay, great. Okay, extra things, standard deviation is always what? Square root of variance. Okay, great. How do you calculate annual return if it is not given to me in the question? Means what all return I am getting? Dividend plus capital appreciation, which is P1 minus P0 on how much investment you have put divided by P0 into 100. Okay, great. Correlation xy, correlation between two securities, it is nothing but net how much risk is there on the total risk. Net risk is my covariance xy divided by total risk is sigma x into sigma y. Correlation is a numerical value, yes or no? Yes, between -1 to +1. Okay, great. Yes, if correlation of two securities with the market is given, yes, Rxm is given, Rym is given, you multiply both, you will be getting the relationship with each other. Rxy is nothing but Rxm into Rym. Yes, some important things. Yes, correlation of a security with itself, R of x with x is what? X increases, same only, one only. Covariance of a security with itself, covariance x of x is nothing but variance of x. These two things we have to keep on the back of our mind. Okay, okay boss, great. This format, okay, anyways, not needed much. Yes, return of a portfolio. Now I came to portfolio. I want to calculate a return of a portfolio. What is return of a portfolio? Weighted average. Simple, it is summation of weight into expected return. Yes, weight, if it is given means great, not given means it is the amount invested or opening market value for every year. Okay, great boss, opening market value for every year. Okay, returns we know how to calculate. Okay, now I am telling, yes, I want to calculate a risk of a portfolio. Risk is always variance. I should give impact of correlation. Two things, simple. Yes, a plus b the whole square is a square plus b square plus 2ab. Yes, instead of a I have weight of x sigma x, b I have weight of y sigma y. So it is weight of x sigma x the whole square plus weight of y sigma y the whole square plus 2 into weight of x into weight of y into sigma x into sigma y into Rxy, because my correlation may help me in reducing the risk. Now instead of sigma x into sigma y into Rxy, if I want, I can also write it as covariance xy. Okay, great. Till here things are absolutely fine. Okay, va? Yes, some scribbling we will do. Okay, Okay, if this is done over modern portfolio theory 80-90% is over, then we have weight of a minimum risk portfolio. That's anyways just a 5-minute concept. Yes, this understanding of this one was important. Based on this, so many times questions have been coming. Okay, yes, afternoon we'll see questions also. Now look at this, 2 securities I have taken, then 3 securities variance calculation is there, that becomes a plus b plus c whole square, simple. Okay, 2 securities there, x is there, y is there, different situations. Let us calculate the risk. I want you guys to do it quickly. Okay, yes, in x I am putting 60%, in y I am putting 40%. Yes, what is the risk? Standard deviation of x 15%, y is 12%. Okay, great. Calculate portfolio variance and standard deviation in the following situations. Yes, if r, the relation is 0.8, what will happen? Minus 0.5, what will happen? 0, what will happen? 1, what will happen? Minus 1, what will happen? Okay, one time I'll write the formula, taka taka will put on, yes, we'll keep on putting the numbers and we'll keep on going. Okay, great. Tell me, yes, variance of a portfolio is what we want. Yes, which formula I will be putting? A plus b whole square. Arams only will be doing a square plus b square plus 2ab. Instead of a I have weight of x sigma x, instead of b I have weight of y sigma y. Aram se will first create the formula and keep, then I'll keep playing. Okay, yes, a square, which is weight of x sigma x the whole square, plus b square, weight of y sigma y the whole square, plus 2 into weight of x, weight of y, sigma x, sigma y, into, give the impact of correlation, Rx. Great. Okay, now everything else will be same only, only this will keep changing. Yes or no? Okay, if r is equal to 0.8, first situation, yes, what was the numbers? X and y, 0.6, 0.4, 15 and 12. Okay, great. Yes, look at this, everything else will keep, this only will just some 2 observations we want to pull off, that is why we are playing with this. Okay, great. This is 0.6 into x is 15 whole square plus 0.4 into 12 whole square plus 2 into 0.6 into 0.4 into 15 into 12 into r is 0.8. Okay, can you just do the numbers and tell me quickly? How much? 173% square. Okay, what is your name? Sushmita has told. I don't know. If it is wrong, fight with her. Okay, online students, I don't know. I presume she has done the calculations right. Sebi, what happened? Tension? No, na? Green only, na? Okay, second situation. If r is minus 0.5, r is minus 0.5, tell me everything else will be same only this one will change. Here it will be minus 0.5. Yes, you guys can calculate these 2 values initially and keep it if you want. Then the only thing, yeah, tell me. 60.84. Yes, what is your name? Lalita has told. I don't know. Online students, Lalita. Okay, great. Okay, yes, if r is equal to 0, yes, everything else will be same only this thing will change. This will become 0. Now tell me one very simple point. Yes, 0.6 into 15 into equals 0.4 into 12 into equal. Then don't keep on doing 2 into 0.6. Ramandu say into 0 it is happening. Ultimately it will become 0. Okay. Yes, that means how much will be the risk? 10.04. Okay. Everything is percentage square. Okay, great. Yes, now comes if r is equal to plus 1, r is equal to minus 1. Okay, yes, first we will calculate. The reason why we are doing is for this purpose only. Plus 1 means here it will be into 1. Minus 1 means here it will be into minus 1. Tell me plus 1 is how much? 190.44. Yes, minus 1 means how much? How much? 17.64. All these are variance. Okay. Yes. Now, two things we'll have to do. Yes. Firstly, yes, we understand in different situations. R is equal to 1. Then R is equal to 0.5 is there. Sorry, R is equal to 0.8 is there. R is equal to 0 is there. R is equal to minus 0.5 is there. R is equal to minus 1 is there. All these different situations are there. Okay, boss, great. Now tell me, R is equal to 1. How much is the risk? 190.44. Maximum risk is there because portfolio is not reducing risk, boss. R is equal to 0.8. Some risk reduction will happen. It will come down to some 173 point whatever is a number. I am just giving you guys the feel. Some risk has reduced. R is equal to 0. Again, more it has reduced. It is just 104 only something. Okay. R is equal to minus 0.5. Again, it has reduced. It has become just 60 now. All is percentage square. R is minus 1. It has just come down to 17.64. Okay. Yes. R, how much it keeps on reducing? Your portfolio risk also keeps on reducing. Okay. This was just an understanding, not needed for us from examination perspective. Now, one simple thing that I want from examination perspective. Okay. A small tweak shortcut formula. Okay. Okay. Tell me, my portfolio thing is, or else let me just write this only and show it. Okay. Yes. Portfolio variance is weight of x sigma x the whole square, a square plus b square plus 2ab. Okay. Plus weight of y sigma y the whole square plus 2 into weight of x sigma x, weight of y sigma y into r x y. Okay. Tell me one very simple thing. Let me keep this entire equation as it is. If my r is equal to plus 1, this one will be 1. Yes or no? R is equal to plus 1, r x y. I will just copy this and keep it. Yes, this is 1. So everything into 1 will be same only. Okay, that means can I just write it is nothing but weight of x sigma x plus weight of y sigma y the whole square. Directly it is the same thing only. Great. That means this is going to be your variance if you want to calculate your standard deviation of a portfolio directly. Anywhere else you cannot calculate standard deviation directly. You will calculate variance, then you will come down to standard deviation. But if your risk is equal to plus 1, whether your risk will reduce? No, boss, it is just your weighted average. You will take a square root of that. Square root gets cancelled. That means your sigma p is nothing but weight x sigma x plus weight y sigma y, because your risk is not reducing, boss. Okay. Let me try seeing. I have my number. Assuming the numbers you have given is right. If it doesn't work out, the numbers you have given is wrong. Okay, tell me. Yes, it is going to be 0.6 into 15 plus 0.4 into 12. How much it is? 13.8. Yeah. Tell me. Yes, here my R was 190.41. Here it is 13.8. Tallying? Not telling. The Mandu say, here it is what? Percent square. That means I will take a square root of this. 190.41. Square root is how much? 13.8. This is also 13.8. I can use a shortcut formula. Yes or no, everyone? Okay, fine. Have you heard what is Mandus? Mandus, you know what is Mandus? Don't know? Yes, Mandus is a Malayalam term which means intelligent. Ale? YouTube, parnolo. Intelligent. Mandus. Go out and tell to your friends. Okay, you are the biggest Mandus I have met in a life. Okay, fine. Now. Similarly, if your R is equal to minus 1, which one I copied, God knows. Okay, fine. R is equal to minus 1. Tell me, this R becomes minus 1. This means this entire plus becomes minus. yes, which will become nothing but a square plus b square minus 2ab, that is a minus b the whole square. Yes or no? So can I also tell it as weight of x sigma x minus weight of y sigma y the whole square? That is the variance. Here also can I calculate my standard deviation directly? Take a square root. Your sigma p will be weight of x sigma x minus weight of y sigma y. Okay. In two situations, I can calculate my standard deviation directly. Yes, where all? If r is equal to +1, whether risk will reduce? No, boss, it is my weighted average risk only. Sigma p is equal to weight x sigma x plus weight y sigma y. If r is equal to -1, it is a minus b, sigma p is weight x sigma x minus weight y sigma y. Okay, va? Till here things are clear. Great. Okay. Okay, great. Now, in this situation only, yes, one final point we will discuss. Okay. Yes, it is Friday, so I'll be taking a break in 5 minutes maximum. I have to go to the mosque. Yes, people, Tamil Nadu, the prayer timing is 1:45, so accordingly I'm adjusting. If you guys have to leave, means you guys can leave now. We will continue our discussion at 2:30. Okay, the balance discussion will be continuing at 2:30. If you have to go to mosque, means you guys can leave now, depending on the time your prayer timings are. Yes, for me I have some more time here because it is 1:45. Okay, fine. Now understand one very simple point. Yes, if my r is equal to +1, whether my risk will be reduced? No, it will not be reduced. Both are moving in same direction only. When my r is equal to -1, whether risk will reduce? Maximum risk will reduce. If I want, I can make my risk 0 also, but for that I have to invest in the right proportion. So how much proportion should I invest in order to make my risk 0? Look at this simple. Yes, I have this example wherein I have x, y. I will just take a standard deviation. Okay, wait, I am calculating. Okay, how much was the standard deviation here? 15 and 12 it was. Okay, great. Okay, this will happen only if my r is equal to -1. R is equal to +1, whether risk will reduce? No, boss. Yes, r is any other number, whether risk will reduce. Yes, if it comes to -1, whether my risk can become 0? It can. Whether it will always become? No, it can. When it will become 0? When I invest properly. Now, how should I be investing? Okay, great. Now, if r is equal to -1, standard deviation of a portfolio, I have my shortcut formula. It is weight of x sigma x minus weight of y sigma y. I want to bring down the risk to 0. How much I should invest in x? A very important life lesson. SEBI, whenever we don't know, whenever we don't get whoever we want in life, yes, we don't know what exactly is happening, we have no clue, we should remember our x. Our x will give answer to every lesson, every problem in the world. So now what all I want? I want weight of x, weight of y. Let me assume weight of x as x. Total weight is 1. Yes, that means weight of x plus weight of y is 1. This is x, means weight of y, can I tell it is 1 minus x? Okay, simple. If I want, I can give you a formula, but there is no point of by hearting and keeping a formula. As much as possible, we will eliminate formulas. Only the bare minimum things we will use. Okay, great. So weight of x, I have assumed it as x into standard deviation of x is 15 minus weight of y is 1 minus x into standard deviation of y is 12. Yes, if I invest this way, it should become 0. Okay, 0 is equal to 15x. Yes, minus 12 into 1 is 12 minus 12 into x is 12x, minus into plus is minus, minus into minus becomes plus. I am doing it here only, you can do it aram se, becomes 0. Tell me 15x plus 12x is 27x minus 12 should be equal to 0. 27x should be equal to 12. Therefore, x is equal to 12 divided by 27. How much it is? 0.444444. Yes, that means in X I should be putting 44.4444% amount. That means in Y how much I am putting? 1 minus, how much it is? 0.5556. If I invest in this proportion, my portfolio risk will become 0. Yes, if I want, we will see, I will use shortcut formula. If you want a long formula also, you calculate, yes, variance as well as standard deviation. If you want to bring it to 0, ensure you take these weights up to 4-5 digits at least, or else because of rounding off also up or down may happen. Okay, simple. Sigma P, if R is -1, it is weight of X sigma X minus weight of Y sigma Y. In X I have put 0.444 into sigma X is nothing but 15 minus 0.556 into sigma Y is 12. Do this calculation. 0. Small rounding of up or down may happen, except that it is going to be 0 only. Is this clear? If you want a long formula also use portfolio. Yes, variance a square plus b square plus 2ab, that formula also you put. You will get 0 only if you are putting in this proportion. Okay, till here things are fine. Okay, so this next question also, this only was the important thing for us to understand. Correlation is -1. Yes, if weight is there, you can use shortcut formula. There is no need to use full formula. Yes, calculate the weight of X and Y in order to make the standard deviation of portfolio as 0. If you want, you can by heart the formulas. Yes, you are having formula weight of X is, I guess, sigma Y divided by sigma X plus sigma Y, something like this formula is there. Who will by heart unnecessarily? Yes, remember your X. Your X will give answer to all problems in life. Say B. For that you should first have X. For that you should first have a girlfriend. For that first you should become C. Okay, fine. Till now whatever we have discussed from scratch till now, we will revise. We will go for a break. Okay. During break, if you guys want, I will share on our Telegram group. Yes, the name of the Telegram group is Think with the Tabish. Yes, questions, compilation I will share. Okay, it is just a question compilation. I'll just show it to you guys. Okay, yes, concept wise we have compiled every question from study material. With that, reference is also given. Okay, plus past paper from May 18 till today, May 24. Okay, yes, reference is also given. See, first is return and risk of individual security. Okay, practical 1 is there, practical 2 is there. Yes, past paper not there. This return and risk of a portfolio. Yes, practical 3 is there, 4 is there. Yes, 6 is there here. Yes, correlation, this thing is given. Practical 7 is there. Okay, yes, practical 24, all these things are also there. We will discuss these also, don't worry. Past papers also. Risk of a portfolio, look at this. A is there, B is there. Market price of last so many years is given. 1, 2, 3, 4, 5, 6, 7. 7 last year's data is given. Based on that annual return for 6 years I can calculate. Okay, X and Y I will get. Risk and return by investing. Separately, what is the return and risk? Yes, if you invest 60-40%, what is the risk and return of a portfolio? Portfolio return directly you will do weighted average, but to calculate risk, you want your correlation, covariance correlation calculation will come. Yes, which is a better opportunity for investment, A or B or portfolio, I should be suggesting. Yes, similarly, Jan 21 it has come, November 21 it has come, May 22 it has come. Just a calculation of covariance and correlation. November 22 it has come, so many times it has come. May 24 again, this recent attempt, 8 marks it has come. Okay, probability is given, 3 years, X and Y is given, risk and return of individual. Yes, if equal proportion 50-50 if you are putting, means what is going to be risk and return of portfolio. Okay, for that you should be calculating correlation. Okay, then find out the proportion of each to formulate a minimum risk portfolio, that we have not discussed. Minimum risk portfolio, if R is other than -1, if R is -1, I told you how to do it. You put weight of X is equal to X, 1 minus X, you will be in a position to do it. In other situation, how do we do that? That I have not explained to you guys. Okay, this file I will share. Yes, you guys can, yes, go back today or tomorrow and aram se, yes, do questions also. Now, one final time, whatever we have discussed from scratch till now, yes, quickly, yes, take a piece of paper, we will keep on scribbling. Okay, where I will scribble. Okay, starting quickly, let us see how much time we are taking. Okay, fine. Why do I create a portfolio? Yes, I want you guys to respond. Online students also respond. At home, let people think you have become mad. No issues. Yes, why am I creating a portfolio? To reduce the risk. How risk will be reduced? Based on the correlation between the securities. Okay, boss. For that, first I should know individually for my securities what is going to be the return as well as the risk. Okay, boss. Historic past data is given. Future data. Past data means divided by n I will be doing. Future data means into P I will be doing. Okay, first expected return of a security. I will be expecting the average return. How will I get? Summation x divided by n. Risk of a security is always the variance. Yes, how do I get the variance? I will take the deviation x minus x bar the whole square to eliminate the difference. I will take the total. Boss, I want average divided by n. Summation x minus x bar the whole square divided by n. I cannot interpret. Standard deviation is very simple. Square root of variance. Okay, great. Future data based on that, instead of divided by n, you will be putting into P. As simple as that. Okay, fine. Till here was over. Then, yes, one more formula we want is covariance. Joint deviation, both together. That is a deviation of x, x minus x bar. Deviation of y, y minus y bar. Total together I want summation. I want average. On an average, what is a deviation divided by? Is this clear, everyone? Okay, great. So based on that, yes, individual returns of a security, yes, individual risk, how to calculate past data, future data we did. Now, sir, x value only is not given. X values only is not given. How do I calculate my returns in a year? How much dividend I have got plus capital appreciation, P1 minus P0 divided by investment into 100. Okay, great. Yes, individual securities is over. Yes, based on that, correlation calculation. Okay, correlation, it is how, yes, my two securities are moving in relation to each other, same direction or opposite direction. Yes, correlation, just get the feel of this. Yes, formula, yes, it is telling, yes, how much is my net risk on the total risk. Yes, out of 100 I got 50%. That percentage is what it is telling. Yes, net risk when I create a portfolio, it is the covariance divided by total risk. It is nothing but sigma x into sigma y. So Rxy is nothing but covariance xy divided by sigma x into sigma y. Interpretation of correlation +1 -1, what it means, all those things. Okay, for the time being, for us it is not needed. Okay, now based on that, these all was individual securities we have done. Now when I come to a portfolio, I create a portfolio. Yes, what is expected return of a portfolio? Nothing but weighted average. Weight of A sigma, return of A plus weight of B, return of B, so on and so forth, summation of weight into returns. Returns not given, I know how to do. Yes, weight given, great. Not given, it is my investment value or opening market value. Okay, great. Yes, I want to calculate risk of a portfolio. Tell me, whenever I tell risk, it is always the variance. Yes, A plus B whole square formula. It is a weight of X sigma X plus weight of Y sigma Y the whole square. Yes, it is A square plus B square plus 2AB. Yes, here, yes, we will do it again. Look at this, aram se. Yes, it is weight of X sigma X the whole square plus weight of Y sigma Y the whole square plus 2 into weight of X, weight of Y, sigma X, sigma Y into Rxy, because when they both come together, because of correlation, risk reduction can happen. Okay, this is my original main formula. Tweakings I will do. Yes, first tweaking is sigma x into sigma y into Rxy is covariance xy. So I can also write it as weight of x sigma x the whole square plus weight of y sigma y the whole square plus 2 into weight of x into weight of y into covariance xy. Second tweak. Third tweak that I can do, if my R is equal to +1, tell me whether risk will be reduced. No boss, it will not be reduced. What is it? It is going to be weighted average only. Directly I can calculate it, standard deviation. Weight of x sigma x plus weight of y sigma y. Yes, if R is equal to -1, maximum risk cutting will happen. That means sigma p is equal to weight of x sigma x minus okay. Yes, if R is equal to -1, if I want, can I bring down the risk to 0 also? Yes, but if I have to bring it down means, tell me what thing I can change. Can I change the risk of individual security? No, that is not in my hand. But I can change the proportion in which I put. Weight of x, I will take it as x. This is going to be 1 minus y. Based on that, you will be getting the proportion. Story over. Till here is clear, everyone? Let's quickly see, yes, whether anything is left out. Okay, returns calculation, okay, we have discussed. Additional standard deviation is okay, annual return is okay, correlation, okay, relationship with market is given. Yes, RXM into R y of market gives me R of X with Y. Okay, great. Covariance of a security with itself, it is nothing but variance of a security. Yes, correlation of a security. Yes, covariance determines the risk. Correlation is telling how it is moving. Correlation of a security with itself is always going to be +1 only. Okay, great. This format is there. Expected returns of a portfolio is just weighted average. Okay, great. Variance of a portfolio, it is A plus B the whole square formula. You can bring in a tweak here. 3 securities we have not discussed. Minimum risk portfolio. Okay, if R is equal to +1 means you have a shortcut formula. Yes, directly add. Yes, sigma p is weight of x sigma x plus weight weight of x sigma x plus weight of y sigma y. R is equal to -1 means weight of x sigma x minus weight of y sigma y. Risk can be brought to 0. For that, the weight is going to be x, you assume it as x, y you assume it as 1 minus x. Based on that, you play it. Yes, in all other situation there is no shortcut formula. You have to calculate variance, then only you will come down to standard deviation. And how do we calculate? Yes, the minimum variance portfolio, that will be discussing subsequently. Okay, now in modern portfolio theory, right now 3 things are pending. Afternoon you have to remind me if I forget. First is portfolio risk for 3 securities. Nothing is there, A plus B plus C whole square. Next is a weight of a minimum risk portfolio. Next is efficient and optimum securities. With that, yes, one of the biggest chunk modern portfolio theory will be over. Okay, then we'll go, 2 main chunks are there, that's all. Next is all miscellaneous jujube. 2 main chunks. First is modern portfolio theory. Next is going to be, yes, CAPM and beta, capital market theory by Sharp. Okay. Okay, I hope till now things are okay. Speed is okay for you guys. Yes, Zoom live students, as well as YouTube live, I hope the speed is fine. Okay, so now the time is 1:12 p.m. Have your lunch, relax for a while. If you have the time and energy plus interest, try some questions also if you want. Okay, we will continue our discussion at 2:30 p.m. Okay, yes, a lot more exciting discussion to be there. Discussion will continue at 2:30. What is this? Okay, fine. In the meantime, for you guys, that questions PDF I will share. Other things in the evening I'll share. Okay, all other things I'll share in the evening. How do we transition here? Yes, YouTube students, audio video is clear. Give me a confirmation. Room live. Okay. Oh, I want this one. Right? Yeah, now the audio video is clear. Give me a confirmation. Online students. How is the audio now? Give me a confirmation, students. Sound is perfect, clear? I am neither able to view it nor listen. What is this, duh? Okay, great. So, welcome back after the break. So, let us continue our discussion. I hope you guys had a good lunch. Yeah. So, ready to sleep? Huh? No sleep? Okay. Yes. So, let us continue our discussion from where we've stopped. Let's quickly summarize. This is off. Everything I should only do. Where is it? They're coming. This is also off. What? Projector. This is projector. From there only, I guess you can switch it on, or else use this. Not that projector. Oh God, it's on. Don't switch it off. What does it be? Adapted environment. Very important. This is not that is not the remote. This is Panasonic one. It's actually Panasonic. It's working. Project also came. Everything is working. You are the good luck, or probably once you went outside, good luck came in. Okay. Yes, everyone. So let us continue our discussion. We are discussing the chapter portfolio management. Quickly, we'll summarize. We'll continue further. Yes, everyone. So a piece of paper. Okay. We'll scribble. Yes, everyone. So firstly, why am I creating a portfolio? What is my objective? I want to reduce my risk. So firstly, let me calculate the expected return and risk of individual securities. Tell me expected return, it is summation x divided by n. Risk, how will I be calculating risk? In the form of variance, it is summation x minus x bar the whole square divided by n. If future data is given, that is probability is given, instead of divided by n, I will be doing into p. Okay, great. Now covariance xy, joint deviation, it is summation x minus x bar y minus y bar divided by n. Okay, great. So basics are there. Along with that, correlation coefficient. Yes, how my securities are moving in relation to each other. It is my net risk divided by total risk. Net risk by creating a portfolio, it is my covariance xy divided by sigma x into sigma y. Okay, great, boss. Yes, expected return of a portfolio. Portfolio return is going to be weighted average, but portfolio risk, is it going to be weighted average? No, boss. Why? What is coming into picture? Correlation is going to coming into picture. Okay, how do I calculate the risk of a portfolio having two securities? Two simple points I should always keep on the back of my mind. Risk always I will calculate in the form of a square, and I should be giving the impact of correlation. So it is a square plus b square plus 2ab. It is weight of x sigma x the whole square plus weight of y sigma y the whole square plus 2 into weight of x weight of y sigma x sigma y. When both are coming together, correlation is also going to come into picture. Yes, weight of sigma x into rxy can also be written as covariance xy. Okay, great. Now two shortcut formulas. If R is equal to plus 1, it becomes a direct weighted average. Yes, my standard deviation is weight of x sigma x plus weight of y sigma y. R is equal to minus 1 means it becomes weight of x sigma x minus weight of y sigma y. If R is equal to 1, whether risk will reduce or no, boss? If R is equal to minus 1, maximum risk reduction will happen. If I want, I can also bring it to 0, but for that I should give appropriate weights. How do I calculate weight? Take weight of x as x, weight of y as 1 minus x, portfolio risk should be equal to 0. Use this shortcut formula, you will be getting it. Okay, till here things are absolutely clear. Okay, boss, great. Now this is over. Till here we've okay. Now risk of a portfolio having 3 securities. I am having 3 securities, boss. Now how do I calculate? Yes, a very simple point. Example number 9. Where am I having? Yes, look at this. We are investing in 3 companies. SEBI is there. He is telling, okay, 3 companies I want to invest, boss. Total 10 lakh I have. Tata I will put 4 lakh, 40%. Hindustan Unilever I will put 3 lakh, 30%. Yes, Think with Tabish will put 3 lakh, 30%. Okay, great. Expected return of every security we calculated. Yes, risk of every security also we calculated. Now, yes, 3 securities are there. Yes. What is the relationship between x and y? RXY, 0.7. 0.7, 70% times they are moving in the same direction. Y and Z, how they are moving? 0.4. Yes, X and Z minus 0.6. Okay, boss, given. Now, expected return I have to calculate, risk I have to calculate. First, let me try calculating the expected return. A very simple thing in the world, expected return. Tell me in first security, yes, how much return it will give me? 20% it will give me, but I have only put 40% of my amount. Plus second one will give me 14%. I have put 30% amount. Third one will give me 30%, boss, but I have put only 30%. So what is going to be expected return of my portfolio? Tell me the values. Say be fast da. How much? 21.2%. Yes, standard deviation, risk of a portfolio. Can I do a weighted average? No, boss. Correlation will reduce my risk. Okay. Now 3 securities are there. So I am having A plus B plus C. Variance is always calculated in the form of, risk is always calculated in the form of variance square. Okay. A plus B plus C whole square formula. You guys know it is A square plus B square plus C square plus 2AB plus 2BC plus 2AC. Over. Yes, if you don't remember, simple. Box you have to put. Yes, ABC, ABC. Yes, A into A is A square, AB, AC. AB or BA. Yes, B square, BC. AC, BC, C square. So look at this, A square plus B square plus C square plus AB, AB, 2AB. Yes, BC, BC, 2BC, AC, AC, 2AC. Yes or no, everyone? Okay, great. So this one I got. Now in that place, what all I am having? 3 securities I am having. Yes, A is weight of x sigma x, B is weight of y sigma y, C is weight of z sigma z. Not going into the entire derivation again. I know how to play. Aram se we'll just keep it here. We'll play it. Now A square, yes, which is going to be weight of x sigma x the whole square, plus B square weight of y sigma y the whole square, plus C square weight of z sigma z the whole square, plus 2AB, 2 into weight of x weight of y sigma x sigma y. And when they both are coming together, what will be coming into picture? Correlation will help me to reduce the risk. Individually here correlation is 1 only, nothing will happen here, but here correlation will help me to reduce my risk. Rxy plus 2BC, 2 into weight of y weight of z sigma y sigma z RYZ. Aram se we have to, yes, derive. Then yes, AC x and z, 2 into weight of x weight of z sigma x sigma z Rxz. Formula is ready. If I want, I can tweak it also. Yes, we know how to do that. Yes, this can also be written as covariance xy. This can also be written as covariance yz. This can also be written as covariance xz. So based on that also, if I want, I can create A square plus B square plus C square plus 2 into weight x into weight y into covariance xy plus 2 into so on and so forth. Okay, okay, this is going to be my formula. If I want, I can also create that using this one also, but it is not needed. So long as I know the base of a plus b plus c whole square, based on it I can play. The simple thing is I have to do a square, and whenever things are coming together, I will be giving impact of correlation also. Individual also correlation is there, but it is one boss, it will not impact me. Is this clear, everyone? Okay, now based on that, in this data, do we calculate quickly the risk of the portfolio? Okay, let's quickly do it. Look at this x, y, z. Okay, so let me calculate variance. Okay, yes, it is a square. A is weight of x sigma x, b is weight of y sigma y, c is weight of z sigma z. Okay, now a square, which is weight of x sigma x the whole square, plus weight of y sigma y the whole square, plus weight of z sigma z the whole square, plus 2ab, 2 into weight of x weight of y sigma x sigma y into rxy correlation, plus 2bc weight of y weight of z sigma y sigma z into r yz, plus 2ac weight of x weight of z sigma x sigma z into r xz. Put the values, you will be getting the portfolio variance. Take a square root, you will be getting the standard deviation also. Okay, this thing is clear, absolutely crystal clear, yes or no? Calculation part you guys can do it by yourselves. Okay, so long as the concept is clear and you know the adjustments in the question, calculation parts is something you guys can be doing it by yourselves. Okay, now comes another important point. Yes, three securities, simple. Yes, always calculate in variance terms, give impact of a correlation as well. Okay, great. A plus b plus c the whole square formula. Okay, great, fine. All these things is over. Correlation is over. Now comes on final point. Okay, minimum variance portfolio, minimum risk portfolio. SEBI is an investor. He's telling I don't want a risk only. Risk least risk I want. How should I invest in my securities? Okay, now firstly tell me, if my R is equal to +1, both are moving exactly in the same direction, whether my risk will reduce? No, boss. That means my portfolio risk, it is nothing but the weighted average weight of x sigma x plus weight of y sigma y. Okay, completely opposite directions they are moving. Whether maximum risk reduction can happen? Yes, boss. Portfolio risk, yes, in a very small way, it is weight of x sigma x minus weight of y sigma y. Okay, if I want, can I also bring my risk to 0? Yes, boss, I can bring it to 0, but for that exact proportion I should invest. What should be proportion? Simple, x you take it as x, y you take it as 1 minus x, based on that make it 0. Okay, in all other cases, tell me, in all other cases, portfolio, can I directly calculate standard deviation? No, boss. First I will calculate variance. What is variance formula? A plus b whole square, that formula. Okay, great. Whether risk can be reduced, can it be eliminated? So I have to calculate the weight of a minimum risk portfolio. First let me write down the formula, then we'll understand. Yes, weight of x, it is sigma y square minus covariance xy divided by sigma x square plus sigma y square minus 2 into covariance xy. Maja has begun. Weight of y is equal to, yes, sigma x square minus covariance xy divided by sigma x square plus sigma y square minus 2 into covariance xy. Simple, JGB. Tell me what is formula? Weight of x is equal to sigma y square minus covariance xy divided by sigma x square plus sigma y square minus 2 into covariance of xy. What exactly on earth is happening here? Simple thing. Yes, understand. Yes, three simple principles we have to keep on the back of our mind. Story number 7. Okay, we will aram se derive this, absolutely no need to by heart. Okay, if a portfolio is consisting of two securities x and y, tell me, yes, whether a security can reduce its risk by itself? No, boss. Who is reducing the risk? Other security is coming and reducing the risk. Yes or no? That means if I am having x and y, means x's risk who is reducing? Y is reducing. Y's risk who is reducing? X is reducing. Simple point. Look at this. In a portfolio, risk of one security is reduced by other. Say for example, yes, we are watching a cricket match. Only Virat Kohli is playing full 50 overs. He is only coming, he is only going also, he is only running back, he is only playing. Risk is there, boss, he can get. Only Rohit Sharma is playing. No need to run, only hitting. Still risk is there, boss. But when both are playing together, a portfolio, partnership, whether the risk will reduce, Who will reduce the risk? Virat Kohli's risk is being reduced by whom? Rohit Sharma. Rohit Sharma's risk is reduced by whom? Virat Kohli. Yes, Rohit Sharma hits properly because he knows Virat Kohli will there, he'll take care if he gets out. Yes or no? He'll play slow. Why? Because he knows Rohit Sharma is there to hit. Why Chuma we should take efforts? Yes. So risk of one security is being reduced by the other security. Okay, boss. Point number 1. Yes. One more example. Assume one random day, SEBI decided to get married. Yes, SEBI is there, Mrs. SEBI is there. Okay. Junior SEBI is there. Okay, fine. Yes. Husband, wife. Now, assume, yes, husband is having a bad day. His wife is there to take care of the child. Yes or no? Wife is having a bad day. Husband is there to take care of the child. Both are having a bad day. Kid is there to take care of the parents. Yes. So, who is reducing the risk? Yes, he is having a risk. Due date pressure, full tension, no work. Yes, nothing can be done. Can he only reduce his risk? No, boss. It's reduced by the other security. Yes or no? Okay, simple. Two securities. Ice cream is there, umbrella is there. Yes, ice cream's risk, who is eliminating, who is reducing? Umbrella is reducing. Yes, umbrella's risk, who is reducing? Ice cream is reducing. Okay, simple point, risk of a security, who is reducing? The other security is reducing. Okay, boss, great. Second principle, what is the degree of risk reduction? How much risk has reduced? Yes, it is variance of a security minus covariance. Understand? Yes. Variance of a security minus covariance. Okay. Now, ice cream as well as umbrella example we'll take. Yes, we'll go back to that numbers. Okay. If I invest in ice cream alone, whether risk is there? Boss, risk is there. Okay. We'll go to that page. We'll take those numbers and see. Page number 11. Where is it? Okay, fine. Okay. This is, yeah, same story only. Okay, who will reduce the risk to what extent? Okay, if I invest in ice cream only X, whether risk is there? Risk is there. What is the risk if I invest only in ice cream? Risk is always variance. It is 62.5% square. Yes, if I invest in umbrella business only, what is the risk? Yes, 62.5% square. But when I create a portfolio, the net risk together is minus 62.5% square. That means understand. Ice cream, its risk was 62.5% square. When I'm only putting in ice cream, its risk was 62.5% square. But when I bring them together, the net risk came down till where? Till minus 62.5% square. 0. It was here 62.5. From here, where it came? Minus 62.5 it came. That means how much the risk reduced? It reduced by 125. Yes or no? Okay. From 62.5 it came to minus 62.5. That means it reduced by 125. Yes, next umbrella, whether risk is there? Boss, risk is there. If I put in umbrella only, yes, 62.5% square risk is there. But when I create a portfolio, the net risk came down to where? It came down to minus 62.5% square. Okay, from 62.5 it came down to minus 62.5. That means by how much it reduced? 125 it reduced. Okay, great. Now tell me total by how much my risk reduced? 250 my risk reduced. Yes or no? Till here story is fine. Now tell me. Yes, how much weight I should be giving? From here we'll take. Tell me a very simple point. Risk of ice cream, who is reducing? Ice cream is reducing. Umbrella is reducing. Yes, tell me how much risk it has reduced? 125. So it is a risk reduction. This I am taking it as X, this I am taking it as Y. It is a risk reduction of Y divided by total risk reduction. Yes, when I am investing in ice cream, why am I investing in ice cream? To reduce the risk of umbrella business I am investing. How much it will reduce? It will reduce by 125. Total how much it will reduce? 250.5. Yes, here. Yes, when I am investing in umbrella, whose risk I am reducing? Ice cream's risk I am reducing. How much I am reducing? 125 divided by 250. 0.5. That is going to be my formula. Now look at this. Yes, I will show this aram se, we will see. Yes, because this is a place where it becomes a bit difficult for students to by heart and keep it. There is absolutely no need to by heart and keep it. Simple point. Look at this. Aram se we've written and kept as well. Yes, ice creams. If I am putting only in ice cream, what is the risk? 62.5%. But when I create a portfolio from 62.5, yes, the net risk of a portfolio covariance is where? Minus 62.5. That means from here till here it has come. That means how much it has reduced? It has reduced by 125. Yes, umbrella also, whether it is reducing or boss, it is reducing from 62.5, it is coming to minus 62.5. That means it has also reduced by 125. Okay, that means tell me, X's risk has reduced by 125, Y's risk has reduced by 125, total risk has reduced by 250. Okay, okay. Now tell me a simple point. Yes, weight of X, I will tell it is a risk reduction of Y. X is reducing whose risk? Y's risk, divided by total risk reduction. Risk reduction of Y, 125 it has reduced, divided by total is 250.5. Weight of Y, Y is reducing whose risk? X's risk. So it is a risk reduction of X divided by total risk reduction. 125 it has reduced on 250, which is 0.5. Till here it's clear. So without touching a formula I can do, but I want to create a formula. Why you want formula? How will I believe? Yes, the formula is correct. On formula means at least in study material we'll see. Okay, boss, simple. Look at this. I have told simple points. 3 simple principles I have told. Principle number 1. Yes, risk reduction of X. X's risk who will reduce? Y will reduce, so on and so forth. And my risk reduction, what is risk reduction? It is nothing but a variance of a security minus covariance. Now weight of X, it is risk reduction of Y divided by total risk reduction of X plus Y. Okay, tell me risk reduction of Y. Y's risk, where was Y's risk? It was in sigma Y square. From there, where it came? It came to covariance XY divided by total risk reduction, that is risk reduction of X plus risk reduction of Y. Risk reduction of X, X's risk was where? Sigma X square. From there, where it came? To covariance XY. Y's risk, where it was there? Sigma Y square. Where it came? Covariance XY. I will now play with this. It is sigma Y square minus covariance XY divided by sigma X square plus sigma Y square, minus into minus. It is minus 2 into covariance XY. This is going to be my formula. Understanding of what exactly is happening. Okay, yes, simple. Yes, we will play with this. Absolutely no need to by heart. Sigma is no need. Simple. Yes, just the logical thought process should be there. Yes, X and Y is there. X's risk, who is reducing? Y is reducing. Y's risk, who is reducing? X is reducing. What is the amount of risk reduction? My risk, if it was individually, where it was there? In variance. But when I create a portfolio from here, where it reach? To covariance. So it is variance minus covariance. So based on that, in a very simple way, I can tell weight of X is nothing but risk reduction of Y divided by total risk reduction of X and Y. Over. So in any random number I can put, I can get the values. Yes or no, everyone? Yes, online live students, give me a confirmation. Is this clear? Manasilayo. Okay. Data. Question number 10. We will see in any existing data. Let us try putting, because for a new data to calculate, it is taking time. Or else one question fully properly we'll do. Properly, quickly we'll scribble it down. Okay, look at this. From start till now, everything in a single question. Okay. Following information is available for 2 companies, X and Y. Okay, X 5 years, what all returns is given. Y 5 years, what all return is given. Expected return of individual securities. Okay, boss, will do. Risk of securities. Okay, boss, will do. Covariance and correlation. Okay, boss, will do. Portfolio returns and portfolio risk. If investor decides to put 60%, 40%. Okay, boss, will do. Weights of a minimum risk portfolio. I want my risk to be minimum. What should be the weight? Also calculate return and risk of such a portfolio. Okay, great. Now look at this, x is there, y is there. I want you guys to quickly write down 15, 18, 17, 25. Say B, you tell me the numbers quickly. Okay. Tell me, x 5 years data is there. Tell me the total of the return summation x 10 plus 15 plus 20 plus 18 plus 2. 65. That means I will just calculate x bar. 65 I am getting over the course of 5 years. That means is it 13%? Okay, va? Okay. Similarly, I will do for y. 15 plus 18 plus 17 plus 20 plus 5. How much it is? 75. That means y bar 75 I am getting over the course of 5 years. That means 15%. Okay. Yes. Now let me try calculating the risk of each securities. X minus x bar the whole square. Tell me x, I am expecting 13. I got 10 only, minus 3. I got 15, 2. I got 20, 7. I got 18, 5. I got 2, minus 11. Yes or no? Okay. Now x minus x bar the whole square. 3 3s are 9, 2 2s are 4, 49, 25, 121. How much it is the? To not percentage square. Tell me variance of x. Yes, it is summation x minus x bar the whole square divided by n. 208% square is there over the course of 5 years. That means every year. Tell me how much it is. How much? 0.6% square. Sigma x, take a square root of that. 6.45%. Okay, great. Now for y also I have to do. Y I am expecting 15. Y minus y bar 15 I am expecting. 15 I got, no risk. 18 I got 3, 2, 5, minus 10. I will do a square. Y minus y bar the whole square. 0, 9, 4, 25, 100. 125, 129, 138. Yes, sigma y square. Always try putting a formula. Y minus y bar the whole square divided by n. Yes, every time you are having historic data, remember that you have to do divided by n. We will miss out. We will write aram say like this, sigma y square is equal to 138. I say will also write aram say 0, come after 6 months. Okay. Yes, we commit this mistake. 138 divided by 5. How much it is? 27.6% square. That means sigma y is going to be 5.25%. Okay. Part 1 is our expected return of individual securities, risk of securities. Covariance and correlation. Okay, boss. First I have to calculate covariance xy. For that, net deviation I want is, that is x minus x bar into y minus y bar. Okay. X minus x bar minus 3 into 0. 0. Yes, 2 into 3. You should be very careful. Yes, I also commit a mistake. But I can commit a mistake because I cleared my exam. Okay. Yes, 2 into 3 is 6, 7 2s are 14, 5 5s are 25, minus into minus is plus 110. Now just looking at this, yes, get a feel of whether your correlation is going to be positive or negative. It is going to be positive, boss. Look at this. This is falling. Okay, this is not impacting. Okay, this is increasing. This is increasing. Increasing. Decreasing. Same direction they are moving, boss. Whether risk reduction will happen, not much will happen. Okay, we'll see. Tell me, add this 150 percentage square. So my covariance xy, it is nothing but summation x minus x bar y minus y bar divided by n. Every time you have to tell past data divided by n, future data into p. Yes, it is going to be 155 divided by 5, which is going to be 30% square covariance. Now let me try calculating my correlation coefficient. Yes, correlation. Yes, my net risk is how much as a proportion of total risk. Net risk is covariance xy. Total risk individually, it is sigma x into sigma y. It is 31. I am telling, boss, if I had not created a portfolio, na, x is having a risk of 6.45, y is having a risk of 5.25. Total would have been how much? 6.45 into 5.25. 33.86. But because of portfolio, some cutting has happened. It is only 31. That means my correlation is how much? How much the 31 divided by 0.92. Okay, till here things are fine. Okay boss, great. This much we have done. Okay, now we'll go ahead. Portfolio returns and portfolio risk. If investor decides to put 60% in X and balance in Y. Okay boss. Now here let me just try creating a summary of data. X, Y, expected return, sigma. Tell me expected return is 13 and 15. Standard deviation directly I am taking 6.45 and 5.25. 6.45, 5.25. Covariance XY was 31, I guess. RXY was how much? 0.92. Clear? Okay. Now, yes, I create a portfolio. How much percent I am putting in X? 60%. How much percent I am putting in Y? 40%. Okay, boss. Great. Good. Now, expected return of the portfolio. Return is always just weighted average. Tell me, X is giving me how much return? 13%, boss. I put 60% only, na? Yes, Y is giving how much return? 15%. I put 40% only, na, boss? So, how much is it going to be? 13 into 0.6 plus 15 into 0.4? 13.8%. Yes, risk of a portfolio. Risk is always variance, sigma p square. Write down aram se, a square plus b square plus 2ab. Okay. It is weight of X sigma X the whole square plus weight of Y sigma Y the whole square plus 2 into weight of X weight of Y sigma X sigma Y r X Y. Yes or no? Okay. In X how much I am putting? 60%. 0.6 into sigma X is 6.45 whole square plus 0.4 into 5.25 whole square plus 2 into 0.6 into 0.4 into 6.45 into 5.25 into RXY is 0.92. If you want, you can do based on covariance also. Okay, boss. Now take out your calculator. 0.6 into, yes, when it comes to calculation, you should be very careful. 0.6 into 6.45 into equals 0.4 into 5.25 into equals 2 into 0.6 into 0.4 into 6.45 into 5.25 into 0.92 equals grand total. How much the? 34.3. Okay, great. That means standard deviation of a portfolio is going to be how much? 5.86%. Okay, great. Till here is it fine? 34 point. For a minute, just to do this calculation, tell me, Sebi, 6.45 into 0.6, 5.25 into 0.4, grand total, how much? Okay, 5.97, okay, 5.86, okay. Small cutting has happened because it is 0.9 something, na? Correlation is anyways 0.92, okay, great. This has happened. This is one option. Yes, still here also I have done. If he is putting 60-40, what to do? Weight of a minimum risk portfolio. SEBI is investing risk and I don't want risk only. Minimum risk I want to take. Tell me how much proportion I have to invest. Okay, great. Also calculate return and risk of such a portfolio. If I invest in minimum risk portfolio, what is going to be the risk? Okay, boss, let us try doing. Now look at this, very simple. I will keep these numbers here because I will be using subsequently. Okay. Minimum risk. Okay, firstly, X is there, Y is there. Without touching a single formula, I will calculate. X is there, Y is there. First, I will tell risk reduction. Tell me risk reduction. My risk will be in variance. Once I create a portfolio, it will come down to my covariance. Tell me. Here I will do sigma square also because I want the numbers here. It is how much? 41.6 and 27.6. 41.6 and 27.6. Tell me. Yes. X. If I was investing only in X, the risk was 41.6. From there, when I bring it to a portfolio, the risk has come down to 31. That means by how much it has reduced? 10.6 it has reduced. Yes or no? Okay, great. Now, when we are investing in Y, yes, it was 27.6 minus 31. Whether risk reduction has happened? No, boss, it has increased. Yes or no? Because I invested more amount in this one. 27.6 minus 31. How much it is going to be? Minus 3.4. Okay, over. Tell me total risk reduction is going to be how much? 10.6 minus 3.4. 7.2. Okay. Weight of X, it is a risk reduction of Y divided by total risk reduction. Okay, tell me, yes, when I'm investing in X, why am I investing in X? To reduce whose risk? To reduce Y's risk. Yes, by how much it will reduce? 3.4 it will reduce. So it is minus 3.4 divided by 7.2. How much is it going to be? Minus 0.47. Okay, great. Yes, this risk reduction of Y. Yes, when I'm investing in Y, yes, whose risk I'm reducing? X's risk I'm reducing. It is 10.6 divided by 7.2. How much it is? 1.47. Okay, now these are random numbers that I have taken, because of that weight is coming negative, or else in real life also your weight can be negative. When your weight is positive means you're investing. When your weight is negative means you're doing a short. Not getting into that right now here. Okay, boss. Now, if I invest like this, let me see actually if my risk is reducing or not. Okay, boss. What work you are having in life? Yes, this is minus 0.47. This is 1.47. Okay. Yes, I'll keep the same formula only. I will just change the numbers here. Weight of X was how much? Minus 0.47. Na? Weight of Y was 1.47. Okay, here only I will do minus 0.47. This is 1.47 minus 0.47, 1.47. Okay, great. Now take out the calculator. 0.47 into 6.45 into equals, okay sir, symbol is positive or negative? Confirm? It is a negative, but it is becoming square, so negative into negative will become positive. Okay, yes, simple, careful, aram se. Yes, 1.47 into 5.25 into equals, you keep it on m plus. Now this overall symbol, let me see how this symbol will be. Plus, this is minus. Okay, everything is there. That means this will become overall minus. Yes or no? So take out the numbers. 2 into 0.47 into 1.47 into 6.45 into 5.27 into 0.92. How much it is coming? Nobody is telling. No, risk vanda. Huh? 43.05. That means overall what is going to be the value? 27.0. Percentage square. Standard deviation is going to be 5 point. Take a square root. 0. Okay, great. Okay, now understand. See, previously it was 34.34 if we were investing that way. Now it has come down to 25.70. Now you take any other proportion, your risk cannot go below this. If you want to put numbers, you don't have work in life, or else if you know to use Excel, take any other weights. This is the bare minimum risk that will be there. Below this it can never go. Okay, perfect, great, chill. Pudinjicha, manasilayo. Okay, weight of a minimum risk portfolio. Alternatively, by giving probability also you can do. Okay, great, boss. Okay, this is something you guys can try it for practice purpose. Look at this. Yes, X and Y, again 5 years returns are given. Based on that, can I calculate individual return risk? Okay, can I calculate covariance, correlation coefficient? Okay, calculate portfolio returns and standard deviation. When? Yes, expected return of a portfolio, standard deviation of a portfolio. First I will calculate variance, then I will do a standard deviation. If I put 100% in X only, tell me if I put randomly, I am telling, tell me X bar is going to be how much? 12 plus 15 plus 18 plus 10 plus 3 divided by 5. 11.6%. I am telling I create a portfolio, boss. In that full money is X only. What return I'll get? X is return only will get 11.6. Assume, randomly assume, yes, sigma x square is equal to, randomly I am telling 100. Random number it is. If I put 100% in X, did I create a portfolio? Whether risk reduction happens, cutting is happening or no. That means what is going to be risk of portfolio? Same 100 only. Standard deviation, take square root of that 10. If you want, you can use this formula also. Weight of x sigma x whole square plus weight of y. Yes, 100% you are putting, that you put as 1, this you put as 0. No other work in life. Yes or no? Okay. 100% in y also, same thing only. Return is going to be return of y. Risk is going to be risk of y. Yes, everywhere else. Yes, cutting will happen. Return is going to be just a weighted average. Here you have to put the entire formula. Yes, based on that, advise the best portfolio from the perspective of returns and risk. Like this, sometimes question will ask. Now, 1, 2, 3, 4, 5. 5 different portfolios are there. Random numbers I am giving. Expected return of portfolio, risk of a portfolio. Random, okay. 10, 12, 20, 5, 30. Risk, assume it is 8, 10, 20, 40 to 30. Returns. I want more returns or less returns. More returns from the perspective of returns. Wherever return is a maximum, I will select that. Risk, I want more risk or less risk. Lowest risk, yes or no? Yes. We are all risk averse investors. Okay. Yes. Where is the risk lowest? Here. That is going to be the most preferred. Okay. Calculate the weights of a minimum risk portfolio. Minimum risk also I can do. Tell me weight of X. Simple structure for us. It is nothing but risk reduction of Y divided by total risk reduction. There is no need to calculate weight of Y also. Weight of Y I can directly tell it is 1 minus weight of X. Over? Yes. That point is also over. Yes. Now we have one small final point with that. Yes, concept 1, yes, which is a very big chunk we'll get over, which is efficient portfolio and optimum portfolio. Okay. Yes. Now what it is telling is, yes, Harry Markowitz is telling, yes, while we are selecting, there could be 10,000 different stocks. Yes, for investment purpose, I should select and invest only in the efficient securities. Now, what is efficient security? Simple example I'll give you. Yes, I had a childhood dream. We all will be having childhood dreams. Yes or no? Then we finally came into CA. Yes, my childhood dream was, yes, I should go into Olympics. I should become the best sprinter. People used to call me the Usain Bolt of my town. Okay, so my dream was, yes, one day I should be competing with Usain Bolt. I will be there, Usain Bolt will be there. We will run 100 meters. Who will become first? Tell me, assume I and Usain Bolt, both of us compete together, run together. Who will win? Me or Usain Bolt? Usain Bolt? Usain Bolt is retired. Still he is young only. He has not turned 80 and all. Don't worry. Yes. Who will win? Simple. Assume I have no practice. Assume I have a very big tummy. I can barely walk. I and Usain Bolt decide to run. Who will win? Usain Bolt. Simple. There is no need for a competition also. No need to think also. Or assume I am telling, yes, we want to create a list of best batsmen in India. Okay. 3-4 batsmen's name I am telling. Yes, you have to tell, yes, in the ranking. Okay. Yes, Virat Kohli is there. Rohit Sharma is there. Surya Kumar is there. Rishabh Pant is there. Tabish Hassan is there. Yes, we are competition. Okay. Yes, in other people you may be having. Yes, if you want a person, okay, yes, who will be there? Okay, go for Virat Kohli. If you want a person who is okay, either 6 or out, Rishabh Pant. You want a person who has that, yes, caliber to play 360 degrees, Surya Kumar. Okay, that preference could be there. But one person is direct eliminated. Nowhere. So what I am telling is, so many securities are there. I will directly see and eliminate my inefficient securities. How do I understand that? Simple, boss. 3 companies are there. A is there, B is there, C is there. Individually, I can calculate the returns. A is giving me 14%, B is giving me 18%, C is giving me 25%. Individually, I calculated risk also. Okay, now compare A and B. Tell me, A is giving how much return? 14% return. For how much risk it is giving me? For 8% risk. B is giving how much? 18 giving. For how much risk? For 8%. Tell me, if I have to select between A and B, any rational person, what you will select? You will select B, you will select, because risk 8% you are taking. For 8% risk, A is giving 14 only, boss. B is giving me 18, na? Which is good? B is good. So I can directly close my eyes. There is no need to do anything else in the world. I can tell, yes, anything may happen in the world. I will not invest in A. Now let me compare B and C. Tell me, yes, B is giving me 18%, C is giving me 25%. So if you are a person, yes, who is a risk lover, you want more returns, you go for C. You are a risk averse person. I'm telling risk, I don't want. B is having less risk. Yes or no? Between B and C, preference could be there. Risk averse person go for less risk. Risk lover go for more risk, more return. But A is directly eliminated from the competition. Is this clear, everyone? Okay, great. Now let us try understanding this. Okay, yes, steps to select the efficient securities. We are having one example. We will see this example. With that we will do. Yes. Now 6 securities are there. Question is telling I want to select 3. Okay, yes, A is there, returns and risk is given. 6 securities. First I will see, yes, risk where all it is same, can I compare and eliminate? Returns where all it is same, can I compare and eliminate? We will derive the steps. Look at this. First, let me compare the returns with same returns. Which all returns are giving me same returns? Which all securities? A is also giving 12. F is also giving me 12 only. So both from the perspective of return, they are same only. Tell me, same return they are giving. Which security you want? Security with more risk or less risk? Less risk I want. A is having 8% risk. B is having, sorry, F is having 9% risk. Tell me, what will I tell? I will close my eyes and tell F I don't want. Why? Because A is better, was same return is giving at a lower risk. Okay. Step 1, compare securities having the same return. Same return is there. Which security I will select? Select the security with the lowest risk in that. Others are inefficient. F is inefficient because A is giving same return at a lower risk. Okay, great. Now, returns I compared. What next thing I can compare? Risk I will compare. Tell me, risk where all it is same, where all risk is same. B and D, risk is same. So let me compare risk. B is also having 10% risk. D is also having 10% risk. But B na, for 10% risk, it is giving 18%. D for 10%, it is giving 20%. Tell me, return I want more or less? More I want. For 10%, this is giving me 18 only, boss. This for same 10% risk, it is giving 20. What I will do? Any rational person, what will tell? Tata bye bye for B. D is there for us. Yes or no? Okay, boss. So 2 I eliminated. Step 1. Yes. Compare the securities having the same returns. Their risk should be what? Minimum. Lowest risk I will select, others I will eliminate. Step 2. Compare the securities having the same risk. Risk is same. Return I am comparing. Return should be what? More. Select the security with the highest return. Others use eliminate. Okay. Now balance securities are there. That you have to compare. This I will try arranging in some order so that I get an understanding. Let me arrange based on risk, lowest to highest. Now understand. Yes. A is giving me very, yes, lowest risk. Yes, or in terms of risk, this is first best, this is second best, this is third best, this is fourth best. Okay. Tell me, A is giving me, A is having lowest risk. It is giving me low return. Okay. Okay. Yes. D is having slightly high risk. Yes or no? From 8 it is 10, more risk. Is it compensated with a higher return? Yes, boss. 12 was there, here 20 is there. If you don't want risk only, go for A. You want to take some risk, go for D. Okay. Yes, D is giving me 10, D is having 10% risk. C is having 11% risk. More risk is there, risk is there. But is it compensated with more return? Ah, boss, it is giving more return, no tension, na? Okay. Now, last, yes, C is having 11% risk, D is having 13%, sorry, E is having 12% risk. More risk is there. But whether E is compensating me with a higher return, boss, C is giving for 11% risk, na? C is giving 25% return. E is having more risk, but return is less here, na? So any rational person, will he choose E? Oh, boss. So this also gets eliminated. So what is pending? A, C and D will be pending. Step 1, compare securities having the same return. In that, which one I will select? Lowest risk I will select. Step 2, compare securities having the same risk. So based on return I have to compare. Highest return I will select. Now balance securities I will arrange, yes, in the ascending order of risk, and I will see individually. Based on that I will do. Look at this. A is low risk, low return. Okay, D is having a higher risk, but it is compensated by higher return. No tension, boss. C is having higher risk, but it is compensated by higher return. No problem, boss. E is having even more risk, but it is not compensated. Nah, that means E is inefficient. A, C, and D are efficient. Sir, which one we should invest, boss? If you are risk averse, you go for A. You are willing to take some risk, go for D. You are willing to take a bit more risk, you can go for C also. Okay, great. Inefficient. Now, yes, Markowitz has plotted it on a graph and he called it as the efficient frontier. How does it look? Look at this. X-axis is the risk, y-axis is the return. Okay, this. Okay, this is my efficient frontier. This contains only my efficient securities. This is going to be the inefficient securities. Understand? I'll just explain. See here, see this here, risk is less, return is less. Risk is a bit more, no problem, boss. More return, more risk, 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 more return, no problem. Okay, but here you see, here suppose I am putting some random numbers. Assume this risk is 5. Okay, this security is giving me some random numbers I am putting here. Yes, for 5%, this is giving me say 10% return. This is giving me say 20%. For same 5% risk, this is giving me 10 only, but this is giving me 20. So this is inefficient for me. If you want to compare, yes, with respect to this story, yes, look at this. Same risk, 10 and 10, B and D. If I plot B and D on a graph, risk is 10 only. Look at this. Let me just take this. Yes, risk is 10 only. For 10 risk, yes, my security, which security on earth it was? Some security was giving me 18. Yes, B was giving me 18, D is giving me 20. That means B is giving me somewhere here 18. Some random, yes, things I'm putting. Yes, D is giving me 20. Okay, so that efficient curve, efficient frontier, in that whichever you want to select, low risk or low return security you take. More risk you are willing to take, yes, you can go for any other thing. Is this clear? Okay, perfect. Now in that also, one final point, yes, efficient frontier, determination of efficient securities. Step 1, compare securities having same return. In that, select with the lowest risk, eliminate others. Same risk means I want comparing based on return, highest, eliminate others. Balance securities, rearrange based on ascending order of risk, see if there is any inefficient. Yes, efficient frontier graph also I have drawn. Now based on that, yes, optimum, I am telling no boss, okay, efficient I selected. In that also I want one only. Yes, I want to select. On what basis I can select? Now, two different techniques are there. First is coefficient of variation. Second is Sharpe ratio. Quickly in a minute I'll tell, not that important. Yes, what is coefficient of variation telling? Yes, it is telling how much risk I am taking to earn 1 unit return. How much risk, sigma, for 1 unit of return, sigma divided by x bar. Okay, simple. Look at this. 3 securities are there. A is there, B is there, C is there. Look at this. Yes, A is the lowest risk, low return. B is having slightly higher return. It is having higher risk, higher return. Okay, boss, great. CV is telling, yes, for how much risk I am taking. It is sigma divided by x bar. For 1 unit of return, how much risk I am taking? Simple. Sigma by x bar. It is 10 divided by 15. It is how much? 0.66. It is 12 divided by 20. It is how much? 0.6. Yes, it is 40 divided by 30. It is how much? 1.33. Now let me try understanding simple. See, everything is just a cross multiplication. I will show sigma x bar. Sigma is 10. If I take 10 risk, I am getting 15 returns. I am telling for 1 unit of return, how much risk I am willing to take. It is going to be 10 divided by 50. Yes or no? Sigma divided by x bar. It is 0.66. So I have calculated. Tell me, for 1 unit of return, how much risk I am taking? Tell me, risk more I want to take or less I want to take? Less I want to take. That means which one is the best? Lowest is the best. B is the best. Based on coefficient of variation, lowest is going to be the best. Okay, there is one more way for us to do it. It is called Sharpe ratio. Subsequently it will be coming. Yes, Sharpe ratio is telling it is the extra return that I am earning. How much extra I am getting for taking 1 unit of risk. Okay, so it is nothing but extra return divided by risk. It is expected return minus risk free divided by sigma. Now a very simple way, yes, assume risk free rate is 5%. That means even if I don't take any risk, I don't want risk only, boss, zero risk. How much I will get? 5% I will get. But I took some risk and I invested in A. How much return I am getting? 15. That means how much extra I am getting? 10% extra I am getting. But boss, to get 10% extra, how much risk I took? 10% risk I took, na? Risk free, there is no risk only. But here 10% risk is there. So I incurred 10% extra risk. For that I got 10% extra return. That means for 1 unit of risk, how much extra return I am getting? 1. Okay, B I am investing. I put in risk free. How much I will get? 5 I will get. But here how much I am getting? 20. How much extra I got? 15 I got, boss. But to get 15, how much risk I have taken? 12 risk I have taken. So 15 divided by 12 is going to be how much? 1.25. Okay, clear. Now I am telling, no, boss, I want to invest in C. I don't take risk only. How much I'll get? 5. C is giving me how much? 30. That means how much extra it gave me? 25 extra it gave me, boss. But to give me 25 extra, how much risk I am taking? 40 risk I am taking. That means to get 1 unit of extra return. Sorry, for 1 unit of risk, how much extra return it is giving me? 0.625 only. Yes, it is telling for 1 unit of risk, how much extra return I am getting. Tell me, return should be more or should be less? Should be more. For taking 1 unit of risk, A is giving me 1% extra, B is giving me 1.25% extra, C is giving me 0.625 only extra. Tell me which one is the best? B is going to be the best. Is this clear? Okay, yes, with the highest Sharpe ratio, this is the lowest C. Is this clear? So with this, yes, concept number 1, one of the biggest concepts, yes, modern portfolio theory by Harry Markowitz is over. We will quickly summarize. I'll give you guys a 2-minute breather, then we'll continue further to the next big concept. Now there is something called as capital market line. Yes, till now in the last 8-9 attempts question has not come, just a theoretical discussion. Yes, logically to take the journey of portfolio ahead, yes, logically that is a very important milestone, but for us from exam perspective it is not important. In the end, if you want, I can tell to you guys in 2 minutes if you want, in the end, in market line concept, but the complete story, all those things is not needed for us. Okay, so I will not be touching on capital market line. We can aram se go ahead, no issues. Online live students, give me a confirmation. Okay na? Okay. Yeah. Shall we revise? Okay. Yes. Obviously, first time we are getting into the flow, it will take a bit of time. But once you have understood, see, first time for you to understand things properly in a structured way, it will take some time. But once you have done, I can assure you, portfolio you can revise in 10 minutes maximum. Yes, without by hearting. Just your steps have to keep. You have to just keep repeating. That's all. Okay. Yes. Great. Okay, now we will start. Okay, I want you guys to respond. Online students also respond. Okay, why am I creating a portfolio? To reduce the risk. How my risk will be reduced? Based on the correlation between the securities. Okay, boss. Individual securities return and risk I want to calculate. Yes, past data is there, future data is there. Past data means divided by n, future data means into p. Okay, yes. Expected return of a security, it is nothing but the average return. It is summation x divided by n. Risk is always variance. Yes, it is x minus x bar, deviation. Eliminate the yes signs, whole square, take a summation. I want average divided by n. Okay, great. Yes, my standard deviation is always going to be square root of variance. Okay, boss. I am telling 2 things I am investing together. I want to calculate the net risk, covariance xy. It is a summation x minus x bar, y minus y bar divided by n. Obviously, everywhere you are having future data, instead of divided by n, you are going to put into p. Okay, boss. Yes, annual return x is not given to me. How do I calculate? Dividend plus capital appreciation, p1 minus p0 divided by initial investment p0 into 100. Okay, boss. Great. Till here it's fine. Okay. Now, if returns are not given to you, prices are given, market price and dividend is given. For 5 years, data is given means, can I calculate return for full 5 years? No, boss. -1. First year opening will not be there. Based on that, for 4 years only. That thing should be there on the back of our mind. Okay, great. Based on this, yes, correlation XY. Yes, it is a net risk divided by total risk. Net risk, when I create a portfolio, it is my covariance XY divided by total risk without diversification, sigma x into sigma y. Okay, great. Yes, x bar, it's always available in the form of a percentage. Variance is always percentage square. Standard deviation is again percentage. Covariance is percentage square. R is a numerical value. It will be between -1 and +1. Interpretation, what does correlation tell? Yes, two securities, how they are moving, same direction or different direction. Okay, yes, correlation can be between +1 to -1. +1 means risk is reducing, no. -1 means maximum risk reduction will happen. If R is equal to +1, what is the interpretation? Yes, plus, both are moving in same direction. How many percent times? 100% times it is happening. R is equal to 0.6. Which direction they are moving? Same direction. How many percent times? 60% times it is happening. R is equal to 0. Whatever is happening to one security, other is not responding only. Okay, so on and so forth. Okay, boss, great, fine. Now, when I am creating a portfolio, for a portfolio, expected return of a portfolio, it is nothing but the weighted average return summation of weight into expected return of a portfolio. Expected return, I know how to calculate. Weight, if it is given means great. If it is not given means it is nothing but my amount invested or opening market value. Okay, great, boss. I want to calculate the risk of a portfolio. Risk of a portfolio is always calculated as a variance. Two things I should keep on the back of my mind. Yes, risk I will always calculate in variance, square terms. Second, I should give impact of correlation. Okay. Yes, in case of two securities, it is A plus B whole square formula. A square plus B square plus 2AB. Yes, it is weight of x sigma x the whole square plus weight of y sigma y the whole square plus 2 into weight x, weight y, sigma x, sigma y into rxy. If I want, instead of this, I can also write as covariance xy. Okay, boss. That is two securities. Sir, three securities there. A plus B plus C the whole square. A square plus B square plus C square plus 2AB plus 2BC plus 2AC. Yes, it is weight x sigma x the whole square plus weight y sigma y the whole square plus weight z sigma z the whole square plus 2 into weight x, weight y, sigma x, sigma y into rxy. If I want, instead of this, I can also write covariance xy plus 2bc, that is weight y, weight z, sigma y, sigma z, ryz. Aram se, yes. Here if I want, I can write covariance yz plus 2 into weight x, weight z, sigma x, sigma z, rxz. Here if I want, I can also write as covariance xz. Okay, boss, great. Yes, then comes shortcut formula for calculation of standard deviation directly. Only two places I can do. If R is equal to +1, cutting will not happen. It is weight x sigma x plus weight y sigma y. R is equal to -1, maximum cutting will happen. Weight x sigma x minus weight y sigma y. Now here, can I bring down the portfolio risk to 0? Yes, boss. But for that, what I should do? Invest in the right proportion. What should be the proportion in which I should be investing? Take weight of x is equal to x, y is equal to 1 minus x. If you don't want, you put the weight of minimum variance portfolio. That formula also, if you put same answer only, you will be getting. Okay, okay, great. Now, any other situation, yes, R is +1 will not reduce. -1 completely it can be eliminated also. Other cases, risk will reduce, it will reduce. Will it be eliminated? No. I am telling I want a minimum risk portfolio. For that, how much should be weight of each securities? Okay, simple principle I should always keep on the back of my mind. Yes, x is risk. Who is reducing? Y is reducing. Okay, what is the amount of risk reduction? It is variance minus covariance. Simple, x is there, y is there, total is there. Yes, risk reduction of x. Yes, it is variance of x minus covariance. It is variance of y minus covariance. Weight of x. X is reducing whose risk? Y's risk. So it is risk reduction of y divided by total risk reduction of x plus y. If you want from here, you can play. risk reduction of y, it is variance of y minus covariance xy divided by, yes, variance of x plus variance of y minus 2 of 2 covariance xy. There is no need, from this you can directly play along. Okay, yes, that is weight of a minimum risk portfolio. Then efficient securities, I will eliminate inefficient securities. How do I calculate? Step 1, select select securities having the same return. Select security with the lowest risk, others you will eliminate. Then select, compare securities having the same risk. For the risk return, what I want, highest return I want, others I will eliminate. Now balance securities, in some order I will arrange, ascending order of risk. I will compare and see if any efficient securities are there, that also I will eliminate. Okay boss, efficient securities I got. In this also one only I want, which optimal security I should be investing in. Okay boss, you can take it based on coefficient of variation or Sharpe's ratio. Sharpe ratio, it is telling how much extra return you got. Expected return minus risk free for 1 unit of risk divided by sigma. Yes, this is from the return perspective. This is from the risk perspective. Yes, for 1 unit of return, how much risk I am taking? It is sigma divided by x bar. Okay, for 1 unit of return, how much risk I am taking? Tell me, risk taken should be more or less? Less, that means CV should be lowest. Yes, return that I am getting should be more or less? More, that means Sharpe ratio should be maximum. Aram se, there is absolutely no need to by heart and keep. Is this clear everyone? Okay, using the charts, let us see if anything has been missed out. Okay, all these things we have done. Covariance is also over. Format, if you want for all the things together. Yes, when probability is there, P x, P into x gives me my x bar, x minus x bar, P into x minus x bar the whole square, that gives me variance of x. Yes, y, P into y gives me expected return of y, y minus y bar, P into y minus y bar the whole square gives me variance of y. Now I want to covariance, P into x minus x bar into y minus y bar. Okay, great. Yes, if this is not there, yes, probability is not there, this will go, this will go. Yes, everything else will be there, but just that, okay, you will not be multiplying by probability, that's all. Aram se you will do. Yes, if you are multiplying by probability directly, if you add means sufficient, otherwise you have to do a average everywhere. Okay boss, perfect. Standard deviation is always a square root of variance. Yes, annual return I have told. Correlation, okay, formula we have told. Okay, yes, correlation of two securities with market is given. Yes, RXM into RYM gives me my RXY. Okay, great. Covariance of a security with itself, it is nothing but a variance of a security. Yes, R of X with X is always 1 only. Okay, great. Yes, expected return of a portfolio is nothing but a weighted average. Weight is not given, means what you have to do. Yes, risk of a portfolio, variance in case of 2 securities, 3 securities. Standard deviation is square root of variance. Okay, minimum risk portfolio, just simple principle, risk of X, who is reducing, Y is reducing. To what extent they have reduced, it is nothing but variance minus covariance. So weight of X is risk reduction of Y divided by total risk reduction of X plus Y. Okay, great. This 3 securities, in case of 3 securities, how do I calculate the minimum risk portfolio? We will discuss subsequently when we are discussing the concept of market line. Yes, shortcut formula. Yes, R is +1. Okay, R is -1. All other cases. Okay. Yes, the concept is fully over. Efficient optimum also we have discussed. Till here things are okay, I presume. Okay. We'll go ahead to the next set of concepts. 5 o'clock onwards, we will solve questions. Okay, till 5 o'clock, how much ever maximum we can do, we'll do. After that, questions will solve. Wherever new adjustments are there, I'll tell. Balance, you guys try by yourselves. I've given you the PDF. Go back, try. Doubts are there, we'll be discussing. Okay, na? Whatever examples we are doing in that maximum, different types of adjustments we are trying to include in that. Okay. 2 minutes break for me. Huh? For you is break only, nada? Coffee, you're having? Oof, morning 6:45. Where? Ram Harsha sir's classes. Ram Harsha sir takes it morning 6:45. He wakes up at 6:45. When is the exams? November only. This class will get over. Who is that sleeping da? What is your name? Bahubaliya. Ah. So you guys are listening to class from morning till evening. The night again some other class you will see. When you will study. Okay. Morning 6:45. You will not sleep, audit of that too. Morning 6:45. Full day. Yesterday night I had to write all these things. So from 2 days I am writing. It is not getting over only. So yesterday night from somewhere I ordered tea. Half-liter tea I ordered. Okay. I ordered, I drank. 2 o'clock I am going to sleep. I am not getting sleep only. Yesterday I was getting sleep by 6 p.m. but work was not over. Na? So I started drinking to finish this up. Then there is no sleep only. Day before yesterday, due to travel, I did not sleep. Yesterday, because of tea, I did not sleep. Today, God, please. Huh? Yes, online live students. I hope pace is okay, fine. Okay, great. We'll continue our discussion, everyone. Okay. People in the last, come friend, na. I'm shouting so much. You also, blue t-shirt. You're having a fight with everyone, na. What is your name? Harini. First bench, Harini. Yeah, you can sit next to him. Don't drink his coffee. That's all. Okay. He is keeping it aside. Don't worry. She'll not drink your coffee. Huh? Or to distribute everyone. Okay, great. So, capital market line I'm not discussing. Not important also from examination perspective. Okay. Next comes another very important concept, which is capital asset pricing model and beta. This is by William Sharpe. Okay, these two are going to cover roughly approximately around 85% of portfolio management, modern portfolio theory, next CAPM and beta. After this, what is pending is just your arbitrage pricing theory, that is JUJUB. Then there is that concept of market line is there, that is again a security market line, all those things in that characteristic line. Okay, sometimes it will be asked, that's all. Okay, boss. Now let us try understanding. First is the basics of beta. Yes, what exactly on earth is beta? Now, we told that the risk is always variance. I have told risk is always variance, standard deviation just for interpretation purpose I am taking. Okay. Yes, the risk that I am calculating as per modern portfolio theory, that is the total risk of a security. Okay. William Sharpe is telling I have to bifurcate it as systematic risk, unsystematic risk. What exactly? Let us understand the thought process. Based on that, we will build everything. Okay. He is telling total risk will be bifurcated as systematic risk, unsystematic risk. Yes. Unsystematic risk, systematic risk. Yes. Which is uncontrollable. Unsystematic risk is uncontrollable. Which is controllable. Systematic risk is controllable. Yes or no? No. Ulta. Yes. Systematic risk. It is a risk in the system. In the market, the risk is there. Yes, it originates from macroeconomic factors which are uncontrollable. Anything in the world you do, you cannot control. Yes, it is measured using beta. Unsystematic risk is company specific risk. Okay, it is controllable. How it is controllable? Through diversification. It is controllable. Yes, a very simple. Yes. Okay, example I'll give you. Yes, first story that we started with today. Yes, I decided that I am going to invest 100% in Adani. Yes, risk is there. Risk is there. What all risk can be there? Yes, possibility number one, say for example, yes, Hindenburg report came. Yes, that all these things are happening in Adani, you should not invest. Because of that, share price fell. Tell me, is this company specific factor or full economy specific factor? Company specific. Only in Adani it is happening. Other companies it is not there. Yes. Say for example, a fire broke out in Adani. Company specific, full overall economy. Only company, only in this company it is happening. Yes, its impact will be reduced if you create a portfolio. Understand, Adani security, yes, fell by 20%. Okay, boss, you build a portfolio, na? The risk reduction of Adani will be very less only. Yes, the impact of Adani's fall is going to be very less because other securities are there, they'll take care of it. Okay, systematic risk. Yes, the entire economy only fell. Say for example, COVID came. Yes, you had invested in Adani, Tata, Reliance, HUL. COVID came. COVID is impacting one company or full market? Full market, full economy. Now tell me whether Adani will also fall, Tata will also fall, Reliance will also fall, HUL will also fall. Yes, systematic risk means it is a risk in the system. Full system only risk is there. Market only can go up, can come down. Market is going up, everything will go up. Market is coming down, everything will come down. Okay, that is systematic risk. Unsystematic is going to be company specific. Over and beyond systematic risk, company specific also some risk will be there. Okay, boss. So let us try seeing. Look at this. Yes, systematic risk. It is a risk that originates from macroeconomic factors which are not in the control of the company. It is uncontrollable. Yes, how do I measure systematic risk? It is measured using beta. So what is a beta? It is a measure of systematic risk. The way I measure total risk by sigma. Sorry, standard deviation sigma. Yes, the way, yes, I measure my systematic risk using beta. Okay, unsystematic, it is company specific. Yes, company specific risk is there. That its impact can I reduce? Yes, I can reduce through diversification. It is measured using error term, EI. It is called as error term. Okay, great. Example, change in interest rates. Yes, RBI changed the interest rate, Fed changed the interest rate. It is going to impact the full economy. Whether any company can do anything about it? No, boss, cannot. Yes, inflation rates. Inflations are more. Anyone can do anything? No, boss. Exchange rates have changed. Full market is getting impacted because of that. Yes, geopolitical factors. Say sudden government dhamar, it fell. Full market is gone. Yes or no? Recession, etc., etc. Yes. Some other things are company specific. Say for example, only in one company inefficiency is there. Yes, one company cash problem is there. Yes, one company, okay, they ran away. Only in that company it is there. That if you create a portfolio, its impact will be reduced. This impact will not be reduced. Sir, why exactly on earth we are doing all these things, sir? Yes, understand. Yes, Sharp is telling a very simple point. He is telling, boss, systematic risk is there, unsystematic risk is there. Till now we told that for taking a risk, we are asking a premium. Okay, Sharp is telling simple point, boss. Systematic risk is there, unsystematic risk is there. Unsystematic risk, can I reduce through diversification? That means, should I be asking a premium for taking unsystematic risk? No, boss, you diversify, na. Systematic risk, can I reduce through diversification? No, boss, it is there in the market, inherent it is. You ask a premium only for systematic risk. Simple point. Till now we are telling we will ask a premium for the risk. Sharp is telling you ask a premium only for systematic risk. Okay, yes, a very simple different examples will you. Yes, assume, yes, SEBI is there, SEBI is a student, he gave CA exams. Yes. First attempt, he did not study only. Yes, full time, he was playing with the, yes, market portfolio, yes, drinking coffee, not opening books only. He went to the examination, every question was from study material, simple only, he did not study only. Yes, assume, he wrote for 30 marks. He is coming out and telling, ICA should give on 20 marks grace this time. Whether ICA will give? Can you demand a premium for things which are in your control? Assume situation 2. He studied everything, revised everything, everything he did. He went to the examination. The most difficult paper. Nobody is understanding anything. Everybody is doing like this. But still he wrote maximum whatever he did, he wrote. Now can he expect some grace marks? Okay, so a very simple point. Yes, we can demand premium only for factors which are uncontrollable, which are not in our control. Yes, Sharp is telling the same thing. You demand a premium not based on total risk, boss. In total risk, systematic is there, unsystematic is there. Unsystematic, you diversify, it will get eliminated, na? Why should we give premium for that? Yes, systematic risk cannot be eliminated. So you demand a premium for systematic risk only. Okay. Okay, so that is the thing. Okay. Inherent, there are some inherent risk which cannot be eliminated. You do whatever you want to do. Okay. Yes. So for that market related risk, for systematic risk, for risk which cannot be eliminated, for that you ask a premium. For risk which can be eliminated, diversified, you diversify. Simple. Okay. Just a very imaginary example. Yes. Assume. SEBI is there. Okay. Yes. Assume. Yes. SEBI loves kids. Okay. SEBI has only one dream. Yes. First to become CA. After that, he wants to have so many kids. Yes. He wants to create a big cricket team, not of 11 people, even bigger. Okay. In that, he wants people from different states. Okay. So assume, random imaginary story. So SEBI married a person. Okay. So they did not have a baby. So SEBI married another person. They did not have a baby. SEBI is saying, I want to reduce the risk. I want to diversify. He keeps on marrying other people. Yes, why? On the expectation that due to diversification, the risk will be reduced. But what if there is inherent risk? Can it be eliminated? Imaginary story. Don't feel bad. He's saying, no, sir, I have self-assurance. Okay. So the same thing we are telling. Yes, there are risks that can be diversified. There are risks that cannot be diversified. Unsystematic, company specific. You diversify, you create a portfolio, it will be diversified. For that, can you demand a premium? No. But there are some systematic risks, some inherent risks, some risks that cannot be eliminated. For that, you ask a premium. Okay. So simple. Investor is there. SEBI is an investor. He invested 100% of his funds in Adani only. Yes, risk is there. So what if something happens to the company? Entire fund will go away. Yes, SEBI decided, no, boss. He will put 100% in United Breweries. Heard of United Breweries? His role models company. Vijay Mallya. Shanta, what? Okay, whatever. Yes, 100% he put in United Breweries. One day he went away. Yes. Investors also went away. Okay. Yes. To compensate for the pain that they took, they could not even drink also, because with the bottles only he went away. Okay. Now promoter absconded the country. Risk is there. But boss, you should have diversified. That is why you are telling, create a portfolio, diversify your risk. Okay. Suppose he invested in 30 most efficient securities. He invested in Nifty, 30 best securities, efficient. Yes, in that he invested. Still, is there a risk? Diversification has happened. 30 best securities, diversification has happened. But if the entire market has fallen, say for example, COVID has come, you invested in Nifty, whether your portfolio will go down? Yes, boss, it will go down. The entire market is down. Suppose 2008 economic crisis has happened, market will go down. So a simple point that he is trying to make across is the crux. Yes, normally investors are going to demand a premium for the risk taken in a stock. Sharpe is telling that is wrong, boss, because in your total risk, you have systematic risk as well as unsystematic risk. Unsystematic risk you can diversify, then why are you asking premium for that? Yes, Sharpe is telling, as per me, risk means only the systematic risk. That means I will ask a premium only for systematic risk. Risk of a stock is systematic risk because it can be eliminated through diversification. So investors should be demanding a premium only for the systematic risk. So here all calculations will be done from the perspective of systematic risk, which is measured in terms of beta. Okay, that is going to be the start of my CAPM. Okay, boss, great. So investors will be demanding a premium for risk taken, but he is telling only systematic risk. So you will be demanding premium only for systematic risk. Okay. Then comes again a very important point, concept of beta. What is beta? Okay. Beta is a measure of systematic risk. It is telling how much a systematic risk is there in a security. Okay. It measures by how many times a stock's return will fluctuate in relation to market returns. Yes. Beta is also called sensitivity of stock in relation to market. Interpretation of beta. Yes. One simple example I'll tell you. Okay. Yes, if today, I am taking simple example today. Okay, today assume the overall market has increased by 1%. Reliance is also share. Assume Reliance has increased by 2%. Tell me, that means Reliance is changing. Yes, in what extent in relation to market? 2 times. Yes or no? So when market is changing 1%, Reliance is changing how much percent? 2%. Suppose randomly I am telling, yes, market has changed 10%, Reliance has changed 15%. So I want to know, if my market changes 1%, security will change how much percent? 15 divided by 10, 1.5. Now understand the meaning of beta. Beta tells me for 1% change in market, security will change how many times? If my beta is 1.5, what does it mean? If my market changes 1%, security will change 1.5%. Yes, that means if my market increases by 1%, security will increase by 1.5%. Market decreases by 1%, security will decrease by 1.5%. Market increases by 10%, security will increase 1.5 times of that. 10 into 1.5, security should increase 15%. Market decreases 5%. Yes, it is 1.5 times riskier. So it is 1.5 into 5, it will be reducing 7.5%. Okay, it is telling how many times it is riskier. Okay, boss, look at this. If beta of a stock is equal to 1.5, what does it mean? Its interpretation is that if my market fluctuates by 1%, my stock will fluctuate by 1.5%, or my stock is 1.5 times riskier when compared to market. That means if my market increases by 10%, tells me if my market changes by 1%, stock changes by 1.5%. If my market has increased by 10%, stock will change by how many times? 15% it should increase. Yes or no? Okay, is this clear? If my market has decreased by 10%, by how much percent security will fall? It will decrease by 15%, 1.5 times riskier. So if it falls by 10 means 10 into 1.5, 15% will be the fall. Is this clear, everyone? So got the feel of beta? It is telling my security is how much times riskier when compared to market. If my beta is, say for example, 3.3, it means my security is 3.3 times riskier when compared to market. That is, if my market increases by 1%, this will go up by 3.3. If it falls by 1%, my security will dumb or fall by 3.3%. Is this clear, everyone? Yes. Now comes, yes, types of beta. Understand, yes, different types of beta. Positive beta means both things are moving in the same direction. Market is increasing, security is also increasing. Market is decreasing, security is also decreasing. Okay, great, boss. Yes, if my beta is up to 1, say for example, my beta is 0.8. What does it mean? What does it mean? What does it mean? If my market increases by 1%, na, security will increase by how much percent? 0.8% only. If market reduces by 1%, security will fall by 0.8%. Yes, it is called as a defensive stock. It is less risky because change is less. Yes, if beta is equal to 1, means market increases 1%, mine will also increase 1%. Market fall 1%, mine will also fall 1%. It has exactly same risk as market. Yes, beta is more than 1. Aggressive stocks, it is more risky. Yes, assume beta is 1.8. That means market tomorrow, if it increases 1%, means this will increase 1.8%. Market falls 1%, means this will fall 1.8%. This is going to be more risky than market. Okay, this is coming in positive, both are in the same direction. Then comes zero beta. Yes, market is increasing, decreasing, whatever is happening, security is not moving only, no relationship only. Yes, negative beta. Yes, if market is increasing means security is decreasing, market is decreasing means security is increasing. In the real life, yes, this is going to be very less. Okay, yes, and William Sharp has assumed that yes, beta is always going to be positive only, but sometimes in questions ICA can give anything in the world. Okay, yes. So now understand the interpretation. If I am telling beta is equal to minus 1.5, what does it mean? If a market has increased 1%, what will happen to my security? Security will decrease, negative, opposite direction. How many times? 1.5 times, that means 1.5%. If market has decreased by, say for example, 1%, that means what will happen to security? Ulta it will go, increase it will go. How many times? 1.5 times 1.5. Okay, is this clear, everyone? Okay. Yes, beta is always calculated as a numerical value. Okay, great. Some important beta figures that we should be knowing. Firstly, beta of a risk-free asset. Yes, whether market increases, decreases, whatever happens, risk-free, will it change? No, boss, it will not change only. That means beta of a risk-free is always going to be equal to 0. Beta of market is always equal to 1. Why? I am comparing in relation to market, na? Means market I am always going to take it as 1. Simple, I am telling, if my market changes by 10%, security changes by 15%. That means if my market changes by 1%, security changes by how much? This is what I am doing. 15 divided by 10, 1.5. That means interpretation, if market changes by 1%, security changes by 1.5%. If I am comparing with market only, yes, market changes by 10% means market changes by 10%. Market changes by 1% means market changes by how much? Mandu say it is in relation to this only, right? It will be 1 only. Okay. Yes. So beta of market is 1, beta of risk free is going to be 0. Okay. Now comes the calculation of beta. Beta formulas. 4 formulas are there. First, let me just write down the formulas, then slowly aram se will try building. Yes. Only 2-year data is given. Yes, beta is nothing but change in stock return divided by change in market. Yes, multiple year data is there. Beta is sigma x divided by sigma m into RXM, or beta is equal to covariance xm divided by sigma m square. Okay, this is my beta formulas. With this, there is one more shortcut formula also. Yes, it can be used only if past data is given. It is summation xm minus n x bar m bar divided by sigma m square minus n m bar square. This is shortcut. This is shortcut. Okay, now this, even if you forget completely also, it is going to be absolutely fine, no issues for us. Yes, mainly, yes, I should understand this, I should understand this, based on this I will tweak and get this, based on this I will tweak and get this. Aram se is quickly we'll see. Firstly, only 2 years data is given. How do I calculate? Simple. Year 1, 2 years data is given. Year 1 x has earned 12%. Year 2 x has earned 20%. That means tell me in second year how much extra return x has earned. 8% extra it has given. Okay, va? Okay, 8% extra it has given. Market has given me how much extra? 5% extra it has given me. Simple. Okay, so I am telling, when market gives me 5% extra, my return is giving me how much extra? 8% extra it is giving me. Yes, so when market gives me, yes, market security. When market gives me 5% extra, security is giving me 8% extra. Yes, when market changes by 5%, security changes by 1%. I want to know if my market changes by 1%, security will change by how much percent? It is going to be 8 divided by 5, 1.6. Yes, 8 is nothing but change in the security return divided by change in the market return. Simple, boss. Beta I am calculating in relation to market. That means market will always be in denominator. For 1% change in market, how much my security is changing. Simple. Is this clear, everyone? Okay. Look at this. In this example, we will see for different years. We will try seeing. Look at this. First year, market had given 10%. Second year, it gave me 12%. That means market has given me how much extra? 2% extra. When market gave me 2% extra, security gave me how much extra? 4% extra. So when market is giving me 2% extra, security is giving me 4% extra. I want to know if market changes by 1%, security will change by how much? 4 divided by 2. 2 times is going to be the change. Okay. Next year we will see. Market changed from 12 to 20. How much it increased? 8. Security increased by 16. So how many times? 2 times. 16 divided by 8. Yes, market reduced from 20, it became 10. It reduced by 10. This reduced from 36 to 16. It reduced by 20. That means the fall is how many times? 2 times. Change in security return divided by change in market return. From 10 it became 5. It fell by 5. This fell by how much? When market is falling 5%, security is falling 10%. How many times it is falling? 2 times. My beta is going to be 2. Is this clear, everyone? Okay. Now, when the slope is the same, directly I can calculate. But yes, when slope is different, now every day so many fluctuations can be there. It is not necessary every day the percentage change should be same. In that case, how do I do? Look at this simple example. In this case, yes, in our typical way we will see, then we will slowly try deriving the formula also. Look at this. When market gave me 10%, stock was giving me 16%. Okay, good. Yes, market started giving me 12%. That means market gave me 2% extra. Security gave me how much extra? 4% extra. That means how many times it is giving? 2 times. Okay, this I calculated. Market from 12 it became 14. How much extra it gave? 2%. Security, how much extra it gave? 2%. How many times it is given? 1 time only. Yes or no? It gave me 2% extra for 2% change in market. So that means here it is going to be 1 only. 14 to 18, it increased to 4%. Here 6%. That means how many times? 6 by 4, 1.5. Yes or no? Change in security divided by change in market. Yes, 18 to 10, it fell by 8. This fell by 10. How many times? 10 divided by 8, how much it is? 1.25. Yes or no? Tell me whether the change is the same, whether the slope is same. No, slope is changing every time. Slope is nothing but delta change, okay, in relation to something. Yes, it is not same. That means I cannot be using this formula. This is just a simple random this thing. Yes, randomly if I want to see, I can check. Say for example, randomly today morning I saw. Today morning randomly I am telling a number. Nifty is nothing but my market. Today morning my market has increased by 0.2%. Okay, same today I saw Reliance share. Reliance share has increased by 0.45%. Yes, just based on this data I want to calculate a rough estimate of beta. I will tell, okay boss, market is there, Reliance is there. When Reliance changes by 2%, this will change by 0.45%. Same direction, I did not worry. That means if market changes by 1%, Reliance will change by how much? 0.45 divided by 0.2. How much it is? 2.25 times. Okay, that's a simple calculation of beta. But in reality, so many factors are there. Over the long period, my beta will never be same. So, I will have to calculate the average of the beta. Now, how do I calculate that? Simple. When multiple years data is given, how do I calculate my beta? Formula is there. First, let us see the formula. Then we will slowly get a feel of what this formula is exactly trying to tell me. Okay, it's a very simple thing. Yes, to get a feel of the formula. Yes, beta formula. First, let us just see the formula. What is the formula? Sigma x divided by sigma m into RXM. What exactly on earth is it trying to tell? Simple. Yes, with a story, with a number, let us try understand. Yes, sigma x is 20%. What is the risk of x? 20% change will be there. Sigma m, market's risk is how much? 10%. RXM is how much? 0.7. Okay, great. Calculate beta of x. That is, if my market changes by 1%, x will change by how many percent? First, tell me, when market is having a risk of 10%, security is having a risk of how much? 20%. So, in a very simple way, can I tell my security is 2 times risky? Okay, boss. Sigma x divided by sigma m. Okay. Yes, when market is changing 10%, na, yes, security is changing 20%. That means 2 times it is risky. Okay. Step 1 I did. Yes, change in market, sorry, change in security divided by change in market. But tell me, here I have compared sigma x and sigma m. Tell me, sigma x, it is the standard deviation of security, which is nothing but the total risk of a security. In total risk, again, systematic is there, unsystematic is there. In beta, I am seeing the relationship of only systematic risk. Unsystematic, I don't want, boss. Yes, that means effectively, I have shown, yes, risk of x divided by risk of market. But in reality, I want systematic risk of x divided by systematic risk of market. Okay, boss. So, I got a simple feel that, okay, 20 divided by 10, yes, security is 2 times riskier than market. But this denotes the total risk. The total risk of security is 2 times when compared to market. I want systematic risk only, boss. Okay, fine. In my total risk, if I understand how much percentage of it is systematic, I will be getting my systematic risk. Suppose I am telling securities total risk is 20%. 50% of that is due to systematic factors, uncontrollable factors, market related factors. That means how much a risk is because of systematic factors? 20 into 50%, 10%. Okay, great. I ultimately want standard, yes, systematic risk of x divided by systematic risk of market. Now, aram se. Okay. Security x is there. What is the risk of security s? X. Sometimes it is very difficult to pronounce x. So, no, so much pain. What da? No x, huh? He listens to class in the morning. You don't know about him. Which girl? Okay. How do you survive? Because he gives her coffee. You give her, no? Okay. Okay, fine. Afterwards. No. Understand. Total risk of security X is 20%. Yes. RXM is given. Correlation of security with the market is given, which is 0.7. Now let us try understanding, getting a feel of what is this RXM. Yes, correlation of which and which? X and market is 0.7. That means tell me a very simple thing. When market is increasing, whether X will also increase? When market is decreasing, whether X will also decrease? Yes, but how many percent times on it will happen? 70% times on it will happen. That means X will change 70% times with market. That means 30% times it is not reacting to market, it is not going to change with the market. Okay, so understand, yes, risk of X is having a total risk of 20%. In that 70% of the time, change is coming because of which? Because of market. 30% time it is coming because of market. No boss, market is happening whatever. This does not care only. It is coming because of unsystematic company specific factors. Okay, so I'm telling, okay boss, X is having a total risk of 20%. Yes, in that 70% of that is coming due to market. RXM is 0.7. That means how much risk is coming because of market? 20 into 0.7, 14%. How much is coming due to company specific factors? 30% is coming due to company specific factor, which is going to be 6%. Okay, that means can I tell systematic risk of a security? It is a total risk into how much percentage is due to systematic factors. And how will I get the percentage of risk due to systematic factor? RXM. Is this clear? Okay, till here is okay, okay boss. So total 20% risk is there. Even after diversifying, 14% will still be there. This 6% you can diversify and eliminate. This is in relation to market now boss. How will you eliminate this? Okay, till here it is okay. So I am telling I want beta of X, which is nothing but systematic risk of X divided by systematic risk of market. Just to give you a very simple feel, suppose I am randomly telling, yes, systematic risk of market is 15. In relation to that, systematic risk of my security is 30. That means tell me, yes, my security is how many times riskier than market? 2 times riskier than market. Okay boss, I want systematic risk. It is nothing but total risk into how much percentage is due to systematic factors. Okay, so I want a systematic risk of X divided by systematic risk of market. It is nothing but a total risk of X into how much percent is due to systematic factors, RXM, divided by total risk of market into how much percent is due to market, RMM. Okay, till here is fine. Now understand one thing. Yes, security, individual securities risk, systematic is there, unsystematic is there. Unsystematic, if you create a portfolio, it will go away. What is a market? What is market? It is just a collection of all efficient good securities. It is already there in a portfolio. When portfolio has already happened means unsystematic risk is already eliminated. Tell me, in my market risk, whether unsystematic risk will be left? No boss, it will be eliminated because I created a portfolio na. That means in my market risk, only which risk will be there? Systematic only will be there. That means the entire market risk is what? Systematic only. That way I can go. Or else I know it is sigma m into RMM. Yes, correlation of a security with itself is always going to be what? 1 only. Yes, that means I will now tell, yes, it is systematic risk of X divided by systematic risk of market. Systematic risk of X, it is a total risk into how much percentage due to systematic factor RXM divided by, this is anyways sigma market. Yes, even if I multiply, it is going to be same only. Unsystematic is anyways eliminated. So I got my formula. It is sigma X into RXM gives me systematic risk of X divided by sigma M. That is going to be beta of a security X. Okay, okay. Logic is fine. Now how do we, yes, keep playing with this? Look at this. Simple. Now how do I derive this? Aram se. Beta of X, I will tell, yes, I want beta. Yes, for 1% change in market, how much my security will change? So it is always a change in X divided by change in market. For 1% change in market, I want, it will always be in, yes, denominator. Beta is denoting systematic risk. So it is systematic risk of X divided by systematic risk of market. Now how do I get systematic risk? It is a total risk into how much percentage is due to systematic factors divided by systematic risk of market. It is a total risk of market into how much percentage is due to systematic, full 100% is there. So you will be getting the formula sigma x divided by sigma m into Rxm. Is this okay? Yes, this is my first formula. Now just if I tweak this, I will be getting my second formula. Look at this, everyone. Yes, I am having sigma x divided by sigma m into Rxm. So I will also write as sigma x divided by sigma m into Rxm. Now tell me correlation formula. Correlation between x and y. It is covariance xy divided by sigma x sigma y. Yes, I want to know correlation between x and market. So Rxm, it is covariance of x with market divided by sigma x into sigma m. So instead of writing Rxm, can I also write covariance xm divided by sigma x sigma m? Okay, so instead of writing this, I will write covariance xm divided by sigma x into sigma m. Yes, now understand, sigma x sigma m x here gets cancelled. So what I will be left, covariance xm divided by sigma m into sigma m is sigma m square. So I have my second formula, which is covariance xm divided by sigma m square. So obviously we'll have to, yes, once we have logically understood, we'll have to scribble 2 times, 3 times, 5 times, then your hands will automatically start telling you guys the formulas. Now can we write down the formulas? Look at this, beta logically we'll do 1 or 2 more times, we'll repeat. Yes, things will be fine for us. Look at this, students. I want to calculate beta. Firstly, I should understand what is beta telling. For 1% change in market, how much percent my security will change? Only 2-year data is given, linear relationship, directly I can take only 2 years data. Yes, it's always, my denominator is always going to be market, because for 1% change in market, so it is a change in security return divided by change in market return. Okay, okay. Multiple years data is there. Yes, I want beta of x. It is nothing but systematic risk of x divided by systematic risk of market. Okay, if market systematic risk is 10, in relation to that security systematic risk is 15, that means okay, yes, security is 1.5 times riskier. Okay, systematic risk, how do I get systematic risk? It is a total risk into how much a percentage is coming because of market, sigma x into Rxm, divided by systematic risk of market, it is sigma m, if you want into RMM, which is anyways 1 only. So you've got this formula, sigma x into Rxm divided by sigma m, or sigma x divided by sigma m into Rxm. Now yes, I can tweak this and I can get a revised formula, covariance xm divided by sigma m square. Okay, okay. Now a logical understanding of the second formula also. Now mathematically we arrived at that, but based on feel, how can I feel the second formula? Okay, look at this. I know beta of a security, it is a change in security return divided by change in market return. Say for example, yes, I am telling my securities, my market's return has changed by 10%. At that time, my securities return has changed by 15%. That means how much times it is risky? 1.5 times it is risky. Okay, boss. Change in security divided by change in market. Now, this change in the return can be because of systematic also, can be because of unsystematic also. Beta is measuring only which factor? Systematic factors, that is market related factors. So I will write it as change in securities return due to change in market. Because market is changing, how my securities returns have changed, divided by change in market return due to change in my market. Now understand, change in the securities return, how my securities return is changing in relation to change in market. When market is changing, with that how my security is changing. Yes, when market has increased by 4%, security has also increased by 8%. Yes, this is x minus x bar, this is y minus y bar, or m minus m bar, is nothing but covariance of xm. Yes, change in market due to change in market. Yes, it is nothing but a variance of market. Yes, covariance of a security with itself is nothing but a variance of a security. Yes, that way I can do it. Or else one more way for me to do it is, okay boss, change in market, market change anyways. Yes, it is because of systematic factors only, but beta is a numerical value. Understand, my covariance is in terms of percentage square. If I want my ultimate value to be a number, denominator should also be percentage square. That means I cannot be taking standard deviation, I should be taking variance only. That way also. Okay, ultimately, see, ultimately, simple. Forget, understood, great. Otherwise also, yes, we know 2-3 times we will write. Okay, we will make through it. Simple, boss. Look at this. Beta of a security. 2 years data is given. multiple years data is given. Beta is telling for 1% change in market, how much percent my security will change. So base is always going to be market. Okay, boss. So here I will tell 2 years data is given. It is change in security divided by change in market. Yes, when market change 10%, security change 18%. Okay, 1.8 times. Okay, this is okay. Okay. Now just by keeping this, let me tweak and arrive at beta for multiple years. Yes, change in security sigma x divided by sigma m. But change in x, that is a total risk. I only want a systematic into RXM. Okay, fine. Or else if I want to tweak it furthermore, yes, I can also write it as covariance XM. It is in terms of percentage square. Yes, it is a net deviation of risk due to change in the market, covariance of XM divided by risk of market. Yes, which is again I want in terms of percentage square, which is nothing but sigma m square. Is this clear? 1 times, 2 times, 3 times we keep repeating. Okay, yes, our minds will start getting the habit of doing this. Is this clear, everyone? Okay, so based on this, look at this, students. Beta formula, yes, beta of individual securities, only 2 year data is given, change in security divided by change in market, multiple year data is given. First way of doing it is, yes, systematic risk of x divided by systematic risk of market. It is a total risk into how much percentage is systematic divided by market is anyways, yes, unsystematic risk is eliminated. Or I can also do it as covariance xm divided by sigma m square. Till here is this clear? So shall we do one or two questions on this? Okay, example 14 and 15. Okay, this is okay. Beta of a security we'll have to do. For this we'll have to calculate everything again. We'll do it one question. Okay, different ways we'll try doing it. Okay, 16, 20, 22, 16, 20, 22, 28, 18. Market is also given 10, 12, 14, 18, 10. Okay, fine. Now first let me try calculating expected return of x. Tell me summation x divided by n, 16 plus 20 plus 22 plus 28 plus 18 divided by 5. How much you are getting? How much? 20.8%. Yes, market's expected return 10 plus 12 plus 14 plus 18 plus 10 divided by 5. 12.8%. Okay, great. Now x minus x bar the whole square. Yes, m minus m bar the whole square. Yes, to calculate my beta, yes, I want to correlation. For that I have to calculate covariance, which is going to be x minus x bar into m minus m bar. Okay, so let me try calculating the deviation. Okay, in x I am expecting 20.8, but if I get 16 only, how much less it is? Minus 4.8. If I get 20, minus 0.8, 22 means 1.2, 28 means 7.2, 18 means minus 2.8. Okay, do a square and tell me sigma x square. 4.8 into equals 0.8 into equals 1.2 into equals 7.2 into equals 2.8 into equals grand total. How much? 80 point average. Yes, do not forget, we commit a mistake here. We do add, we write it finished off. That is why, okay, at least write formula and keep somewhere. Summation x minus x bar the whole square divided by n. That means how much it is? 16 point percent square. That means a standard deviation. Take a square root of 16.96. How much is it going to be? 4.12. Okay. M. Market I am expecting 12.8%. Yes, if market gives me 10% only, minus 2.8, 12 means minus 0.8, 14 means 1.2, 18 means 5.2, 10 means minus 2.8. I will do a square of this. 2.8 into equals 0.8 into equals 1.2 into equals 5.2 into equals 2.8 into equals 44.8. divided by 5. Do not forget this. 8 point percent square. So sigma m is going to be 2 point. Okay, fine. Okay. Now, with this, whether this much data is sufficient to calculate my beta, I want covariance, correlation also I want. Okay, boss. So let me try calculating the joint deviation covariance. Tell me, when x reduces by 4.8, this also reduces by 2.8. Okay, that means minus into minus becomes plus. Just to do this, how much it is going to be? 4.8 into 2.8. Yes, 0.8 into 0.8, 1.2 into 1.2, 7.2 into 5.2, 2.8 into 2.8. Everywhere symbol is, yes, same, only direction is same, so it will become plus only. You can just add and tell me the total value. .8 into 2.8, 0.8 into 0.8, 1.2 into 1.2, 7.2 into 5.2, 2.8 into 2.8. How much is it? 16.8. Therefore, my covariance XM, it is 16.8 divided by 60, 60.8 divided by 5. It is going to be how much? 12.16% square. Okay, let me try calculating my correlation coefficient. Yes, it is a net risk is how much when compared to total risk. It is covariance XM divided by sigma x into sigma m. Yes, individually it was 4.12 into 2.99, but overall when portfolio became, now it came to 12.16. 0.9 of 0.99. Okay, then in this case it is 1 only, I guess. 4, 2, 2. Okay, fine. Okay, fine. Now let us try calculating the beta. Two different ways we'll try calculating beta. Beta of x. Yes, let us again, yes, build in our mind beta formulas. Different ways. Only 2 years data is given, multiple years data is given. Yes, only 2 years data is given. Beta is always compared in relation to market. Market is the base. It is change in security divided by change in market. Okay, beta for multiple years. Yes, it is sigma x divided by sigma m. Yes, this is total risk, boss. I want systematic into RXM, or else if you want, you can also write it as covariance XM divided by sigma m square. Okay, fine. Beta of x, let me try calculating. The sigma x divided by sigma m into RXM. Systematic risk of x divided by systematic risk of market. Tell me, yes, x is having a total risk of 4.12. Yes, in that how much percentage, yes, is due to systematic factors? 0.99. So it is going to be 4.12 into 0.99 divided by market is having a risk of how much? 2.99. Tell me how much is it going to be? 1.36. Okay, yes, beta is just a number. Its interpretation is okay, it is 1.36 times the risk here. If market increases by 1%, ideally this should increase by 1.36%. If it reduces by 1%, it will reduce by 1.36%, so on and so forth. Okay, or else I also want to use another formula. Beta can also be written as covariance XM. What is the risk of x in relation to market divided by sigma m square? Tell me what is my covariance XM? 12.16 divided by sigma m square. It is 8.96. How much is it going to be? 1.36. Okay, fine. Now there is one more way for us to calculate beta. Sir, 3 formula only is too much, sir. Now understand, if in case you can absolutely ignore this formula, you will still get the answer, you will still be in a position to solve. But if in case question asks you just to calculate beta, or in an MCQ a question comes for you to calculate beta, you will have to do everything. Individually you will have to calculate the returns, risk, you will have to calculate covariance, correlation, then you will go to beta. If a 2 mark question comes, means okay, 15 minutes you will spend. That too, if somewhere one number is gone, means gota. Yes or no? So a shortcut formula is there. Now, not getting too much into the feel of this shortcut formula, Yes, this shortcut formula can be used only for historic data. That means past year data is given, only then I can use. If probability is given, I cannot use. Yes, it is using a technique called regression analysis. So much statistics and all previously was there, not getting into any of those things. Yes, what is the formula? Beta of x is sigma xm minus n x bar m bar divided by sigma m square minus n m bar square. Sir, we will take some more time, sir, no problem, that only is okay. Now understand, yes, we can get a feel of this. I am not getting into complete logic, but a feel for me to derive and keep the formula. Okay. Tell me, beta, two formulas are there. Forget 2 years data, multiple years data, two formulas are there. Sigma x divided by sigma m into rxm, or covariance xm divided by sigma m square. Let me go with the formula covariance xm divided by sigma m square. Let me slowly further develop and just get a feel of this. Tell me, covariance formula, covariance, joint deviation, it is summation x minus x bar, y minus y bar, here it is market, m minus m bar divided by n. Sigma m square, risk of market, it is x minus x bar the whole square divided by n, it is in market m minus m bar the whole square divided by n. Okay, now suppose I am having 1 divided by 2 divided by 5 divided by 2. I can directly write it as 1 divided by 5. Don't believe me, take your calculator. 1 divided by 2 is 0.5 divided by 5 divided by 2 is going to be how much? 2.5. 0.5 divided by 2.5 is how much? 0.2. Directly 1 divided by 5 is how much? 0.2. Both places divided by n is happening. So if I want to, what I can do, I can write it like this also. This becomes my third formula if I want. Okay, but I will not be using this. Now based on this, I will just try tweaking and get a feel of how do we keep the formula in our mind somehow. Okay, not getting into regression, best fit, least squares, equation, none of those things. You forget this, it is absolutely fine. You can go with the long approach if you want a shortcut. Okay, now understand. Okay, I would have written here. I want to calculate summation. If data is different, means I have to individually add. If data is the same, means I can directly do, yes, the number into number of times that data is there. Just a simple feel. I am telling 5 years written is there, 10, 15, 20, 25, 30. Yes, I want to do addition, summation I want. How will I do? Individually I will add. Okay, 100 I got. Yes, assume, yes, I calculated based on this, yes, average, it is 20. Every year I am putting 20, 20, 20, 20, 20. How much total I will get? 100. But this alternatively, can I also write it as n into m bar? Tell me, average is how much? 20. Like that, for how many years it is there? 5 years. That means total should be how much? 100 over x is different. You have to individually do the summation. Yes, average is there, means if you want you can do n into the average, you will get the summation. Yes, just to look at this and get a feel of the formula. Look at the formula. I am having summation x minus x bar into m minus m bar divided by sigma m minus m bar. Now look at this, how will I write? Yes, slowly I will just tweak it and write it. Summation. Okay, yes, here first one with first one, second one with second one. Yes, x with m, I will write summation xm minus, yes, it is going to be x bar m bar. I want the summation of that. I can also write it as n x bar m bar. Yes or no? Because it is average, I can do, yes, average into number of years. Yes, divided by, yes, this is individual number, so it is sigma m square. Square is happening here. Yes, minus, this is, yes, sigma m bar the square. I can write n into m bar square. Okay, a feel. If you have got it, you have got it. Otherwise, formula is there, summation xm minus n x bar m bar divided by sigma m square minus n m bar square over. Okay, that is the feel of the formula. If you want, okay, a way for me to at least to know exactly what is happening in the world. Okay, otherwise 4 or 5 times you write, okay, on a piece of paper, 6th time you will reasonably write it. But if you have a feel, you will be in a position to write it a better way without taking any risk. Otherwise, in the exam center, you will get divided by m bar x bar. And 99% of the time, at that particular moment, your mind will give you wrong answer only. Okay, after that, it will tell you right answer. Okay. So, yes, what I'm telling, yes, just a final time. Okay, it is covariance xm divided by sigma m square. Covariance xm, it is summation x minus x bar m minus m bar divided by n gets nullified, summation m minus m bar the whole square. Okay, m minus m bar the whole square. If I want, I can do m minus m bar into m minus m bar. Again, I can play. Okay, leave it. Now, simple. First one with first, second one with second. Whenever I'm having average, directly you can do n into that. Okay, sigma. First one with first, it is x into m. Minus is there here. Okay, minus. Yes, averages I am taking. Yes, if I want, I can write sigma x bar into m bar. That in a simple way I can write n into x bar m bar divided by, yes, sigma m square minus m bar. Whenever I am getting m bar, I will put n into m bar the square. This is going to be my formula. With that, if I am doing means quickly takka my answer I will be getting. If I just want to calculate beta, other data I want, I cannot use. Probability is given, I cannot use. If just the question comes on calculation of a beta, if you want, you can do it like this. Now look at this. X is there, m is there. Xm, m square. Story will be over. Tell me x into m you do, you tell me the total. 16 into 10 equals 20 into 12 equals 22 into 14 equals 28 into 18 equals 18 into 10 equals. Summation is going to be how much? One three nine 2. Okay, sigma m square is going to be how much? 10 into 10 100, 144, 14 is how much? The 196. 18 is 324, 100 how much? 8 64. Then I want x bar and m bar. Tell me x bar is how much? 16, 20, 22, 28, 18 divided by 5. How much? 20.8. This is going to be how much? 12.8. Okay. Yes, beta of x, it is covariance xm divided by sigma m square. I will slowly, for me to get the understanding of what is happening, I will do it like this only. Trust me, I cannot keep that formula in my mind. Okay, I will just play with this. 10 seconds I will play, but my answer will be fast. Yes, it is x minus x bar m minus m bar divided by n gets nullified divided by sigma m minus m bar the whole square divided by n gets nullified. Okay, boss. Now I will just play based on this. Look at this. Sigma, first one with the first one, xm minus second one with second one. Yes, it is x bar m bar. Here I will do into n divided by sigma m square minus m bar square n into m square. Okay, formula is there. Sigma xm is how much? 1392 minus n. How many number of years data is given? 5. X bar is 20.8. M bar is 12.8. If despite doing this, if somewhere in the calculation, if you have done error, na. Okay, sigma m square, it is 864 minus n into m bar square. N is 5 into m bar is how much? 12.8 square. Aram se will do. Yes, 5 into 20.8 into 12.8 equals minus 1392. How much you are getting? Tell me. Simplify and tell me the final value. You do whatever in the world. How much? No, final. Numerator divided by denominator. 1 point. Bachao. If you had told other value, na, I would have gone. 1.36. 1.36. 1.36. Okay. If you can retain this in your mind, okay. Otherwise, see, you can spend some more time also. No issues. Only for a descriptive. Okay, normally if it comes for your, sorry, if only for your MCQ, if it comes for your descriptive, anyways for 8 marks, they'll ask everything. You have to do everything. Okay, for a MCQ question, if question only asks you to calculate a beta without giving you a data, if you want x, m, xm, m square, based on that I can finish it off. Sometimes question asks you calculate data beta by giving you 10 years data. That time there is a huge risk of you committing a mistake. Only at that time, if you want, you can do it. That too, if you can feel and aram se do it. Simple covariance xm divided by sigma m square. Based on that, you will tweak, divided by n, you will eliminate first one with first one, second one with second one. Yes, whenever m bar is there, you will do n into that. Whenever average is there, you will just do n into average. Simple. Over. Okay, everyone. Okay. Yes, future data is there. I want to calculate beta. Can I calculate? Yes, but can I use the shortcut formula? No. Yes, it is a regression analysis, past data analysis. Yes, line of best fit, based on it has come. You cannot be using shortcut formula for future data. Simple point you should always be having on the back of your mind. Yes, you will do all the calculations. Numbers I am not getting into. Probability you will put, x you will put, x minus x bar. Yes. Sorry, firstly you have to get your p into x. Expected return of x you will be getting. X minus x bar, p into x minus x bar the whole square. Yes, this will give you the variance of x. Then market is there, p into market gives you the return of market. M minus m bar, p into m minus m bar the whole square. This gives you the variance of market. Covariance you want, p into x minus x bar into m minus m bar. This gives you covariance of x with the market. Based on this, yes, based on this also you can calculate, or calculate correlation x with the market. It is a net risk divided by total risk. Covariance xm divided by sigma x, sigma m. You calculate. Based on that beta, now however you want you can calculate. Yes, either sigma x divided by sigma m into rxm, systematic risk of x, total risk into percentage, which is systematic divided by, yes, change in market, or covariance xm divided by sigma m square. With the practice only, yes, the mistakes will be reduced. You will commit mistakes, trust me. Okay, you will see, you will tell, Jujibi, I will do it any given day. You will commit mistake and come. Okay, yes. This in a different way they have asked. Okay, fine. Yes, beta calculation, is it reasonably fine? Okay, understood. Beta formulas, shall we write it one more time? Okay, yes, this is beta is over means calculation of beta is over means, okay, expected portfolio beta is simple, systematic risk in percentage is simple, then comes the CAPM. Okay, whatever we thought we will be doing it today, we will finish it off. Okay, fine. Okay, concept 1 I am keeping it aside, end of the day we will revise it one more time. Yes, concept 2 capital market line I am not touching. Concept 3 CAPM and beta by William Sharp. Yes, William Sharp is telling, boss, till now everything I did based on total risk, but in that unsystematic is company specific. Now you diversify. It means everything I will be doing only from the perspective of systematic risk. Systematic risk I will be calculating in terms of beta. Now, yes, first, what does beta tell? My beta tells my security is how many times risky when compared to market. Beta is 2. It means my security is 2 times risky than market, boss. Okay, boss. Yes, important thing is calculation of beta formula. Yes, only 2 years data is given. Your mind should always tell you, yes, multiple years data is given. Only 2 years data is given. Beta is always calculated in keeping market as the base for 1% change in market. Only 2 years data is given means it is a change in security divided by change in market. Okay, multiple years data is given. I want a systematic risk of x divided by systematic risk of market. Systematic risk of x, total what is the risk, sigma x, into, in that how much percent is due to systematic factors, into rxm divided by systematic risk of market. Total what is the risk of market, in that how much percentage is due to market factor. Boss, it is 1 only, na? Right, also it is fine. They have eliminated, they have given us shortcut. We don't understand what exactly is happening here. Okay, this is my formula, sigma x divided by sigma m into rxm. Or else I want to tweak it a bit. I can also tweak it. I am telling I want to change in security due to change in the market, which is covariance X with market divided by change in market due to change in the market, which is sigma m square. Okay, yes, third formula also I got. Yes, next formula, if I don't know, it is absolutely fine. World is not going to be upside down, but if you feel you may remember, it is okay. Covariance formula only I will play with it. Yes, covariance is sigma x minus x bar m minus m bar divided by n gets nullified. Sigma m square is m minus m bar the whole square. Okay, now look at this. Aram se. Yes, first one with first one. Yes, individually numbers are there, means I have to do the summation. Summation xm minus, yes, x bar m bar is there, that means I will directly, yes, do into number of years, n into x bar m bar divided by, yes, sigma m square is there, yes, minus, here m bar is there, means obviously n into m bar, it is in terms of square, n into m bar square. This is the only way, otherwise you have to keep by hearting, and that also there is a huge likelihood of committing a mistake. Tweak it a bit, in a minute you will be somewhere getting a, yes, feel of the formula. Okay, yes, these formulas we have done. Okay, we will see that question, portfolio beta, calculation of systematic risk. Okay, this one beautiful question we will see. Okay, look at this, students. Okay, fine. Yes, SEBI is there. SEBI is investing in 3 different securities. Now understand, market price per share is given, number of shares is given. Now for this portfolio beta we have to do. Okay, first we'll understand portfolio beta, then we'll come back here. Okay, beta of individual securities I calculated. Now I have to calculate my portfolio beta. Simple, don't worry, nothing more is there. Portfolio beta is nothing but weighted average. Understand, portfolio risk, was it weighted average? No boss, it was not weighted average. Why? Because due to diversification, due to correlation, some risk was reducing. Which risk is reducing? Unsystematic is reducing. Systematic will reduce. No. Portfolio beta, beta is a measure of systematic. You create a portfolio, whether systematic reduce will fall. No boss, it will be weighted average only. Yes, it is nothing but weight of A, beta of A, weight of B, beta of B, so on and so forth. It is nothing but weighted average. Only when I am calculating the risk, reduction will happen. Everywhere else it is weighted average only. Yes, it is weight of A, beta of A plus weight of B, beta of B, so on and so forth. Okay, fine. Look at this. Investor is having 10 lakh rupees. Okay, Reliance, Tata, think with Tabish, 5 lakh, 3 lakh, 2 lakh. Proportion I have taken 50%, 30%, 20%. Beta of security, yes, Reliance is having a beta of 1.2. What does it mean? It means beta, yes, Reliance is having a risk of 1.2 times when compared with market. Tata may change 1.5 times with respect to change in market. Think with Tabish may change 2.2 times. Okay, what is portfolio beta? Simplest thing in the world for me to do. Tell me. Yes, in Reliance, yes, what is a beta? 1.2, but I have put only 50% money there. Yes, in Tata, how much is beta? 1.4, but 1.5, but I have put only 30% there. In think with Tabish, it is 2.2, but I have put only 20% there. So tell me what is going to be beta of the portfolio? 1.49. Online students, alive na? YouTube live. There is one Zoom live also that I forgot only. Okay, 1.49. Yes, total risk will reduce to diversification. Systematic will not reduce, boss. It will be same only, weighted average only it is going to be. Okay, fine, great. Now, based on this, there is nothing in portfolio beta. Beta calculation, individual beta is going to be difficult. Portfolio is just weighted average. Now, look at this one simple, yes, question. Beautiful question this is. Okay. I have to calculate portfolio beta. Tell me, for calculating portfolio beta, I want beta of portfolio. It is weight of A, beta of A plus weight of B, beta of B plus weight of C, beta of C. Weight is always going to be the investment. Market price per share is there. A, yes, 100 share I purchase. Every share at what price I purchase? 1000 rupees. If you multiply, will you be getting your investment? Based on that, can you be calculating your weight? Yes or no? So look at the structure. Yes, first, yes, security market price per share, number of shares. You multiply, you will get your investment. Add, you will get total investment. Based on that, I will get my weight. Okay, weight I got. This is not a challenge. Challenge for me is to calculate beta of my security. Let me see how I will calculate beta. Look at this. Other information is given. For A, beta is directly given 1.5. No tension. Okay. For B, what is given? Standard deviation is 18%. RBM is 0.55. Yes, I guess standard deviation of market is given 10%, risk free is 7%, market portfolio return is 15%. Okay, let me try calculating beta of B. Tell me what is the total risk of B? 18%. In that, how much percentage is due to systematic factors? 55% only, 0.55. That means systematic risk of B is going to be how much? 18 into 0.55, 9.9 divided by, yes, sigma market, risk of market is how much? 10.99. Yes or no? Yes, sigma x divided by sigma m into RXM, 0.99. Okay, first one is 1.5, 0.99. Third one, let me see what is given. Yes, covariance XM is given. So that means based on that, how will I calculate beta? It is covariance XM divided by sigma m square. Okay, 188% square to eliminate denominator also I want percent square. It is a 10 square 100, 1.88, 1.88 beta. I will just do weight into beta. This is going to be my portfolio beta. Obviously, practice is something you have to do for yourselves. Okay, yes, but a beautiful question. Expected return of individual shares as per CAPM, expected return of portfolio. Okay, systematic. Okay, in percentage terms. Okay, we'll come to that. Okay, 3 parts are over. Part 4, part 5. In that part 4 is just jujube, just for me to get a link to sharp single index model. I am telling. Okay, calculation of systematic risk. Tell me, how do I measure my systematic risk? In terms of beta, I am measuring. But beta is just a numerical value. I want to calculate my systematic risk in percentage terms. How do I do that? Simple, just to get a feel of this. Okay, no question will come from this, but for me to understand sharp single index model, this understanding will be useful. Okay, this is just done from understanding perspective, not for examination. Simple, beta of a stock is 1.8. That means my stock is 1.8 times riskier than market. Suppose market is having a risk of 5%. That means stock will have a systematic risk of how much? Look at this, beta is 1.8. That means market, stock. Beta is 1.8. That means if market changes by 1%, stock changes by 1.8%. If market changes by 5%, stock will change by how much percent? Yes, 5 into 1.8, 9%. Yes, this can I tell? It is nothing but beta of x into sigma market. Yes or no? Yes, sigma market. Market is having a risk of how much? 5%. Yes, my securities risk is how much? Mine is 1.8 times, na boss. Market is having 5% risk. Mine is 1.8 times. That means mine is how much? 5 into 1.8, 9% risk. Is this clear? Got a feel of this? Yes, look at this. Simple. Beta is 1.8. It is 1.8 times riskier than market. If market changes by 1%, if market changes by 1%, mine will change by 1.8. Market is changing by 5. That means mine will change by how much? 1.8 into 5. 9%. It is a beta of x into sigma market. Market will change by how much? Mine is changing how many times in relation to that? That tells me my security is systematic risk. Okay, this if I do a square will be the systematic risk in sharp single index model. That is going to be the base there. That is why I've told. Look at this, simple. Look, you can look at this also. Now, two different situations. Market is increasing by 10%, market is reducing by 8%. Based on this, let us try getting. Okay, my beta is having, yes, my securities beta is 1.8. That means my security is moving 1.8 times in relation to change in market. If market increases by 10% means my security will change how many times? 1.8 times. So it is 1.8 times of 10. 18% my security will increase. Market, thadam, it fell 8%. Mine will also fall, thadam, more it will fall. Yes or no? How many times? 1.8 times of 8, how much it is going to be? 14.4% it will fall. Okay, beta is 0. Market increase 10%. What will happen to my security? Nothing, it will be there only. Yes or no? 0 into 10, 0. Market fell 8%. Mine is risk free, boss. Will not change only. Beta is 3.5. Oh my god. Security will increase. Sorry, market will increase 1%. My security will increase 3.5. It will fall 1%. Mine will fall 3.5%. Okay. If market increases by 10%, mine is 3.5 times the change. It will increase by 35%. Oh my god. Very happy. Yeah? Look for the downside also. If market falls by 8%, mine will fall 3.5 times. How much it will fall? 28% will be the fall. Yes, 1.5 times risky. Market increases 10%. It is 1.5 times of that. 15% will it increase. What? Oh, sorry, it is minus. Okay. Sorry. I did not read only minus. Okay, I just did 1.5. Okay, fine. That means market is increasing. Mine is negative. Mine will go ulta. Mine will reduce. How many times? 1.5 times. Market will change 10 means this will change 15. Okay, market is falling. Mine is ulta beta. Mine will increase. How much times? 1.5 times of market. Yes, it is 8 into 1.5 is 12%. Yes. What is the change in market? My security will change how many times in relation to change in market? That tells me by how much my security will change. A systematic risk of a security X in percentage term, it is beta of X into sigma market. Market will change how much? In relation to that, my share will change how many times? That will tell, yes, my security will change how much percentage. Okay, just got a feel. I don't want anywhere else. Just for sharp single index model, I want that. Okay, so I've just kept it here. Okay, let it be there somewhere in the end. We will use it subsequently. Okay, then comes the final thing, capital asset pricing model from inter days only. Yes, we have been learning. Okay, now capital asset pricing model, the logical meaning is something I don't need to tell. Anyone by looking at that, they'll get a feel of what it is. Yes, there's a historical derivation as well from 200 years, how that is derived from Markowitz to capital market line to CAPM. From exam perspective, not important, but a beautiful derivation. Because I have not explained CML, it becomes difficult for you guys, so leave it. Okay, I will just tell you guys, yes, the logical derivation in 2 to 3 minutes. Yes, why I will be using capital asset pricing model. Yes, it is used to calculate the required rate of return on a security or a portfolio. How much I should be getting. Okay, yes. Tell me, Sharp has told that, yes, premium I am going to demand based on total risk or systematic risk only. Systematic risk only. Unsystematic you eliminate, na, you diversify. That means I will demand premium by taking only beta. Okay, a simple example is there. Based on that, let us logically try understanding what this CAPM equation is trying to tell. Okay, yes. Investor wants to analyze the required rate of return based on the following information. Risk free is 6%. I don't take any risk. How much I'll get? 6%. Market is giving me 12%. Security is having a beta of 1.5. Based on this, slowly let us try understanding. Investor is there. Yes, investor is telling, I don't take any risk at all. How much I am getting? 6% I am getting. So I invest anywhere in the world. How much I should get? 6%. In any case, I should get, even if I don't take risk. Okay, boss. I go to market. Yes, in market, am I taking risk? Yes, I'm taking risk. Whether market is giving me a premium? Yes, boss, it is giving. Tell me, market is giving me how much return? 12%. That means if I invest in the market, how much extra return I will get? 6% extra return I will get. Yes or no? But risk is there. Risk is there. Beta of market is 1 time. For taking 1 unit of risk, for taking 1 unit of beta, I am getting 6% extra return in the market. Okay. Yes. Tell me, I don't take any risk in the world. How much I want? 6% in any way I want. But if I invest in the market, how much extra I am getting? Risk free was giving me 6. Market is giving me 12. That means 6% extra return I am getting. For how much extra risk taken? For 1 unit of risk taken. Okay. Okay. Now I am telling invest in this security. Okay. Think with Tabi share is there. I am telling invest in that. I am asking, yes, what is the beta? What is the risk in that? It is 1.5 times riskier than market. Tell me. Yes. For taking 1 unit of beta, how much premium, how much extra I am asking? 6% extra I am asking. Yes. Security is how much times riskier? 1.5 times riskier. That means how much extra how much I will be asking? 6 into 1.5, 9% extra I will be asking. Yes, that means total how much I will be asking. I will tell boss, in any case risk free I want, plus I want the premium for taking risk. Yes, even without taking risk, how much I should be getting? 6% I should be getting. Now risk, if I take 1 unit of risk in the market, market is giving me how much extra? 6% extra, but I am taking 1.5 units of risk. Na? That means I should be getting 1.5 into 6, 9% extra. 6 plus 9, I should be getting total 15%. Okay, this only, yes, I can, yes, create in the form of a formula. Look at this. Yes, required return on a security. Even if I don't take any risk, what I should be getting? Risk-free rate of return, plus because I am taking risk, what I should be getting? Premium I should be getting. I should be getting a risk premium in the security. Okay, it is a risk-free rate of return. Yes, how do I arrive at my risk premium? I will first tell, market is giving me how much premium? RM minus RF. Yes or no? Risk free is giving me 6%, market is giving me 12%. That means market is giving me 6% extra for taking 1 unit of risk. My security is having how much times risk? 1.5 times risk. That means I should be getting 1.5 times extra return. So I should be getting, yes, 1.5 into 6, 9% extra return. 6 anyways basic I want. So total I should be getting 15% return. That is a simple understanding of CAPM. This is something, okay, looking at the formula only we get a feel, yes or no? Yes, I want a risk free plus premium I want. This is in the market. My security is how much times riskier into beta is going to be my CAPM. Okay, CAPM equation is something, yes, even a bacha will be knowing the equation. There is no way you will forget this equation at least in your lifetime. Yes or no? Even if you are in a death bed, they will ask you CAPM or you will tell, because from foundation inter you will be, yes, knowing one thing only, CAPM. Yes, RF plus beta into RM minus RF. Okay, fine. Not getting too much into detail. Okay, this is a beautiful historical derivation of that, not getting into that. Now, required rate of return. I want on the individual security, I want on the portfolio. Simple. If you want on the security, means you put beta of security. If you want on portfolio, means you put beta of portfolio. Story is over. Yes or no? So if it is on the security, means you are going to put the beta of security. If you want on the portfolio, means you will be putting beta of portfolio. Sir, how will I get beta of portfolio? What is beta of portfolio? It is nothing but weighted average beta. Over, story over. Is this clear, everyone? Okay. Now, here different adjustments of all questions have compiled. Okay, if you do just this, you will understand exactly what all different variants of questions will be there. Okay, now let us quickly summarize concept 3 that we are discussing. Yes, it is CAPM and understanding of beta by Sharp. What did Sharp tell? He is telling premium you ask boss, but not based on total risk, but based on systematic risk only. So everything is based on systematic risk. How will I measure systematic risk? Using beta. First one is a calculation of beta. Yes, if my beta is 1.5, what does it mean? It means my security is 1.5 times riskier when compared to market. Okay, boss. How do I calculate beta? Calculation of beta, only 2 years data is given, multiple years data is given. Only 2 years data is given. Yes, beta is always calculated in relation to market, keeping market as a base. Yes, it is a change in security return divided by change in market return. When market changed 10%, security changed 15%, boss. 1.5 times risk is there. Okay, multiple years data is there. Yes, beta, it is a systematic risk of X divided by systematic risk of market. Okay, systematic risk of X, it is a total risk of X into how much percentage is due to systematic factors divided by total risk of market. Market anyways it is systematic only. Yes, unsystematic is anyways eliminated because it is a portfolio already, or into RMM, which is nothing but 1. Okay, this is one formula. Based on that I can create one more formula, covariance XM divided by sigma M square. Yes, if you want a shortcut, but the most important thing before you apply shortcut is the awareness that you can use it only for past data. I am telling this because with probability you will put, it will be gone. Okay, only for past data. Yes, I will just tweak this, covariance XM divided by sigma M square. Covariance XM is X minus X bar, m minus m bar divided by n, you forget, this is sigma m minus m bar the whole square divided by n gets eliminated. It is first one with first one, second one with second one. Yes, summation xm minus n into x bar m bar divided by, yes, first one sigma m square minus n into m bar square over, yes, this is my formula. Yes, how will I put? Simple boss, x m, x into m, m square over. Based on this you will be getting your beta. Okay. Beta calculation is over. Based on beta calculation, I just told a simple understanding of systematic risk in percentage terms. Yes, market is having a risk of 10%. My security is 1.5 times risky. That means my security's risk should be how much? 1.5 times of 10-15%. Yes, it is beta of x into sigma market. That will be giving me my systematic risk in percentage terms. Nowhere I'll be using the formula, just for me to derive, yes, sharp single index model only I'm using this. Okay. Yes, based on this CAPM we came, CAPM equation, the required rate of return on a security, yes, as suggested by William Sharp. Yes, risk free anyways I want a premium for taking risk. How much a premium? RM minus RF, that is a premium in the market. Mine is how much times riskier into beta. If I want for individual securities, take beta of individual securities. If I want for portfolio, take beta of portfolio. Okay, wow. Till here things are fine. Okay, now in different places what all adjustments ICA is given. First is calculation of risk-free rate. Risk-free rate, yes, it is a rate on risk-free securities, treasury bills, treasury bonds, government securities, wherever question gives, that is risk-free. Okay, now if risk-free rate is not given in the question, but some extra data is given, I can calculate. Look at this example. Question is telling 7% treasury bill is trading at 140 rupees. Treasury bill is there, risk-free security is there. At what price it is trading? 140 rupees. It is giving me how much a return? 7% interest they are giving. Tell me, interest is always calculated on which value? Face value or market value? Face value. Okay. Yes, nothing is given. Face value of a, yes, security is 100 rupees. Security valuation basics. Okay. Market is telling, boss, I will give 7%. On how much I will give? On 100 rupees I will give. That means how much interest I will be getting? 7 rupees interest I will be getting. By putting in how much money? 140 rupees I will put, I will get 7 rupees. So I will get 7 rupees by putting 140. That means what is my risk-free rate of return? 5%. Yes, I can also write. Yes, this is a formula of your security valuation. It is coupon payment, interest payment. On 100 I am getting 7%, 7 rupees I am getting by putting in 140 rupees. That means how much percent return I am getting? 5% return I am getting. Is this clear? Yes, one question adjustment is this. Okay. Other question is giving me 2 or more risk-free rates. Yes, question is telling me, yes, interest on treasury bill is 5%, interest on government security is 5.5%. Small deviation could be there. Which one I will take? R 5 or 5.5? Take average risk-free. Normally given in the question. If not given in the question, one of the two adjustments. 2 or more RF is given. Take an average of that. Or question is telling you, yes, market price based on that coupon payment is specified. Yes, coupon payment divided by market price gives you your RF. 7% on 140, yes, which is trading at 140. 7% interest will be getting on 100 rupees, that is 7 rupees on 145%. Okay. Then comes adjustments on calculation of RM. RM is given in the question, great. Not given in the question, what to do? Yes, data is given, calculate CAPM, that was there in Inter. In Inter also now they are not asking. Okay, don't expect just a CAPM equation, you will put RF plus beta into RM minus RF. RF also they have given, RM also they have given, beta also they have given. You just put the equation, 8 marks at least. You are in finals. Yes. When I am telling market from the perspective of India, Indian stock market, yes, what does market refer to? Nifty or Sensex. Okay. Yes, RM is not given in the question. But for me, market related information is given to calculate RM. Okay, based on that, how will I calculate? Tell me students, yes, I invest in a security. Simple. I am telling market. Market's value is determined based on points. Yes, Nifty index, yes, points. Yes, market has moved up by 200 points. Yes, the creation of index, the concept of points. Yes, why it has come, how Sharpe has derived that. Yes, capital market line, that thing is there. For now, for exam, not required. Now, simple I am telling. Is you market is a portfolio of all securities. Yes, Nifty is there. It is a combination of how many securities? 50. That I am taking it as market. Now, yes, full stock market's value could be something like 4539875, some 16 digit is there. Tomorrow from that some change happened. Will you understand exactly what is happening? Who will understand? So for that, for relative terms, one random day, yes, they decided, okay, BSE decided, okay, Sensex will start at 1000 points, Nifty decided will start at 100 points. Based on that, the concept of points came into picture. Okay, now understand, year starting, yes, my Nifty is randomly assumed at 100 points. Year ending, Nifty reached 140 points. That means, can you tell me your Nifty, your market has given me how much percent returns? Yes, it has increased by 40 in relation to 100. It has given me 40% returns. Okay, okay. That means whether market has given me 40% returns, yes or no? No. Why? This index value is calculated based on market price. That means here only change in price or capital appreciation is included. My total return will be what all? It will be dividend plus capital appreciation. Okay, my index will not tell me how much dividend every security has given. Okay, so how question will give you? Dividend yield as a percent separately it will be giving you. Opening index value, closing index value it will give you. Based on that I will calculate. Simple boss. Yes, total return it is nothing but dividend yield plus capital appreciation percentage. Dividend yield will directly be given for you in the question. I will write it. Capital appreciation, it is P1 minus P0 divided by P0 into 100. Yes, here I am calculating for market. That means I will be given with the index values. P1 means closing index value. P0 means opening index value. Story over. As simple as that. Look at this, students. Index value at the start of the year is 21,000. That means year start how much it is? 21,000 is there our Nifty. Year end it reached 21,850. Yes, calculate the market return if dividend yield is 4.75%. Okay, boss. I will tell market how much it has given. Yes, dividend how much it has given. Yield is always calculated on my investment market value. Yes, plus capital how much appreciation has happened. Dividend 4.75% it has given. Capital appreciation 21,000 was there. It reached 21,850. That means 850 it increased. From where? From 21,000. That means how much percent it increased? 850 divided by 21,000. 4.05% is the capital appreciation. Dividend is how much? 4.75. That means total is going to be how much? 8 point percentage. Okay, this is one variant. Okay, question will not give you RM. Question will give you opening index value, closing index value. Based on that you will get capital appreciation percentage. On that you will add a dividend yield percentage. You will be getting total return of the market. Second variant, very dangerous. If market related information is not given in the question and cannot be calculated. First one, data was given, they had not calculated it. Market related data only is not given. In that case, what to do? Now understand one very simple thing. There are going to be three different answers. One is the right answer, one is the wrong answer, third is the ICA's answer. Market related data only is not there. No mathematician in the world can calculate market return. Market data only is not there. How you will calculate? ICA told, what nobody can do, we will do. What is beyond human logic? There comes ICA's logic. ICA tells, we are having a portfolio now. That portfolio only will think it is market. But boss, it is my portfolio. My portfolio, different shares, different risk, different beta. No, I will assume it is market. But how we can assume? Because we assume. What if we don't assume? Don't assume, wait for 6 months. Okay? Yes. Openly you can, yes, open your eyes and see. Beta is also given. You will understand it is not a market. But concept aside, ICA is doing means we should also do. Or else wait for 6 months. Okay, simple point. Look at this important assumption by ICI. If market related information cannot be calculated, we will assume that our portfolio is a representative of market. Our portfolio only is market. That means how much my portfolio will earn, that is market's return. Based on this only I should go. There is no way out. And how will I calculate how much my portfolio has earned? Simple. Return is nothing but a dividend plus P1 minus P0 divided by P0 into 100. Yes, where D is the total dividend on all securities in my portfolio. Different securities will be there, number of shares will be there. On total basis, you will do total how much dividend I received. Total closing market value is how much. Total opening market value is how much, divided by total opening market value. That will be giving me my return of the market. Look at this very simple example. Investor's portfolio consists the following securities. A is there, B is there, C is there. Yes, A's opening market value is given, B, C, closing market value is given, dividend is given. Simple, tell me total opening market value at the start of the year for the portfolio is going to be how much? 1,10,000 plus 2,70,000 plus 6,20,000. How much it is? 628.90, 10 lakh. 10 lakh we had invested at the start of the year end how much it became? My portfolio 10.5, 11.9 lakh it became. With that some dividend also we got on our portfolio. How much? 30, 50, 60,000. So tell me what is the return my portfolio is giving? I am telling boss, in my portfolio na, yes, 10 lakh has become 11.9 lakh, 1,90,000 capital appreciation I got, 60,000 dividend also I got, total 2,50,000 I got on how much? On 10 lakh. That means 25% my portfolio has given. That is what I am understanding. But when I am writing, what I will write? This is what market has given. And the best part is based on this RM, I will again calculate return of portfolio. I say things, just I say things. Okay. But if you have to pass means that's the only way we can do it. Okay. Yes, CAPM, yes, understanding of CAPM, any GGB person will also be doing it for us. Adjustments are going to be important. Okay. Yes, CAPM, tell me what is going to be CAPM equation? A required return. It is a risk-free rate of return plus beta into RM minus RF. Beta, if I want for individual security means securities beta I will take. If I want for portfolio means portfolio beta I will take. How will I get portfolio beta? It is weighted average. Risk-free rate of return. Given in the question, great. Not given in the question, but coupon payment and market price is given. Okay, it is my coupon or interest divided by market price. 2 or more RF is given. Take average of that. Yes, RM is not directly given in the question, boss. How do I do that? First, market related information is given to me. Market's index values are given to me. Okay, I can calculate. I will tell, yes, market return, it is nothing but a dividend yield percent plus capital appreciation percent. Dividend yield percent will be given to me. Capital appreciation, index closing value minus opening value divided by opening value. It will give me my market's return. Boss, market related data only is not there. Still I want to calculate. Yes, not given. I will assume my portfolio is a market. So I will calculate my portfolio's return, but I will write it is the market's return. It is a D plus P1 minus P0 divided by P0 into 100. D is the total dividend on my portfolio. P1 is the closing market value of all securities on my portfolio. P0 is the opening market value of all securities on my portfolio. Okay. Okay, great. Okay. Is the last. Okay, last one point we will do. Okay. If RM and RF both are missing in the question, but to compensate for that, some extra additional data is given for me. Okay, look at this. RM, RF both are missing in the question, but question gives us for two different data, for two different securities, for two different risk, required rate also, beta also. Look at this simple question. Question is telling me security A na 1.5 beta is there. For that the required rate is 20%. For B, beta is 1.8. For that the required rate is 23. Calculate RM, calculate RF and calculate required return if my beta is 2.5. How will I do that? Simple, two data is missing. Yes, remember one very simple principle in life. If one person goes from your life means other person will come to your life. Two data is not given, RM is not given, RF is not given. To compensate for that, two extra data is given. For two different securities, required rate and beta is given. Based on that, I can create a simultaneous linear equation and solve. Simple. Yes, I will assume my RF is equal to X. I will assume RM minus RF, that is the market risk premium, is equal to Y. Based on that, I will solve. Look at this. Yes, I have to solve this. Tell me required rate of return as per CAPM. It is RF plus beta into RM minus RF. Okay. Let me assume that RF is equal to X, RM minus RF is equal to Y. Tell me for security A, required return is how much? 20 is equal to RF. Do I know? No. X plus beta is how much? 1.5 into RM minus RF. I have assumed it as Y. So it is 20 is equal to X plus 1.5Y. B, required rate is how much? 23. RF, X. Yes, beta is 1.8. RM minus RF, Y. So it is 23 is equal to X plus 1.8Y. I will just write it this way so that it becomes simple. Look at this equation, 1 minus 2 I will do. 23 minus 20 is 3. X minus X goes away. 1.8 minus 1.5 is going to be 0.3Y. Therefore, value of Y is 3 divided by 0.3, which is 10. Question over? No, we want whom? We want X in life. Without X, there is no life. What say? Yes. So I got my Y. We should not forget whoever X is. Okay. Yes. Y is what? RM minus RF is equal to 10. Okay, boss. Now let me substitute somewhere and let me find out the value of X also. Yes, I know 23 is equal to X plus 1.8Y. Tell me, X plus 1.8 into Y is 10, which is 18. Therefore, value of X is equal to 5. Yes, that means therefore my risk-free security rate is X is equal to 5. RM minus RF premium is 10. I want to calculate RM. Can I calculate RM? Boss, I can calculate. Tell me. Yes, RM minus RF. RF is 5 is equal to 10. Therefore, RM is equal to 15. So no, risk free is 5. Yes, market 10% premium is there. That means total market is giving me how much? 15%. Is this clear, everyone? Okay, great. Board data is not given. Okay. Sometimes question will ask you to calculate simple average return of the portfolio. If question is asking you simple average return of the portfolio, I will be calculating simple average beta. Simple. Normally tell me, yes. This is again ICI's great logics. Portfolio beta is always weighted average. So based on that, yes, I will be getting weighted average. Based on the total how much risk is there, based on that I will be getting the required return. But sometimes question will ask you calculate simple average return of the portfolio. There when you are calculating beta, you will just take a simple average beta. Based on that you will be calculating. Okay. Yes. Now a very simple point. Yes, whether expected return is equal to required return. In reality, two are different things. Yes, I am investing in Reliance. For the risk it is there, I require 20% return. Is it necessary that I am getting 20%? No, boss. Sometimes I may get 20%. Sometimes I may get more. Sometimes I may get less also. If I am getting 20% exactly correctly valued, if I am getting more, great. By now it is undervalued. If I am getting less, it is overvalued. Okay. But most of the places, yes, if ICI is using the term expected return, it is nothing but required return only. Yes, William Sharpe has assumed that, yes, in the long term, whatever is the required return, that only we will be getting also. So my expected return is equal to required return. So unless anything is given, whether question asks you required return, expected return, I will be doing the same thing only. Till here things are okay. Wow. Yes, with that part 5 also CAPM is also over. Quickly, yes, we'll take a 1 minute break. We'll quickly, yes, revise this. Based on that, questions quickly, adjustments we'll keep on seeing quickly. Okay, next 1 hour maximum questions we'll try see. You want a break or we'll continue? Continue, na? He is having everything here only. Chakna coffee. What the? Don't give to me. I'm in the middle of a class, huh? What? No, 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 no. I'll have it afterwards. Don't- Have. No issues. Ah, sure. Yeah, we'll get into question solving quickly. Maximum questions we'll try seeing, okay, quickly. Obviously it will not be possible to sit and solve, do calculations for each and every question, but adjustment we'll keep on seeing. Okay, return and risk of individual security, from there we'll start. Okay, a stock costing rupees 120 pays no dividends. There is a stock, at what price I purchased? 120 I purchased, boss. Is it giving me any dividend? No, boss, it is not giving me any dividend. The possible prices that a stock might sell for at the end of the year with the respective probability is given. 120 I have put today. What all it can become? It can become 115 also, 10% chance is there. It can become 120 also, it can become 125 also, it can become 130 also, 135 also, 140 also. Assume 120 I have put today. It is giving me no dividend. Dividend gain is there or no? 120 I put, year end 115 only it became. Yes, how much is the return? 5 rupees negative on how much? 120. In terms of percentage, if you want, how much it is going to be? Minus 4.16%. 120 was there at the start of the year end also 120 only. Return is there? No, boss. That means overall it is going to be 0. It became 125. 5 rupees I got on how much? On 120. How much it is going to be? 4.16%. Yes, 120 has become 130. That means 10 rupee I got on 120. Yes, it becomes 8.33%. So on and so forth. So step 1, I will calculate the individual returns. Then probability is given. Yes, what is going to be the format I will be putting? Probability x. X I will be calculating step 1. P into x, x minus x bar, p into x minus x bar the whole square. Variance I will get, expected return I will get, standard deviation also if I want I will calculate. Okay, expected return, standard deviation. Second question. Yes, understand the adjustment of this question. Suppose, see, read this question. Existing market price of equity share is 106 rupees, which is come 10% debenture of 6 rupees. Today market price of share is 106, but in that what is there? 6 rupee debenture value is there. That means tell me what is the price of equity share. In 106 rupees, 6 rupees is the value of debenture, na? That means equity share price is 100 only. Okay, yes, the adjustment in question number 2, price of equity share. The existing price of equity share is 106, which is come bonus. In that a bonus debenture is there of 6 rupees. That means price of equity share. I want to calculate return of equity share, boss. It means I want price of equity share only. How much it is? 106 is total. In that you eliminate 6 rupees. It is going to be 100. Except that nothing is there in the question. That means, yes, existing market price, today's price is 106. In that 6 rupees, bonus debenture is there. That means today's price is going to be 100 rupees. Yes, year end, what all may happen. If market is good, na, market, yes, price can become 115. With that 9 rupee dividend also I will get. That means total how much I will get? 15 rupee capital appreciation I will be having, 9 rupee dividend I will be having. That means 24 rupees as a percent will be 24%. Probability of that happening is 0.25. Market can be normal, means price will be 107. 100 becomes 107. 7 rupee, yes, capital appreciation plus 5 rupees. That means 12%. It is bad, means yes, price will reduce by 3 rupees, but 3 rupees dividend I will get. Overall will be 0%. Yes, individually returns I calculated. Then the story will continue. P into x, yes, x minus x bar, p into x minus x bar the whole square, you finish off the story. Okay, find out the expected return and variability of return. What is the variability of return? Risk. Variance also you will do, standard deviation also you will do. Standard deviation you will do every time. Risk is variance, but you will calculate and keep standard deviation always. Okay, if the buyback offer is accepted. Okay, now also advise whether to accept buyback offer. So how will I reduce? Okay, this size is here. Okay, should I accept buyback or not? Simple point. Look at this, students. Price of equity share is how much? 106, which is come 10% bonus debenture of 6 rupees. Company had offered buyback of debenture at face value. Okay, there is a debenture. Debenture is giving me how much percent returns? 10% returns it is giving me. Okay, okay. Now question is asking, should I buy back? Yes, right now, debenture is there. How much return it is giving me? 10% it is giving me. Yes, if I buy back means they will give me the money. That means I will not be getting the interest in future. When will I buy back? Simple story. This investment is giving me 10%. If I have some other opportunity wherein I will get 15%, what will I tell? I will tell, give me my money back. I will take my money, put it, invest somewhere else. Yes, if I'm not getting more than 10%, will I buy back? What will I do having that money with me? Okay, so simple point I will tell. Okay, boss, debenture is giving me 10% return right now. If I anticipate that in the market for the same risk, I can get a higher return, then buy back, get the money, invest it there, get more return. But if you do not anticipate it that way, leave it as it is 10%, you are getting, the story is over. Okay, that is going to be the answer we are going to write. That is what ICA has written. With that, one more small point ICA has written. Yes, if the maturity period is low, then do not go for buyback. Suppose yes, this debenture will mature in less than 1 year, then chumma you'll have to buy back, then you'll have to invest somewhere else, there also you return you'll have to do, yes, all these transaction cost you'll have to incur. Anyways, some extra return you'll be getting. For that, why should you do all this headache? That is what ICA has given. Okay, so if you just look at the crux of this, okay, first, advice on buyback. Yes, company has offered buyback of 10% debentures at face value. Yes, currently investor is earning 10% interest. If he expects that he will be getting more than 10%, then buyback, invest somewhere else. But if maturity period is low, say up to yes 1 year, this is what ICA has given. There is no exact reason as to why they have given maturity period is low 1%. Possibly to do all this transaction cost you will have to incur. Then wait. Otherwise, you go for buyback. Okay, that is what this question is there. Okay, fine. Now, next question that we are having, return and risk of a portfolio. Portfolio we have reached. Yes, simple. This is A is interested to invest 1 lakh rupees. He selected 2 securities B and D. For both the securities, risk sigma is given, expected return is given. Correlation also they have calculated. We need not worry only. Yes, you are required to calculate the portfolio return. Yes, of the following portfolios to be considered. Okay, indicate which portfolio is best from a risk as well as return. Now understand, in the top line they only ask portfolio return, but in the advice they are telling from risk perspective also. That means what all I should calculate? Portfolio return also I want, portfolio risk also I want. Tell me what is going to be my portfolio return. 100% you put in B only, 50-50 you do, 75-25 you do, 100% you put in D only. Portfolio return is what? It is nothing but weighted average, summation of weight into expected returns. Data is given, very simple. Portfolio risk is going to be variance, weight x sigma x the whole square A square, weight y sigma y the whole square B square plus 2 into weight x weight y sigma x sigma y into Rxy. Every data is there, you just have to replicate. Yes, comment which is best from risk as well as return perspective. From return perspective, which portfolio return is maximum, that you will tell. From risk perspective, which portfolio return is lowest, that you will suggest. Story over. Question number 4. Okay, consider the following information on 2 stocks A as well as B. For 2 years, return of both the securities is given. Okay, boss. You are required to determine the expected return on a portfolio containing A and B in the proportion of 40% and 60%. Tell me, A can give me 10% also, 16% also. That means what is going to be the average? 10 plus 16 divided by 2, 13%. B can give me 12 also, 18 also. Average is 15%. Okay, boss. Now, expected return of a portfolio containing A and B in the proportion of 40%, 60%. A 40% into 13, B 60% into 15. You will get expected return on a portfolio. Then standard deviation of return from each of the 2 stocks. Individual risk they are asking. X is there, x minus x bar the whole square divided by n. Y is also there. You repeat that. Covariance. Yes, x is there. Yes, simple. X minus x bar the whole square. Y minus y bar the whole square. You do x minus x bar, y minus y bar. Divided by n, you will get covariance. Correlation also it will ask. Covariance xy divided by sigma x, sigma y, you will be getting your correlation. Okay, correlation. Risk of a portfolio containing A and B in the proportion of 40%, 60%. Portfolio risk, it is calculating A plus B the whole square formula. Okay, great, boss. We will do it, no issues. Next. Historical rate of return of 2 securities over the past 10 years are given. Last 10-year data they have given. Calculate covariance and correlation coefficient. Yes, they have not asked individual risk, all those things they have not asked. But still I have to calculate, boss. Okay, yes, individually I'll have to keep on doing. Okay, so I will do, yes, x is there, y is there, x minus x bar, x minus x bar the whole square. Yes sir, why do I want x minus x bar the whole square? Because of correlation, it is covariance xy divided by sigma x sigma y. For that I want y minus y bar, y minus y bar the whole square, x minus x bar into y minus y bar. You do, you finish off the story. This only will keep repeating so many times. Okay, investor has decided to invest 1 lakh rupees in share of two companies A, B, C, X, Y, Z. Projection of return from the shares of two companies with the probability they have given. Future data probability. Okay, this also can happen, this also can happen. Probability is given. Comment on return and risk of investment in individual shares. Yes, they have just not just asked me to calculate, they have asked me to comment also. Comment means I will tell which is good, which is bad. Return, where return is more, that is good. Risk, where risk is less, that is good. That is going to be my comment. Okay, so probability is given. Probability x, p into x gives me expected return of x, x minus x bar, p into x minus x bar the whole square. Y is there, p into y, y minus y bar, p into y minus y bar the whole square. Till now it feels this much is sufficient, but most of the times they will ask correlation also. P into x minus x bar into y minus y bar. Okay, compare the risk and return of two shares with a portfolio in equal proportion. Portfolio risk you want, for that what we want? Correlation we want. Yes, equal proportion, 50-50. A plus b whole square formula I will put. Find out the proportion of each of the above shares to formulate a minimum risk portfolio. Minimum risk. Tell me weight of x is risk reduction of y divided by total risk reduction of x plus y. Just putting the numbers is there. That is something you only have to do. Trust me, even if I do it here, firstly I will commit mistakes. Okay, I can commit mistakes because I somehow cleared my exams. Okay, yes, but you should not be committing mistakes. Okay, fine. Question number 7. Yes, all these questions reference is also given. Yes, every question from study material plus May 18 till today, everything I've put it here. Okay. Suppose economy A is growing rapidly and you are managing global equity fund. So far you have invested only in developed country stocks. Okay, there are two countries. One is a developed country. One is economy A, which is developing. Till today I only put in developed country. I don't want risk only. But we are telling slowly, boss, I want to earn some more return. In yes, developing also I want to put. Okay, boss. Developed countries expected rate of return. Yes, x bar is given. Yes, risk. Annualized standard deviation percent. How have they given risk in terms of percent? That means they have given me sigma. Okay, x bar is given, sorry, x bar is given, sigma x is given. Yes, y bar is given, sigma y is given. Correlation coefficient is also given. Rxy is given, how they are moving in relation to each other. Yes, assuming risk free rate of interest to be 3%. Why they have given, God only knows. We'll see. What percentage of your portfolio should you allocate to economy A if you want to increase the expected rate of return of portfolio by 0.5%? Okay, let us do this. How much weight you should be giving to economy A? Now, question is telling, yes, so far you have invested only in developed country. Till now, my full amount where I have put developed country only. That means till now the return that I am getting is of developed country only. How much return I am getting? 10% I am getting. But I am telling, boss, this is not sufficient for me. How much more I want? 0.5 more I want. That means return of the portfolio that I am expecting is 10.5. It is nothing but weight of A, return of A plus weight of B, return of B. Okay, tell me developed country, how much return it is giving? 10. Developing is giving me how much? 15. But I want to know how much proportion I should put. Whenever we don't know, whom will call? Whom will call us? SEBI. X will call, yes or no? Let's assume weight of A is equal to X. That means weight of B is going to be 1 minus X. You will get the value of X. Based on that, you will get value of Y. It is 10X plus 15 minus 15X, 10.5. Okay, yes, minus 5x comes here. 5x is equal to 15 minus 10.5 is 4.5. Therefore, x is 4.5 by 5. 0.9. Yes, which I have taken as x. Developed country I have taken as x. So, developed country 90% should be there. That means 10% I should put in developing country. Question they have asked how much I should put in economy A, developing country. 10% I will be putting. Okay. What will be standard deviation of portfolio? Assuming that economy A are included as calculated above. 90%, 10%. Portfolio risk, sigma p square, sigma pi will do. Also show how well the fund will be compensated for the risk undertaken. Yes, you have to just remember this thing, how well the fund is compensated for risk undertaken. Here they are asking me to calculate the Sharpe ratio. How well, how much extra I am getting for the risk undertaken. Random numbers I am giving. Assume for the portfolio, random numbers, number calculation you have to do. Yes, the expected return is, say for example, 15%. For the portfolio, risk is, say for example, 3%. So what I will tell, boss, even if I sit with the risk free, how much I am getting? 3% I am getting. But because I took risk, how much I am getting? 15%. So how much extra compensation I am getting? 12% extra compensation I am getting. For how much risk taken? 3%. That means for 1 unit of risk, how much I am getting? 4. Calculate Sharpe ratio using the actual numbers. This I have just told to give you guys the feel of this. Okay. Question number 8 is there. Okay. This question, 2 years data is given. Question is very simple, Jujube only, but you have to be just, yes, careful in relation to this question. A good question. We'll do this. Okay, I'll just give you guys a feel. Look at this, students. X company limited invested on 1/4/2009 on certain equity shares below. Two securities is there, M limited, N limited. Okay, boss. On 1st 2009 invested. Okay, how many shares? I will just draw a timeline. Look at this. Yes, on 1/4/2009. For M limited, I will draw. Okay, similarly you can do for N limited. Okay, how many shares I purchased? 1000 shares I purchased. Yes, bracket 100 each. Yes, cost that I have invested is 2 lakh. That means look at this. I am only doing for M limited on 1/4/2009. Okay, how many shares I purchased? 1000 shares I purchased. For that, how much investment I have done? 2 lakh investment I have done. That means, can you guys tell me the market price for one share? One share, how much I paid? 2 lakh I paid for 1000 share. That means for one share it is how much? 2 lakh divided by 1000, 200. Okay, sir, then what is that 100? 100 is a face value. Okay, okay, boss, fine. Same thing is there for N limited. Let it be there. Okay, now in September 2009, 10% dividend was paid out by M limited. Okay, okay, okay. I am doing for M limited only. September 2009, which is, yes, how much dividend was paid? 10% dividend was paid. Dividend, if nothing is given, dividend always I will be paying on face value. Face value is 100. That means how much dividend per share I am getting? 10%. 100 into 10%, 10 rupee. Total dividend will be how much? On one share 10, like that, how many shares I am having? 1000. 10 into 1000 is going to be how much? 10,000. Okay, great. In October 2009, next month only, 30% dividend was paid out by N limited. For N limited's data, I will do the dividend calculation. Okay. On 31/3/2010, I invested on 1/4/2009, 31/3/2010, year end. Yes, what happened? Market quotation showed a value of 220 and 290 for M and N limited. That means M limited's price is how much? 220. Yes, P1. 220 for one share. Like that, how many shares I am having? 1000 shares I am having, boss. That means total closing market value is going to be how much? 2,20,000. Okay, ba? Okay. Now, based on this, can I calculate expected return? I can calculate on one share also, on total also. Anyways, I can do. Just data has to be uniform. Yes, expected return. It is a dividend plus P1 minus P0 divided by P0 into 100. If you are doing on one security, tell me how much dividend I got on one share? 10 rupees I got. 200 was my opening market price. Year end it became how much? 220. That means 20 rupees capital appreciation I got. Total 30 rupees return I got. On one share, how much I had put? 200 rupees. How much it is? 15%. I am telling, no sir, total I want to do. Do it on total also. Tell me total how much dividend I got? 10,000. Opening market value was 2 lakh. 2 lakh became 2,20,000. So total my capital value appreciated by 20,000. So that means overall total 30,000 return is there on how much investment? 2 lakh investment. That is going to be how much? 15%. So step 1, calculate expected return of X and Y, whatever M limited, N limited. Step 2, they will be asking me the expected return of the portfolio. Step 2 is going to be expected return of the portfolio. Portfolio return is nothing but the weighted average. Tell me, investment, weight, expected return, weight into expected return. Tell me, yes, 2009, how much I invested in M limited? 2 lakh. How much I invested in N limited? 1.5 lakh. That means it is going to be 2 lakh, 1.5 lakh. Total was 3 lakh 50,000. Tell me, that means how much percentage investment I put in M limited? 2 divided by 3.5, how much it is? 0.57. This is going to be 0.43. Yes, return of X I calculated, it was 15%. Similarly, I will do for Y. Weighted average I will be getting. Over? Yes, fine. Calculate the average return of portfolio for the year ended 31/3/2010. Portfolio return I want. Okay. Now, first year is over. Now, for second year, they are giving me forecasted, projected data to calculate returns. Now, look at this. Year 1 is over. Now, on 1/4/2010, investment advisors indicate that dividend from M limited and M limited for the year ended 31/3 are likely to be 20% and 35%. Okay, boss. And that the probabilities of market price is going to be as follows. Now, look at this simple point. First year is over. Now, here I am standing for year 2. Yes, year 2 starting. What is the market price? I will only do for one security, 220. Year 1 ending, market price was 220. That means year 2 starting market price is also 220 only. I am only doing for M limited. Tell me, M limited, how much dividend is expected? 20%. Dividend is always on face value. On 100 rupees, 20% means 20 rupee dividend I will get. And they are telling, we are projecting, boss, that year end what may happen to the closing market price. Closing market price can be 220 also, 250 also, 280 also. What is the probability? 220's chance is 0.2, 250's chance is 0.5, 280's chance is 0.3. Can you calculate the expected closing market price? 220 into 0.2, 250 into 0.5, 280 into 0.3, 253 over. That means 220 was there, year end I am expecting it will become 253. That means 33 rupees capital appreciation, 20 rupee dividend, total 53 will be there on 220. How much it is going to be? 24.09%. Similarly, I will do for the next security. Now, second requirement is going to be calculate the expected average return from the portfolio for second year. Return of portfolio I want. How will I be getting portfolio return for year 2? Step 1, I will calculate the individual return. Okay. Yes. Second, when I am calculating return of the portfolio, it is weight into expected return. When I am taking weight, it is a second year. Which investment value I will be taking? Second year opening investment value I will be taking. I have already explained, boss. Yes, first year total was 3.5 lakh. T is equal to 0 at the date of investment. First year end, assume randomly I am telling the value became 4 lakh. So, when I am earning returns on the second year, it is on this value. So, the weight will be based on first year end market value or second year opening market value. This is one point we have to keep on the back of our mind. Okay. Yes. Then with that, advise a company on the comparative risk in two investments by calculating standard deviation in each case. They are asking standard deviation. Yes. Tell me for one simple situation. Yes. Risk will happen when I am expecting future. Last year has already happened. Last year's data I know, boss. Last year 200 was there, 10 rupees I received, 220 it became. Over 30 rupees I received on 200. Over, story is over. 15% I got, story is over. Risk I am expecting for future data when uncertainty is there. Now here 220 is there. Here different market prices are given year end, good, bad, yes, all those things. In every situation I will calculate a return. Based on that I will calculate the risk. Okay, probability is given. Yes, look at this very simple situation. Yes, for M limited I will calculate and show. Look at this. Opening market value is 220. That is certain, no tension only. Dividend that I have received in M Limited is 20%. That means it is 20 rupees. That is certain. No tension only, boss. Closing market price, anything it can happen. That means, tell me if my closing market price is 220 only. Year start it was 220. Year end also 220. Am I having any capital appreciation? No, boss. But I got 20 rupees dividend, na. 20 divided by 220 into 100. Whatever is the value. Assume it became 250. 30 rupee capital appreciation I got. With that 20 dividend also I got. 50 on 220. Yes, suppose it became 280. 220 became 280. 60 capital appreciation plus 20. 80 upon 220 into 100. X I got, then I will continue with my story. Okay, very important, beautiful question. Please try this. Virat King. Oh, sir, will this video be available in YouTube, sir? Okay, next question. We will do this. Yeah, we have no option. If you tell me I can stay for 1 or 2 more days, arams I can do. Arams I will keep dancing, playing, and we can do finish it off. You also don't have time. More than that, I also don't have time. Okay, so it is going to be a bit fast when we are coming to questions. Concepts have taken a good amount of time. Okay, yes, Ramesh has identified stocks of 2 companies A and B having good investment potential. Following data is available. Year 1, 2, 3 market price is given for both the securities. Calculate risk and return by investing in A and B. Tell me whether return is directly given. No, I have to calculate. Yes, how will I calculate return? It is dividend plus P1 minus P0 divided by P0 into 100. Now 1, 2, 3, 4, 5, 6, 7. 7 year data is given. Can I calculate return for 7 year? No, 6 year I can calculate. Yes or no? Nowhere dividend is given. So look at this. Yes, year 1 19.6 was there. It became how much? 18.75. Only for 1 year I will do the calculation. That means by how much it reduced. 19.6 minus 18.75. 0.85 it reduced on 19.6 into 100. Next year, next year, next year, next year. Step 1. For 6 years I will calculate individual return X as well as Y. Once you get that, then okay, you will continue with the story. Okay, risk and return of individual security. First step is calculation of X and Y. Then you will do x minus x bar whole square, y minus y bar the whole square. Yes, there might be a need. Portfolio I am creating, covariance, correlation also you calculate and keep. Yes, risk and return by investing in a portfolio. If you invest in 60%, 40%, okay, invest in a portfolio. Then better opportunity for investment. Now 3 things are there. Either I can invest only in A, or I can invest only in B, or they have told on portfolio also is there. Which is better? I will tell. From return, where return is maximum, that is better. From risk, where risk is least, that is better. Story over. Okay. Yes, let us go to question number 10. It has come in past paper, November 21. Okay. Yes, I guess this is similar to the, how many? No, only 1 year data is there. Okay, only 1 year data is there. On 1/4/2020, K invested in the following companies to make his portfolio. Okay, boss. PK, KD. Number of equity shares is there. Face value is given. Purchase price is given. How many shares I purchased, at what price I purchased? It will give me my opening investment that I will be using for calculation of weights. Okay, boss. K expects that dividend for the year 2021 is going to be 40% and 50%. Dividend percent is always on face value. For that purpose, face value is given. Okay. Probability of market price as on first year end. Okay, probable market price is given. Calculate expected market price of equity share for both the company as on 31/3/2021. What they have asked, what they have asked, what they have asked. Calculate the expected market price of equity share on 31/3/21. 31/3/21. What is expected market price? Average price, boss. Yes. There is a 40% chance it can be 200. There is a 40% chance it can be 240 also. There is a 20% chance it can be 260 also. I will finish off my first requirement. Second, calculate the expected average return of portfolio. This is very simple. I need not think too much. They have not asked me risk. Individual I don't want. Okay, look at this. Very simple. I will do it. Look at this. Tell me the expected closing market price. 200 into 0.4, 240 into 0.4, 260 into 0.2. How much it is? 228. Simple. Look at PK Limited. PK Limited, initially I put at 210 rupees. Year and my expectation is it will become 228. That means how much capital appreciation I will be having? 18. With that, dividend for PK is 40% on face value of 10. 10 into 40% is 4. 18 plus 4, 22 rupees return I am expecting on how much? On 210 investment. I will get expected return of X, whatever. Similarly, I will get expected return of Y. Okay, story over. Now, opening investment value I have. Based on that, I will get the weight. Return of portfolio also I will get. Story over. This has come for 8 marks. Bonus it was actually. We saw for 2 years. So much Ramayana we had done. Yes or no? This was simple in that relation. Okay. Calculation covariance and correlation coefficient. Last 10 years. 8 marks it has come. Simple. Question is not going to be very difficult here. But 80% chance you will commit a mistake somewhere. If you commit a mistake in first step, go in the everywhere you will get a big 0. So practice is going to be the most important key here. Okay. Okay, next question. Again you see 3 company data is given, 4 years data they have given. Okay. Construct maximum number of shares. Okay, this one is a good one. Look at this. Construct the maximum number of portfolio and its return if each portfolio consists of 2 companies share in the proportion of 65% and 35%, and suggest which portfolio provides the highest return. Okay boss, now look at this. A limited is there, 4-year data is there. Can you tell me the expected return? 2%, 6%, 13%, 7%. Can you tell me the expected average how much it is going to be? 2 plus 6 plus 13 plus 7. 7. 7. B is going to be how much? 3 plus 8 plus 14 plus 9 divided by 4. Average 8 point. C is going to be how much? 5, 7, 12, 23, 38, 9.5. Individual return I got. They are telling construct maximum number of portfolio. How much portfolio you can build? If each portfolio consists of 2 companies. 2 companies only I am investing. How? In the proportion of 65 and 35. Okay boss, look at this. 65, 35. Okay. Now tell me which all companies are there. A is there, B is there, C is there. First let me take A and B. Portfolio 1. I will put 65% in A, 35% in B. Portfolio 2 I will create. I will put 65 in B, 35 in A. A and B, all possibility over. B and C I will pick. Portfolio 3, 65% in B, 35% in C. Portfolio 4 I will take 65% in C I will put. This one in B I will put. A and C is also there. Portfolio 5, 65% in A I will put, 35% in C I will put. 6. CA. Portfolio is there. Yes. Calculate. Construct a maximum number of portfolios. 6 portfolios. Yes. Suggest which portfolio provides the highest return. I will calculate expected return of every portfolio. Simple. Weighted average. Based on that, I will give a suggestion. I can give a suggestion by closing my eyes. Understand? I want to return more. So where will I be putting more money? The security which gives me highest return. Tell me in the 3 which gives me highest return. C, that means in C I should be putting 65%. Second best which one is giving? B I should put 35%. This portfolio of 65% in C and 35% in B gives me maximum. But because they are asking me for some 8 marks, I have no option. I will do everything. Ramayana. Okay. Yes. Calculate portfolio return and beta. Beta is also there. Okay. If X invests 65,000 in A having a beta of 0.5, 20,000 in B having a beta of 1.5 and 15,000 in C having a beta of 1.8. Simple. Look at this. X is putting in A also, B also, C also. He's saying I want all 3 boss. Okay, great. Tell me how much is putting in A? 65,000. How much in B? 20,000. How much in C? 15,000. Total is how much? 1 lakh. If you calculate the weight, 0.65, 0.2, 0.15. Am I having expected return of every security? I calculated and kept boss. 7, 8.5 and 9.5. Can I do weight into expected return? Will I be getting expected return of portfolio? Now it is asking me portfolio beta also. What is portfolio beta? Weighted average. Yes, here I will put beta. Weight into beta will give me portfolio beta also. Over story. Yes, so this came for 8 marks. When it came? Recently only, November 22. Great. Next is May 24. Hot cake. How many marks? 8 marks. Let us see what was there. Investor has decided to invest 1 lakh rupees. Okay, 1 lakh is having good books. X and Y limited. Okay, boss. Desired return of share of 2 companies along with the probabilities are given. Okay, boss. Probability is given. Yes, X is there, Y is there. Calculate the risk and return of investment in individual shares. Individual shares, I want a risk also, return also. Probability is there. How will I be writing? Yes, probability X, P into X, expected return of X, X minus X bar, P into X minus X bar the whole square, variance of X. Then I will be doing Y, P into Y, expected return of Y, Y minus Y bar, P into Y minus Y bar the whole square, variance of Y. They will be asking correlation also, P into X minus X bar into Y minus Y bar gives me covariance XY. Covariance XY divided by sigma X sigma Y gives me, yes, correlation coefficient of X and Y. Yes, this data number I have to put, that's all. Risk and return of individual securities. Compare the risk and return of these 2 shares with the portfolio in equal proportion. I created a portfolio, equal proportion I am putting. Return is going to be just weighted average. Okay. Risk A plus B whole square, correlation I want, that is why we calculated and kept, based on that correlation also we did. Yes. Third, find out the proportion of each of the above shares to formulate a minimum risk portfolio. Minimum risk portfolio, what is going to be my weight of X? It is risk reduction of Y divided by total risk reduction, that is X plus Y, wherein my risk reduction is nothing but variance minus covariance. Over. 8 marks. Simple. Yes. Then comes efficient portfolio. 6 securities are there. Same number only I put in my example. Look at this. First I will compare returns. Returns. Here also 8%, here also 8%, here also 8%. Everything is giving me same return. Tell me which one I will select. Lowest risk I want. A is having 4%, B is having 5%, F is having 6%. Tell me which one I will retain. A I will retain. B and F directly I will kick it outside. Okay. Now I will compare risk. Where I will compare risk? 4 and 4 I am comparing, risk is there. Okay. Yes. For 4% risk, D is giving me 4% only, but A is giving me 8%. Return, more I want, less I want. More I want, A is giving me more, D is giving me less. D I will, what happened? Okay. D I will eliminate. Yes, assuming 3 will have to be selected, which ones will be picked? I already got 3, over, story over. Yes, if I want further, I can see correct or something else can be eliminated. Lowest risk, lowest return. Yes, E is having some extra risk, but it is giving me some extra return also. Yes, C is having me bit more risk, it is giving me more return. All 3 are efficient. Okay. Yes, assuming a perfect correlation, show whether it is preferable to invest 75% in A and 25% in C, or to invest 100% in C. Okay, they are telling 2 different options are there, boss. Option number 1 is I can invest A le 75%, in C 25%, or I can put 100% in E. Tell me, yes, whether it is preferable. Okay. Now let me try calculating the returns as well as risk. If I put in E only, yes, return of E, how much return E is giving me? 9% for a risk of 5. If I put in A and C together, tell me how much A is giving me? 8 it is giving me. I put 75% in that. Okay. C is giving me how much? 25%. Sorry, it is giving me 12 into 0.25. How much is it giving me? 8 into 0.75, 12 into 0.25. How much? 6 plus 3, 9. Okay, 9 only return it is giving me. Risk I have to calculate. Sir, for risk, weight of X sigma X whole square plus weight of Y sigma Y whole square plus 2 into weight of X, weight of Y sigma X sigma Y into RXY. Want a perfect correlation, means a perfect positive correlation. If it is negative, they will tell negative. Perfect means perfect positive. If R is equal to 1, yes, standard deviation is weight of X sigma X plus weight of Y sigma Y. I am putting 0.75, 0.25. It is A A was 4, 12. Yes, 0.75 into 4, 0.25 into 12. How much is it? 6. Tell me, if I create a portfolio, it gives me 9%. But for that, how much risk is there? 6%. Instead of that, what is better? Directly put in ENA. 9% you are getting just at 5% risk. Okay. Over, that is also over. Finish. Okay. Next, capital market line, there is no question. Calculation of beta. How much it is? 615 it is. Okay. We'll try finishing it off maximum. Going over the head. Morning only to enter. What in evening you are asking? Okay. Beta calculation I want. Look at this. Okay. Maja will come. Okay. Following information is available in respect of JK Limited. One company is there, JK Limited. Okay. Average share price, DPS, dividend per share. Market, average index value is given. Dividend yield is given. Return on government bond is given. Why exactly they are giving, God only knows. Calculate beta value. What is your observation? Step 1 is calculation of beta value. Step 2 is observation. Again, one great thing IC has done in observation. I'll tell you. Don't worry. For that, firstly, I want beta value. Now, tell me, beta value I want. Okay. Different ways for me to calculate beta value. Where did it go? Okay. Only 2 years data is given, means change in X divided by change in market. Multiple years data is given. Sigma X divided by sigma M into RXM, or covariance XM divided by sigma M square. Shortcut, you can play with it and do. Yes. But for doing all of this, I want to know returns. Whether return is given. Data is given. How many years data is given? 1, 2, 3, 4 years data is given. Based on that, for how many years returns I can calculate? 3 years I can calculate. Look at this JK Limited. Okay. Yes, year of 2002. Yes, the share price at end of 2002 was 242. Okay, by 2003 it became 279, and in this year how much dividend I got? 25 I got. Yes, share price always we will be taking IC as always assume it is closing market price. So based on that, for next year only I can calculate. Okay, boss. 242 I had put. By next year it became 279. That means how much extra? How much return I got? 20. But how much da? 37 capital appreciation I got. With that 25 dividend also I got. So total is going to be 62 on how much? On 242. I will get the return percentage. Similarly for next year, I will do D plus P1 minus P0 divided by P0. Now come to market. Yes, tell me, for market, I have told you RM calculation. Dividend yield is given. Directly given as a percentage. Capital appreciation I will calculate from here. Only for 1 year I will show. Look at this. First year, now market value was 1812. By next year, market became 1950. That means how much is the appreciation in the market? 1812 became 1950. That means it has increased by 138 on how much? 1812. That means how much percent is the capital appreciation? 7 point. Is that the return of the market? No, boss, that is capital appreciation. Na? Dividend also I got how much? 4% I got. So total is going to be 11 point. Sorry, I took year 1 now. Okay, 5%. I was checking you guys are alert or not at 6 o'clock. Okay, I can commit a mistake da. Why? Because I cleared my exams. Okay, 12.62%. Simple. What you will be doing is, when you are calculating return of market, first you will calculate capital appreciation percentage. P1 minus P0 divided by P0 into 100. Then you will write dividend yield percentage. You will add the two, then you will write yes, total return of the market. Okay. Step 1, most important thing is to get the individual returns. Once you get individual, then you will continue. Yes, X you are having, M you are having. 1, 2, 3. Yes, M also you are having. 1, 2, 3. Based on this, you will get X bar, X minus X bar, X minus X bar the whole square. Based on this variance of X, you will get return of M, you will get M minus M bar. m minus m bar the whole square. Variance of market you will get x minus x bar m minus m bar. Covariance you will get covariance xm divided by sigma x sigma m. R you will get, once you get all these things after a lifetime, then you will come to beta. Sigma x divided by sigma m into Rx. Yes, sigma x you are having here square root, sigma m you are having here into Rxm you are having here. Okay, if they are not asking me multiple data, now look at this, here they have just asked the beta. If I want, I can eliminate this big Rama in a table. Returns I have to calculate, there is no way I can eliminate that, but I can put my shortcut formula. Once I get x as well as m, I will do xm m square sigma xm minus n x bar m bar divided by sigma m square minus, I guess this should be the formula. I don't know, I can only play with that and tweak and get it. I don't know the by heart thing. Okay, fine, this is there. Same thing is there one more time. There it was JK limited, here it is Krishna limited. Change is there. Number also has changed. Okay, don't tell only company name has changed. 1, 2, 3, 4. 4 years they have given. One thing I forgot. State your observation. For this I want I see a solution to show. Wait a minute. Portfolio. Can someone tell me illustration 6 page number? But I guess I can search here. 6 point. Okay, this is a question. Now understand one. Yes, returns they have calculated individually for every year they got the returns. Yes, for market also they have calculated. Yes, beta here they have done shortcut formula only they have put. Yes, x m xm m square, here they have finished off the story. Okay, based on that they got a beta as 0.15. Yes, the best thing is they have asked for comment, they have not put observation. Don't worry, one more question is there wherein they will do. Where it is, which question we were doing the. Okay, next question you see practical 8, you see Krishna limited observation practical 8. Practical means come to end of the chapter. Okay, same thing, state your observation. We will come to the solution because IC has done one great thing. 6.88. Okay. Yes, firstly, for the company, every year they have calculated the returns. For the market, they have calculated the returns. Beta, xm, xm, m square, they have calculated the beta. Over, fine. So, what is going to be the beta? 1.897 they have given. Based on that observation, they asked. I see I had to do something innovative because if they only keep logic in AFM, AFM becomes simple. With that, they have to mix some of their creative insight so that things become difficult. So, look at what they have done. They are telling, boss, for the year 2012-13, okay, yes, if beta is given means, can I calculate expected return of the security or required return of the security? Okay, boss, I can calculate. Look at this. If you look at the question, where on earth is the question? Okay, government bonds data is given. Based on that, they have calculated. Where is it? Okay, government bond is giving me 6%. Okay, 6% only. They have taken average, or they have taken lower. 2000. Okay. Sorry. Okay, this was 2012, na. 2013 government bond is giving me 6%. That means 6% in any case I want. Okay, boss. So where is it? Okay, 6% it is giving me. Market was giving me 10.81% for that year. That means how much percent premium market was giving me? 4.81% premium market was giving me that year. Yes, my beta is 1.897. That means how much I want? 1.897 into 4.81 plus 6 gives me 15.12%. That is the required return. That much I should be getting. But in a reality, for 12-13, actually how much I got? 12.24 only I got. I should have got, for the risk I am taking, I should have got 15.12% that year. But that year I got 12.24 only. Did I get the required return? No. Good or bad? Bad. So should I be buying the security? Should be selling the security? Yes or no? Yes or no? Yes or no? What nonsense it is. 3 years are over. I am standing 2016 end. IC is telling go back 2012. Yes, share if you are not having means go sell and come the security. That is what it is telling. See, that year's return of risk free, that year's return of market, that year's return of security, that year's CAPM, that year's actual return. Today I am telling go and sell there. ICA. Okay. Question is asking you calculate beta plus observation. You will calculate beta observation. Simple point. You will calculate CAPM return. You will compare with expected return. You will tell buy, sell. Okay. Yes. ICA is telling dog has 2 legs. You will also tell dog has 2 legs only. Story over. You are not going to ask too much. Okay, simple point. Yes, this was one thing that ICA has done that you should be remembering, or else you will commit a mistake in this. Okay, fine. Great. Now next things are simple. 3 years returns are given directly. Understand the maximum mistakes we commit if returns are not given, because there we have to calculate X. Maximum mistakes will happen. This will come only with practice. There is no way out there. Okay. Yes, 3 years probability is given. Okay. Return of security F and market portfolio P. This is market. Okay, boss. Great. You are required to calculate expected return of F and market portfolio, covariance and beta. Tell me here, can I put my shortcut formula? Yes. Sigma xm minus n x bar m bar divided by sigma m square minus n m bar square. Can I put the shortcut regression formula? Why? Probability is given. I can use regression. I can do this shortcut only if I have past data. Otherwise, you have to do that entire story. X minus x bar, whatever it is, full story you do, you have to do the calculation. Okay, va? Okay, fine. Now comes question number 18. It is just pure practice. Nothing else is left. Okay. Yes. Given below is information of market rate and return for 2 companies A and B. Yes, for look at how data is given 2007, 8, 9. Normally year will be given like this. Now they have changed, they have put it like this. Okay, market's return for every year is given. Okay, great. A's return is also given. Okay, great. B's return is also given. Great, amazing. Calculate beta coefficient of A and B. La 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 la. One time beta only was difficult. Now beta of A in relation to market, B in relation to market. Simple, nothing is there. 2 times you have to do, that's all. X first of beta of A with market. Yes, for a data like this, if you put shortcut, you will save a lot of time, hell lot of time. Or else you will keep playing everything, variance, covariance, correlation. If you have time in the world, practice purpose, you do. Okay. Yes, X you will put. Yes, if you want to finish it off quickly, M you will do, xm you will do, m square you will do. Sigma xm minus n x bar m bar divided by sigma m square minus m bar square. Yes, this if you do, you can calculate beta quickly, or else anyways, do it fully, practice purpose. Okay, fine. Now May 22. Yes, exactly same question that you have seen. First question was JK, next one was Krishna, this is Swecha. 1, 2, 3, 4, 5. 5-year data is given. That means for how many year returns I can calculate? 4 years I can calculate. Yes, for Swecha Limited. Here the way they have put a table also is wrong. See, this they should have done a merge and center onward. They forgot. I say na. I can't do anything. Why? There I see this. Okay. Dividend is there. From here it became this. With that 33 dividend also I got. I will calculate the returns. Every year I will calculate. Yes, index, market. I will calculate capital appreciation. 4060 became 4320. How much percent it is? With that 6.5, this also I got. Observation. Why on earth are they asking me observation in beta calculation? It will be having 2 to 3 marks. Yes, what I should do? I should do the most amazing thing in the world, that is do nonsense. Yes, for every year 1, 2, 3, 4, 2018, 19, 20, 21, I will calculate required rate as per CAPM. Yes, that is a risk-free rate of that year plus beta that I have calculated now into RM of that year minus RF. Yes, I will be calculating required rate. I will compare with the expected return that I have calculated and kept. Based on that, I will tell it is undervalued or overvalued. Based on that, I will tell go back and buy now. 4 years back, today you buy. Okay, yes, this is also over. Fine. CAPM questions will finish off and go. 15-20 minutes. Huh? That is easy. Comparatively, it is easy only. Please keep this video for the next 1 week because it is tax audit time. Just for 1 more week. After that, you delete. Okay. Okay, great. CAPM will finish it off. I guess we are at question 20. CAPM will go till 40. And nothing is there. All 2 minutes. GGB. CAPM, that also is not there. I have told all adjustments of CAPM already. Nothing is there for you guys in CAPM. Look at this. See how much difficult questions are there. Company's beta is 1.4. Okay. Market return is 14. Risk free is 10. What is the expected return of company based on CAPM? Oh my God. Yes, 10 I am getting. Market is giving me 4 premium into minus 1.4. 5.6, 15.6%. Second one is even more difficult. If the risk premium on the market goes up by 2.5%, tell me right now what is the premium in the market? 4%. It will increase by 2.5, means it will become 6.5. Revise the return. 10 anyways I want, minus 1.4 into 6.5. You will get the number. Leave the calculator. Okay, over. Yes, next. This is again a difficult. Risk premium for market is 10%. Risk premium, RM minus RF for market is 10%. Assume beta value of security K is 0.25, etc. Calculate the risk premium on the security. That means how much extra I want on the security. Tell me total return on the security is risk-free rate plus risk premium. They are asking me risk premium, which is beta into RM minus RF. They have told RM minus RF is 10 into beta value. Different situations they have given. 0 into 10 is 0, 0.25 into 10 is 2.5, so on and so forth. You will finish it off. Don't expect this will come in the exam, even in the worst dreams. Okay, sorry, even in the best dreams. Okay, next question. Pearl Limited expects that considering the current market prices, equity shareholder as per moderate approach should get a return of at least 15.5%. Equity shareholders. Okay, boss. Whereas the current return on the market is 12%. Okay, market return is how much? 12%. They're telling equity return holders should be getting how much? 15.5%. Okay, boss. Something could be there. Let us see. Okay. RBI has closed the latest auction for 2,500 crore of 182 day bill, treasury bill for the lowest bid of 4.3. Although there were bidder for 4.6 also. Tell me treasury bill, risk free. Tell me 2 risk free is given. Some people are telling 4.3. Some people had also quoted for 4.6. That means average is how much? 4.45% is going to be my RF. Okay. Yes. What is Pearl Limited's beta? Very difficult. Yes. Return is given. Tell me required rate of return. It is RF plus beta into RM minus RF. Tell me what is the return of the company? 15.5 I should be getting. Risk free is how much? 4.45 plus beta. RM is 12 minus 4.45. The only figure missing is beta. Calculate. Story over. Is this clear? Yes. The only adjustment here is RF. 2 things are given. You take average of that. Over. Yes. Now this question looks to be good. We'll see. Equilibrium return 15%. Okay. Now understand, you are having 3 different names for CAPM return. You can call it as required rate of return. How much I want. You can call it as equilibrium return. Ideally, how much I should be getting? Yes, if shares are correctly priced. Yes, if nothing is given about underpriced, overpriced, nothing else is given, you most of the times share is also calling it as expected return. Three different names are there. Okay, fine. Equilibrium, that means as per CAPM, I should be getting 15%. Okay, boss, this is CAPM return. Market return is 15%. Tell me, market is giving me how much? 15%. 7% treasury bond is trading at 140. Oh. Can I calculate RF? Treasury bond risk free. Yes, it is giving me 7%. Nothing is given. Face value default is 100. On 100, I got 7%. 7 rupee. Yes, I am getting on 140. Nah, they are giving on 100. That means 5%. Yes, covariance they have got. They are asking calculate standard deviation. Let us see. Now, based on what data I am having, tell me required rate of return. It is RF plus beta into RM minus RF. Yes, equilibrium CAPM 15 it should be giving me. Okay, now I can close my eyes and tell beta is 1. Why? Because market is also giving 15. My security also should be giving 15. That means beta is 1 only, as same risky as market. But let me do it aram se. Yes, tell me RF is 5 plus beta into RM is 15 minus 5, which is nothing but 10. 15 minus 5 becomes 10 divided by 10. Beta is going to be equal to 1. I told without seeing also beta is 1. Okay, fine. Now based on this, what they are asking exactly on earth? Calculate standard deviation of market and security. How I will do? Now beta is there. Do I know the formula of beta? Yes, two formulas are there. One is sigma x divided by sigma m into rxm, or beta is also covariance xm divided by sigma m square. Which one I will be using? God only knows. Let me see. Beta value I know. What else I know? Covariance I know of market and security. 225. Coefficient correlation is given. Now let me see which one I will use. This one I will use. Tell me beta is 1. Covariance is 225% square divided by sigma market square. So can I calculate variance of market? 225. Why are you using calculator? Da, I will do suicide. Da. Hey, it will go here. Sigma m square into 1. Huh? 225? Square root it. Even for square root also. 15. Okay. Standard deviation of market I got a 15 I got. Security I want. Yes, beta is 1. It is sigma x, I don't know, divided by sigma m is 15 into rxm is how much? 0.75. Yes, 15 is here in division, goes that side. Yes, into, yes, 0.75 here is in multiplication, comes this side, division. 15 divided by 0.75 is going to be how much? 20%. A good question. Different variant. Okay, now look at this. Derive a security market line. Okay, fine. Assuming that shares of ABC and XYZ are correctly priced. Okay, boss, correctly they are priced as per CAPM. The expected return and beta from these shares are as follows. Okay, return is given, beta is given, expected return. If they are correctly priced means this only is my required rate, this only is my equilibrium rate, this only is my expected rate also. Calculate security market line. What exactly on earth is security market line? Nothing, it is a CAPM only. So what is security market line equation? It is RF plus beta into RM minus RF. Detail tomorrow will again explain what all things have to be kept empty, all those things market line will tell, but for the time being this only I want. But boss, to get this RF I should know, RM also I should know. Do I know this? I don't know this. But I have told you for two different data beta is given. For two different data expected return is given. Yes, I will assume RF is equal to X, RM minus RF is equal to Y. Based on that I will continue with my story. Tell me 19.8 is equal to X plus 1.2Y. 17.1 is equal to x plus 0.9y. Yes, based on this, can you guys tell me the value of y? X and x gets nullified. 0.3y is equal to 17.1, 19.8. How much it is? 2.7. Therefore, value of y is going to be how much? 2.7 divided by 0.3. How much it is? 9. Value of y is 9. Correct? I am only doing the. You guys are holding calculator and also not doing. Screen is not visible. Why? Oh, it went outside. When it went, from that time I am playing like this. God. No, only now. Then it is okay. Fine. You should tell. Okay. Okay. Y I got. What is my y? Rm minus Rf is y. Let me calculate x also. Somewhere I will substitute. Look at this. Tell me 19.8 is equal to x plus 1.2 into y. 1.2 into 9. Tell me 1.2 into 9 is going to be how much? 10.8 minus 19.8. 9. Okay, fine. So my x, that is Rf, is equal to 9. Y, that is Rm minus Rf, is equal to 9. Risk free is 9. Extra I want 9 in market. That means total market, how much I am expecting? 18 I am expecting. Okay, what is security market line? Nothing. Same number I will put and keep. Rf is how much? 9. Beta I will keep it as it is. Rm is 18 minus Rf is 9. Yes, it is 9. SML, it is 9 plus 9 beta over. Based on this, whatever beta is there, you will keep getting the required rate over. Story over. Is this clear, everyone? Okay, now look at this next question. So tomorrow which chapter revision? First I should go back and sleep today. Only in that case I will wake up tomorrow, or I will exist tomorrow, because 2 days I did not get sleep only. Okay, we'll try finishing off portfolio. After that we'll go to advanced capital budgeting. Okay, tomorrow we'll try doing advanced capital budgeting. Day after tomorrow. Yes, expectation is 1.5 days portfolio, 1 day advanced capital budgeting, 3/4 of a day for mutual funds, then 1.75 days forex. If things go as planned, then God is there. We will see. Okay, okay. A Limited has a expected return of 22%. Standard deviation of 40%. Okay, look at this. A is there, B is there. Whenever you see data in a paragraph, try putting it down. Okay, A Limited is there. Sorry. Okay. A Limited has an expected return of 22%. Standard deviation, sigma, they have given how much? 40%. Okay. B has expected return of 24%. Standard deviation of 38. Okay. A Limited has a beta. A has a beta of how much? 0.86. B has a beta of how much? 1.24. All data I just wrote, nothing I did. Correlation coefficient R is 0.72. Standard deviation of market is 20. Suggest, is investing in B Limited better than investing in A Limited? Directly they are asking. Tell me, yes, A is giving me how much return? 22. Yes, for how much risk? 40. B is giving me how much return? 24. More return it is giving. For how much risk? Lower risk. A is inefficient security. Yes. Whether investing in B is better? Yes, boss. Any day it is better for me. Directly, if I want to invest. If you invest 30% in B and 70% in A, what is the expected rate of return and portfolio standard deviation? Expected return is weighted average. Yes. Portfolio standard deviation. You will calculate variance A plus B whole square. Based on that, you will bring it down to standard deviation. Okay, what you will do? Yes, what is market portfolio's expected rate of return and how much is a risk-free rate? Yes, now understand market's expected rate of return and how much is a risk-free rate is what they have asked. How do I calculate? What two things they are asking? Market's expected rate of return RM and risk-free rate RF. Two things are missing. That means some two different places some data will be given. Two different beta is given for me. Two different expected return is given for me. I will assume this itself is the required rate. This is the correct return only. Otherwise, there is no way possible for me to do it. Okay, expected return is equal to required return unless you see something else. Based on that, for two different levels, you will use yes RF plus beta into Rm minus Rf It is going to be your expected return. Expected return for both the securities is there. This you will take it as X. Beta is there. This you will take it as Y. Calculate X. Finish off the story. Okay. What is beta of a portfolio? If A is 70%, B is 30%. Portfolio beta is nothing but weighted average. Finish off the question. Over. Portfolio is there. CAPM for portfolio. This much was individual securities. Now portfolio CAPM is also there. Question 26 to 34. What to do? Finish off and go up? Huh? She's telling, we will go, sir. You finish off. YouTube live students, tell me what we should do. They are asking only one question, whether video will be on YouTube. Most of them have gone home. Pradeep is asking again and again. You put 100 messages, response will not change now. We'll try to keep it on YouTube. Okay, fine. Here it's all same style of questions only. Some 2-3 variants are there, that's all. We'll finish it off. Huh? No response only. Huh? See, I can aram se do. Finish off portfolio only in 5 days. I don't have any problem with that. Okay. CAPM. Quickly we'll finish it off. Today's entire target will get over. You guys can go back home, quickly sleep for a while, half an hour, then you think, yes, to practice some questions or not. Yes, okay. Treasury bill is giving me 5%. Okay, RF. Market is giving me 13%. RM. What is the market risk premium? Most difficult question in the world. Market is giving me how much premium? 8% premium. Compute the beta value and required return for the following combination of investment. Okay, they are telling I am investing in treasury bill as well as market. Okay, they are asking the beta as well as required return. Okay, boss. Now tell me. Yes, 100 0, 70 30, 30 70, 0 100. Let me understand what exactly is happening. Yes, option number 1, I put 100% of my money in treasury bill, which is risk free. Yes, this is market. 0% in market. Second is 70% RF, I will put 30% in market, I will put. Now, I know how to calculate portfolio beta. It is weighted average. But for that, I want beta of securities. Tell me whether beta of the securities is given for me. Given? No. That means, can I calculate? No. What will assume? Let us assume X and Y. No. What am I to say? Risk free has a beta of what? 0. Market has a beta of what? 1. So if I put 100% in risk free, my beta of portfolio is what? 0. If I put 70% in risk free, 0.7 into 0, 30% in market, 0.3 into 1, it will be 0.3. 30% in risk free, 0.3 into 0 plus 0.7 into 1 will be 0.7. 100% in market, it is going to be 1. I got the beta of these portfolios. Based on that, can I calculate required return? RF is given. Yes or no, everyone? Okay, fine, great. We will do tomorrow. Yes, you are stuck in RM. Beta of RF 1. My God, when this happened, sir? Beta of RF 0. Oof. Sir, we'll continue tomorrow. Okay, tomorrow we can do. Okay, fine. Okay. I'm giving you guys 2-minute break. Why? Who will revise? Huh? Dead. 86 people are still there online. Oh, it is an achievement. Possibly, if I do not delete this video today, tomorrow it will come to 26 people. Oof. Break is for me. From morning I am speaking. I am only repeating. During repetition also I am only scribbling. You guys are saying like this. What does it be? Portfolio is still green, or now it has become red? Huh? Huh? What? I am giving 1 minute for myself. Okay. We've still reached 30 question only. Portfolio 70 questions are there. Huh? You saw. Tomorrow what all is there? First is underpricing, overpricing, portfolio beta management, sharp single index model. That only. Half day should get over. Then APT is there. APT anyways is okay. GGB. Market line is there. Okay, fine. Sharp's optimum portfolio I will not be touching. There is a concept called as Sharp's optimum portfolio. Okay, there is a formula. I don't know the formula. If you see ICS formula, to remember, after writing 20 times also you won't remember it. Question number 35, practical. That much I know. There is a way you can understand it. Okay, but it is not needed. Till now question has not come. Okay, only one question is there. Study material only it is there. Nowhere else it is there. Yes. Part of knowledge is knowing, yes, when to leave. Okay. Okay. 6:53. We'll see today's entire concept, how much time it will take for us to revise right now. Okay, boss. Portfolio management concept number 1 is modern portfolio theory. I am only telling. Okay, fine. First, why am I creating a portfolio? To reduce risk. How my risk will be reduced? Based on the correlation between the securities. Great. First, let me try understanding individual return and risk. Okay, boss. Past data is there means divided by n. Future data is there means into P. Fine. Expected return. Yes, it is a summation x divided by n. Okay. Variance, risk always I will calculate in variance percentage square. Yes, it is x minus x bar, the whole square. Take a summation. I want average divided by n. Standard deviation is a square root of variance. Boss, future data is there. That means, yes, return is summation p into x. Risk is x minus x bar the whole square into p. Take a summation of that. Okay, boss. I want to calculate covariance, joint deviation of x minus x bar into deviation of y minus y bar. I want to know average divided by n or into p. Okay, boss. Perfect. Now, standard deviation is always going to be square root of variance. Okay. Yes. If annual return is not given to me in the question, how will I calculate annual return? Yes, it is a dividend plus capital appreciation P1 minus P0 divided by P0 into 100. Okay, great. Correlation between two securities. Correlation is telling me how my securities are moving in relation to each other. Okay, yes, correlation is nothing but net risk is how much as a percentage of total risk. Net risk, it is covariance xy divided by total risk. If I did not, yes, if there was no diversification, sigma x into sigma y. Correlation is a numerical value between -1 to +1. +1 means risk did not reduce only. -1 means maximum it has reduced. Okay, boss, great. Yes, correlation of two securities with the market is given. RXM is given, RYM is given. You multiply, you will get RXY. Okay, boss. Two extra points I should keep on the back of my mind. Yes, correlation of a security with itself. Security increase 10%. How much security will increase? 10% only. It is always going to be 1. Covariance of a security with itself. It is nothing but a variance of the security. Okay, boss, perfect. Yes, single structure for future data. Yes, P you will be putting, oh god, P you will be putting, yes, x, P into x, yes, x minus x bar, P into x minus x bar the whole square, y, P into y minus y bar, P into y minus y bar the whole square, P into x minus x bar into y minus y bar. Okay, boss. Now comes, I create a portfolio. What is the expected return of a portfolio? It is weighted average. Yes or no? So it is weight of A, expected return of A plus weight of B, expected return of B, so on and so forth. Okay, fine. Yes, expected return not given means I know how to do past data, future data. Weight is not given, sir. Weight is based on the amount I am investing. Yes, which is nothing but the opening market value. 2 or more year means every year's opening market value I should be considering. Okay, boss, great. Risk of a portfolio. Covariance, correlation, everything we discuss. Now, yes, risk of a portfolio, risk cutting can happen. 3 factors are there. How much weight I am putting, what is the individual, yes, risk, based on that, what is the correlation, how it reduces. Okay, boss. 2 securities. Simple principle, risk I will always calculate as variance, I should give impact of correlation. Yes, A plus B whole square. It is A square plus B square plus 2AB. So it is weight of x sigma x the whole square plus weight of y sigma y the whole square plus 2 into weight of x weight of y sigma x sigma y r x y. If I want sigma x into sigma y into r x y, I can also write it as covariance x y. Okay, boss, great. 3 securities are there. A plus B plus C whole square. Yes, it is weight of x sigma x whole square plus B square plus C square plus 2AB, yes, into correlation I will be putting 2BC, 2AC, correlation impact I should be giving it there. Okay, boss, simple. Okay, standard deviation is always square root of variance, no tension only. Now, minimum risk portfolio. Okay, yes, X is there, Y is there, X's risk, who will reduce? Y will reduce. What is the extent of risk reduction? It is variance minus covariance. Variance it was there, it came down to covariance. Okay, that means weight of x, it is risk reduction of y divided by total risk reduction of x plus y. You will calculate that, based on that you will be doing. Okay, boss. 3 securities with market line, will be discussing it. Okay, shortcut formula, if R is equal to +1, I can directly calculate standard deviation of portfolio as weighted average. Yes, weight of x sigma x plus weight of y sigma y. Yes, whether my risk will be reduced if R is equal to 1, was not possible. If R is equal to -1, maximum risk cutting happens. If I want directly, I can calculate standard deviation as, yes, A minus B, yes, weight of x sigma x minus weight of y sigma y. Okay, fine. Yes, now risk, if I want in this case, I can bring it to 0 also. For that, how much proportion I should be investing? Weight of x is x, weight of y is 1 minus y. Sigma p will be equal to 0. Based on that you do. Yes, even if you do not remember this, minimum risk portfolio formula is there. Weight of x is risk reduction of y divided by total risk reduction. That also if you put, you will get the same answer only. No need to worry. Okay, fine. Others, okay, it cannot be reduced. Okay. Efficient and optimum portfolios. Multiple securities are there. How will I select my efficient securities? First, I will pick the securities having same returns. In that, which risk I want lowest, I will select. Others I will eliminate. Then I will compare securities having the same risk. For the risk, maximum returns I want. Then balance, I will put in ascending order of risk. I will see whether any inefficient securities is there. Okay, boss. Efficient frontier, yes, this upward umbrella shape. Below is going to be inefficient securities. Optimum, in the efficient also, which one I should choose? Okay, 2 things. Coefficient of variation is there, Sharpe's ratio is there. Coefficient of variation is sigma divided by x bar. For 1 unit of return, how much risk I am taking? Lowest I want. Sharpe's ratio, it is extra how much I am getting for 1 unit of risk. That is extra return, expected return minus risk free. Extra return for how much risk I am taking, divided by sigma. Okay. Capital market line anyways is not needed. Yes, concept 1 is over. Yes, now comes concept 3, CAPM and beta by Sharpe. Okay, first is concept of beta. What did Sharpe tell? Sharpe told, boss, you cannot be asking premium based on total risk, because in that unsystematic is there, that you can diversify and eliminate now. That means everywhere you demand a premium based on systematic risk only. So we are asking, how do I calculate systematic risk? He told, calculate beta. So beta is a measure of systematic risk. So I will be demanding premium based on systematic risk only. Okay. Interpretation, what does beta tell? If my beta is 1.5, it means that my security is 1.5 times risky when compared to market. If my market increases by 1%, security changes 1.5. Market decreases by 1%, security falls by 1.5%. If market increases by 10 means it becomes 1.5 of that, 15%, so on and so forth. Types of beta. Positive beta means market increases, security will also increase. But to what extent? If it is up to 1 means it is less risky, defensive stock exactly equal to 1. Yes, same risky as market, more than 1, more riskier than market. Zero beta, whether market anything happens, security does not change only. Negative beta, market is increasing, security will go in the opposite direction they are going. Okay boss, great. Now how do I calculate beta of individual securities? Yes, let us try. Yes, doing it. Look at this, beta of securities. 2 years data is given, more than 2 years data is given. Beta is always calculated keeping market as a base. For change in market, how much it is changing? Only 2 years data is given. I will see change in securities return divided by change in market return. Multiple years data is given. I want beta of x. It is systematic risk of x divided by systematic risk of market. How do I get systematic risk of x? It is a total risk of x, sigma x. But in that, how much percentage is systematic into RXM? That also told by. Yes, divided by systematic risk of market, which is a total risk of market. That is anyway systematic only. Yes, unsystematic because it is a portfolio already would have gone. So it is sigma x divided by sigma m into RXM. Yes, I can also write it as covariance XM divided by sigma m square. Based on that, if I want a shortcut formula only for past data, this should be there. Future data is there, you do XM m square, big 0 you will get. Okay, yes, I will just play with this. I will create covariance XM divided by sigma m square. Covariance XM summation x minus x bar m minus m bar divided by n gets nullified, sigma m square summation m minus m bar the whole square divided by n gets nullified. Now simple, first one with first one, second one with second one, summation xm minus, yes, x bar m bar is there, average is there, directly you will multiply by number of years, n into x bar m bar divided by summation m square minus n into m bar square. Yes, your format is going to be x m xm m square. Takka you will be getting your beta. Is this clear everyone? Okay, fine. Beta calculation formula is over. Yes, portfolio beta, it is nothing but the weighted average of beta. Okay, some important beta figures. This is where you guys got stuck. Most important thing in life, beta of risk free does not change, 0. Beta of market, I am seeing in relation to market, it is going to be 1. Okay, CAPM, required return. Yes, it is RF plus beta into RM minus RF. Individual security means securities beta I will take. Yes, portfolio means portfolio beta, weighted average I will be taking. Okay, blast from the past, important things for us. Yes, risk free. If it is not directly given in the question, it is a coupon divided by market price into 100. 2 or more risk free is given means I will take the average of my risk free. RM is not given in the question. If market related data is given, index values are given. Yes, I will tell my return of market, it is a capital appreciation percentage plus dividend yield. Dividend yield will be given to me. Capital appreciation. Year starting, what was the index value? Year ending, how much it became? P1 minus P0 divided by P0 into 100. Okay, boss. Market related data only is not given. Can anyone in the world calculate market return? No. But who will calculate? I say will calculate. What they will tell? My portfolio only is market. So I will calculate the return of portfolio and tell that is the return of market. So I will tell it is nothing but D plus P1 minus P0 divided by P0 into 100. All these things are for the portfolio, for my portfolio. Okay. Yes. Based on that, if RM, RF both are missing in the question, but required rate as well as beta for 2 different levels are given for me. Yes, assume RF is equal to X, RM minus RF is equal to Y, create 2 equation, finish it off. Yes, question asks you simple average return of the portfolio. I should calculate simple average beta. Based on that we will be using this. Yes, why am I telling these things exactly? You will understand it tomorrow. SML, it's the same equation, RF plus beta into RM minus RF. RF value I will be putting, RM minus RF value I will be putting, beta I will be keeping it as it is. Till here we have discussed. So it is 7:04, 6:53 means okay, 11 minutes. Yes, reasonable. Okay, tomorrow again some 7 to 8 minutes, 20 minutes, the entire chapter. Okay, yes, by me telling will be over. Okay, so obviously you do it 1 time, 2 time, 3 times, 4 time, you keep on scribbling, it will come to you. Okay, because this is one of the most scoring chapters for you. Okay, this from examination perspective, yes, mistakes you can do, but apart from that, nothing much difficult will come. Okay, mutual fund is even more scoring. Every time 8 marks will come. Nothing is there in that. Okay, yes. If it is scoring means you try scoring. If it is difficult means you manage somehow. So now forex is there, manage somehow. Okay, yes. So that's all for today. Yes, I hope you guys have got some value addition. Online students, thank you so much for staying till the end. Yes, even after 9 hours, 76 people are still there on YouTube. On Zoom also some people are there. Zoom people I have not seen only from morning. I have not even opened that tab. So thank you so much. Really means a lot to go back home, let the things settle in, try revising. These pages I will share on the Telegram group. It will help you to quickly summarize things. Based on that, practice questions. Obviously, it will not be possible to solve each and every question. It will take some 2 years again. 26 question you do x, y, x, y, x bar, m bar. Okay, but some questions at least you do. You read whatever, at least in every concept, 1 or 2 basic questions you do. Okay, based on that, now whatever adjustment is new, that you try doing. Okay, thank you so much, students. See you guys tomorrow. Okay, yeah. Online live students. Yeah, anything else? Thank you, sir. Thank you so much, dear. Good night. Okay, thank you so much, da. Oh, it is 7 o'clock already, yeah. Sleep well, sir. Thank you. So we'll end the stream, online live students. Okay. Joker, sir, security evaluation. First, let me finish portfolio, da. Then we'll come slowly. Security evaluation is simple only, na. Okay. We'll end the stream. Thank you so much, students. See you guys tomorrow, hopefully. Thank you, sir. Today's class was superb. Thank you, da. Our class timings is going to be same only. Forgot. 9:30 to 6.